Are you looking to learn how to trade options, but you just don't know where to start? I did a live event recently teaching all about how to sell a put and sell a covered call in order to create income on a weekly basis. And guess what? I'm gonna put it for free right here on this channel. I hope you enjoy. Day one, I want to give you, as me and my little puppy Franklin, my biography. So I started, it's going to be brief because I know that you guys aren't here to listen to me talk about me, right? You're here to learn options. But I want to let you know that I started trading way back when, 1997. So that was an uber long time ago. For the past 10 years, I've been only trading options. That's it. 99% of my income comes from trading. So you guys should know that. Lifestyle. I want you, as we start talking about the day today, I want you guys to think about why you're here, right? What does trading, or what do you want trading to give you? Like, we don't want to think about, okay, just some dollars, right? Like who cares about paper? Dollars are just paper. But what will that give you? How will that change your life? What kind of lifestyle are you looking to get? So I just put a couple of pictures. This isn't to impress you, but this is to impress upon you. I can do it. You can do it. Anybody can do it. You're only limited by your own limiting beliefs. This works, and the strategies that I go over, it's going to work for big accounts, small accounts, everywhere in between. So I just put some things that are important to me. I love my car. So I live in New York City and I don't even really need a car, but I have one. And I have a Porsche 911. Is amazing. So that's me in New York. On the bottom left there, that was taken recently in Thailand this past May. So I stayed at the Ritz-Carlton. Oh my gosh, it was amazing. I had my own private pool villa looking out with the ocean. The right photo is in Bali. I lived in Bali for a little bit. You know, I've had the blessed life to be able to live wherever. So that's the thing about options, guys. And I know that some of you are checking in. I know Pete said you're from Finland. That's awesome. Dan is from Canada. There's a bunch of people from the US as well. This works no matter where you are. So you can be in US based, you can be somewhere else around the world, and this works. And you can trade from anywhere. The top middle picture, that's a special picture to me. Those are my kids, Nina and Adam. So last Thanksgiving, they come here to New York. They live in LA, but they come to New York fairly regularly. And I go to LA as well. But we took that picture last Thanksgiving when they came to visit. And oh my gosh, I had such a rock star month trading options last Thanksgiving. Those are Montclair jackets that we had this like big shopping spree. Now, again, I'm not saying this to impress you, and I'm not trying to brag, but I want to really hit home how much money you can make. So people say sometimes, like, listen, the market in general, people, Wall Street, I'll say Wall Street people, they try to make people believe that you can't make money, or 10%, 20%, 30% per year. That just is not true. You're only limited by your own limiting beliefs. Last November of 2024, this is a screenshot. As I was making these slides a couple days ago, this is from my account that I have. I made literally $115,000. Now, again, I'm not saying that to impress you, but I'm saying that you can do this, right? And it works on a large scale, small scale, the same exact strategies. Only two strategies that you need to know. This can be as hard as you make it or as easy as you make it. Somebody earlier today commented, I've been getting so many comments and subscribers on my YouTube. That makes my heart happy. But somebody said recently that they were talking about like all this technical analysis and trading tools and being tied to a computer screen. Here's the thing. It's not about just making money. Again, it's about the lifestyle that you create. I'm not tied to a trading I don't even have trading screens. I'm just talking right now on my laptop. And yeah, there's only two strategies you need to know. You need to know how to sell a put and sell a covered call. That's it. That's what we're going to talk about. And I'm going to give you all the information so you can make your very first trade next Monday if you want to. So as we start the presentation today, I want to talk a little bit because we do have a lot of beginners in the audience. And if you don't have any experience in stocks, I just want to kind of go over what are stocks? How does that work? Stocks are just publicly traded companies, right? So the US stock market is open during the day, Monday through Friday, 9:30 to 4. There's also going to be, and this is important for people to know that maybe sometimes new people don't necessarily aren't aware of. There's also an overnight market. So at 4 o'clock, when the US market closes, other countries are trading. So sometimes what happens is you know, today 4 o'clock comes and I go to bed tonight and then I wake up tomorrow morning, the price is not going to be what the price was when it closed, because it's going to kind of, you know, go up and down as we go, right? So stocks are pieces of a big company, right? What are examples? Disney, Tesla, General Motors, you know, all these big companies, they are publicly traded companies. You can buy one share, you can buy 1,000 shares, you can buy 5,000 shares. This presentation, we're going to walk through all of those. I'm going to share my screen live as I'm doing now, and I'm going to walk through exactly how you enter orders. How does that work? What does that mean? So it's going to be very, very helpful for you guys. Also, sometimes you can even buy fractional shares now. That's kind of popular. You know, a half a share, 0.2 of a share, that kind of thing. But here's the thing with stocks, guys, and I know probably some of you guys have heard this before. And listen, some of this content you might have heard before, and I don't want you to be bored and think, oh my gosh, like she's just repeating herself. Repetition is the mother of skill. There are certain things that I am just going to talk about multiple times because it is just so important. And this is one of them. One of the biggest problems with stocks is that you make paper money. So basically, most people, the only way you make money in stocks is you buy 100 shares of, you know, Amazon, let's say, and the stock goes up. Okay, I see, you know, I started with $10,000. Now I have $12,000, but it's on a piece of paper or you see it online. Also, what about when the stock goes down? I mean, you could short a stock. We're not going to talk a lot about that now, but I do want to let you know that you can sell a stock short and make money that way as well. Some people do that. Me, I stick to the easy concepts. Here's the thing. If you want to create a system that's very easy to replicate, you have to make it easy, right? Two things: selling a put, selling a call. That's it, right? Going back to stocks, you make money when the stocks go up, but it's paper money. Sometimes you get paid a dividend. So dividends, what are dividends? Dividends are kind of like a way that some companies, particularly big companies, they will share in their profits with their shareholders on a regular basis. So in addition to making that paper gain, they might pay, you know, 5 cents per share that you own every quarter, that sort of thing. It's not a guaranteed thing, but it's another way that you can make money. And that's really the only way that you can make actual cash that you can put in your pocket with stocks. Now, I like this slide. Paper gain. Oh my gosh, I wanna impress upon you guys the biggest, one of the biggest differences: paper gain, realized gain. Does a paper gain, like, does that allow me to take my kids shopping on Madison Avenue and spend $13,000 buying Montclair jackets? Does that paper gain let me book a flight business class from New York to LA? Absolutely not. Well, what can you do with the paper gain? You can wipe your fucking ass with a paper gain. That's it, right? Excuse my language. I hope nobody's offended by that. But you can't spend it. So I just want to like impress that upon you. You cannot spend it. It's not cash in your pocket. You just get to see it. And you have to sell your stuff to take the money out, right? What if you buy Tesla? I'm just going to use Tesla. I use Tesla a lot because that's one of my favorite stocks. What if you buy Tesla and the price goes up and up and up? And that's amazing. But how do you access, like, to spend some of that money? You have to sell your shares. Well, what if you don't want to? That is a fundamentally broken system with trading stocks. ETFs are kind of the same thing. What's an ETF? An ETF is an exchange traded fund. So it's kind of like a bunch of stocks in one pie, you might say. However, ETFs have what's called a middleman. So there's somebody that's managing that fund or putting that fund together. And they get paid for that. So really, you're paying a middleman to buy stuff that you could just buy on your own anyway. So really, that's not a great way to go. And also, ETFs are the same as stocks. It's going to be a paper gain. You can't take money out. Maybe you get a couple pennies in dividends, and I'm not sure what you could buy with a couple pennies these days, right? This is a slide I just put in actually just before this program started. I wanted to really hit home the misconception that people have about the investment industry and about investing in general. Listen, here's the thing, guys. There are certain things that you need a professional for. Like, for example, we were skiing last year and my son broke his collarbone, right? And okay, we go to the emergency room. He had to have surgery, that kind of thing. So he needs a doctor, a surgeon, right? So you can't just like put a Band-Aid on it and fix it. So there are certain things that I recognize that you need a professional for. However, investing is not one of them. Absolutely not. And I don't care if you think, hey, I didn't graduate high school. I didn't go to college. I'm not that good in math. I don't know anything about stocks. My parents never taught me this. I don't care what your excuses are. You can learn these easy concepts. I want to show you this. These are popular funds, and this is why Wall Street is like really trying to tell people that they can't do it, and because it's a rigged game, right? American funds. So a long time ago, I managed money for people. I worked for a broker dealer, and one of the biggest fund companies was American Funds, and they used to make so much money. And I just pulled these numbers off the internet. One of their popular funds, Capital Income Builder, 150 billion in assets under management. What does that mean? That means that here's this monstrous Goliath of a mutual fund. What's a mutual fund? It's like all these little stocks in this basket, right? And here's Wall Street telling you, like, you need a financial advisor. You need to, buy this. You need to just time in the market, and you'll make your 8%, you'll make your 10% per year. Who wants that? Oh my gosh. You know why they're telling you that is because they make trillions of dollars off the stupidity of Americans and other people, frankly, all throughout the world on an ongoing basis. And this just proves my point. $150 billion. What's their expense ratio? 1.36% on average for this particular fund. So what does that mean? That means that built into the performance of the fund, they're taking out 1.36%. So I'll just use round numbers. Let's say like all that stuff in the fund makes 10%. They keep 1.36 off the top. You get the rest. What does that translate into dollars? Over $2 billion per year. Do you think that Wall Street is incentivized to tell you the things that I'm telling you in this class? Do you think that Wall Street is incentivized to tell you, you know what, you could trade options on your own. You don't need all these fancy things. You don't need a financial advisor or invest in a mutual fund company. They're incentivized to hold you down because they're making $2 billion per year off of you. Vanguard, same thing. This is just like a Vanguard total stock market index. How much in assets under management? 1.3 trillion. The T is for trillion, people. Now the expense ratio is a little bit lower for this one, 0.04%. Why is it lower? It's because all they do is just stick a bunch of things in the fund. They're not actively managing, oh my gosh, let me try to make a little bit more money. Let me manage my risk. No, they're just buying a basket of stuff, and then they're just wrapping it up and selling it to you. And for that, they're making $500 million, $520 million per year on an ongoing basis. BlackRock, same thing. What if I can show you a way that, forget about all that Wall Street BS, right? What if I could show you a way that you can get paid the same day, lock in your gain every week, so they're actual realized gains. You could take that out of your pocket and you can go spend it. You can go buy some sushi, whatever you want to do. And you can also make money if the stock goes up, but you can also make money if it goes down and if it stays sideways. Here's the thing, guys. The market goes like this. We're going to kind of go through some charts throughout this workshop. And I'm going to show you kind of like the movement. And maybe you're already familiar with that, how the markets kind of like go up and down. Markets go like this over the long term, especially good stocks, they go up, right? Over the long term. But what if I could show you a way that you can make money if it goes up or goes down or stays sideways? And here's the best part. You have no customers, no employees. You could do it from anywhere in the world, and all you need is a laptop. Some people don't even use a laptop. I taught a friend of mine, Chuck, a few years ago. He used to use his phone. Me, I can't do that. You could. I think it's challenging. I would say you need a laptop. But who doesn't want to be this cat on the beach right here, like just trading your stuff? Listen, no employees, no customers. There is something to be said for that. For like 10 years, I had 3 Airbnbs, villas in the Virgin Islands. And it was cool. And the cool part about it was, actually the best part about it is I can go there, I can hang out. I had friends there. My kids can go there. They can bring their friends. I can have friends visit. That's the best part. But the really pain in the butt part was like customers. Oh my gosh, like how beautiful would life be if you could make money and not have any customers, not have any employees, and you could do it whenever you want also. Like me, I go to typically I get up in the morning, I take Franklin out, the puppy, I go to the gym, I come back, I make some breakfast, I look at the trades. Lately, I've been spending all my time on coding, programming. So I'm going to talk more about that later. But here's the thing. When you learn about options trading, really, you only have to spend maybe like 15 minutes a day trading. It doesn't take a long time, I'm telling you. So again, you could do it anywhere, anytime, no customers, no employees. So what are options? So we talked a little bit about stocks, but what are options? Let's talk about what options are. Options are the right, not the obligation, but the right to buy or sell something at a certain price before a certain date. Now that might sound confusing, especially if you're new. So don't get hung up on lingo, specifics, definitions. I just want to kind of, just let you know the basics of what does an option mean. Each option represents 100 shares of stock. So here's the cool thing about options. Like, instead of trading stocks, again, that's a broken system. And hopefully you guys all agree with me now. Send me some love if you do agree. I hope you guys all understand now that trading stock is not the right way to go. So trading options is the right way to go. Each option represents 100 shares of stock. So what that means, guys, is that you get to capitalize on the movement of that particular stock, but using options instead. It might sound confusing. As we talk about puts and calls, it's going to kind of click to you guys. Okay. Cash flow. So again, the great thing about options is that you get steady cash flow. Now, I don't know what you guys predicaments are right now. Like, I don't know if you retired, work for yourself, work for a company, have a 9-to-5 job. But here's the thing, especially for those 9-to-5 type people, you get like that sense of cash flow. You get paid every week, or you get paid bi-weekly, and you get income in your pocket, so you can do things with that, spend it, pay your bills, that kind of thing. This is the same thing. Options give you cash flow. When you sell an option, you get paid right away. That money gets dropped into your bank account. We're going to go through more details about that as the presentation continues, but I want you guys to know right now, what you're doing is creating weekly income. Here's the thing. I don't have, and I think none of us have, a crystal ball. I have no idea where the market's going to go, like next week, next month, next year, whatever. I know that I need a certain amount of money to sustain my lifestyle, right? My rent is X dollars. My parking fee is X dollars. I spend X dollars on travel. I spend X dollars on, whatever, clothes, groceries, whatever. You have to create yourself weekly income. So that's kind of like, that's mostly, now you don't have to do weekly income. I'm going to talk about that as we go along, but that's mostly what I teach, is because I don't know, like, don't you want to check every week, or do you want to wait like till the first of the month for a check? I don't know. I think a check every week is way better. And it gives you realized gains. And again, realized gains is cash in your pocket that you can spend. Cash flow trumps paper gains any day of the week. Here's the fact. Anybody that's trading stocks and they're not trading options, they are missing the boat. They either, for some reason, don't know, or they think it's like, hey, I heard my neighbor say that they lost a bunch of money in options, blah, blah, blah. Or I heard the news said like options trading is risky. It can be. It depends on how you do it. I'm going to give you all the specifics. Listen, guys, my point for being here is that I want to teach you, to empower you to be able to do this yourself. Your success does not minimize my success. I want to see other people happy. I'm telling you, the Wall Street, I'll just term them Wall Street. They have this thing that they want to keep you down, and they don't want you to realize that you can do this yourself. So yeah, so let's talk about options. Let's just back up a moment, because I don't want anybody to get lost here. And I want to make it super easy for everybody. Okay, so let's talk about options. So options, really, this is a handful, 5 things on options that you just want to understand or have a basic understanding. These are the things that we're going to talk about throughout the week. Underlying security. What's the option on? Is it on, Tesla? Is it on MicroStrategy? Is it on Intel? Is it on Google, Amazon? What's it on, right? That is called the underlying security. Sounds confusing, but it's not. And also, I want to put this in here also as we get going. This is going to be very much, I know I've said this in a lot of videos, but it's so relevant. And again, repetition is the mother of skill. I don't know how many of you, this is a good analogy that I think of. I don't know how many of you out there drive standard, right? So stick shift is not that popular now if you're younger, but if you're older, I'm in my 50s, early 50s. So early on, I drove stick. And when I first started driving standard shift, right, it was very challenging for me. Oh my gosh, like I have to like move the thing with my right hand. And then I also have to use both my feet at the same time, right? The gas is with my right foot, the clutch is with my left. If I'm on a hill, I start to roll back. I felt like there were just so many things that I had to like figure out. And I was kind of like, at first, I was kind of like panicky, like, I don't know, can I do this? This options might be the very same way. You might be feeling overwhelmed, panicky. I don't know if I'm smart enough to do that. I don't know if I can do that. Everybody says it's hard, blah, blah, blah. I'm telling you, get that shit right out of your head. There's a handful of things that you have to know, and I'm going to break it down simple. Underlying security. The second thing is it a put or a call? There's only two kinds of options, a put and a call. We're going to go over that in a couple slides. The way I remember puts and calls though, put down and call up, right? So a put, somebody that buys a put, they want the price to go down, right? Somebody that buys a call, they want the price to go up, right? Again, you don't have to memorize these things. I'm just trying to like give you some foundations. And then it's going to start to click as we go along. I promise you, there's not anyone that I've talked about options with, that I've taught, that could not understand it. The only way that you will fail, let's say, and not be able to do this is if you give up. That's the only way. So you have to believe in yourself, right? I can't believe in you more than you believe in yourself. And you have to just give it this 10 hours that we're going to spend 2 hours each day. And then you're going to be able to spend like 15, 20 minutes a day. I'm telling you, just don't give up. Put or a call. I'm going to go through some slides and visually illustrate to you the differences, but there's only two kinds of options. The other thing that we want to know about with regards to options is the strike price. That's the price at which you're going to buy or sell your stock. So that's the strike price. So just kind of get a sense of what these words mean. Maybe if you have your phone next to you, just maybe put that in notes or something, or scribble it on a pad. I'm going to send out these slides as well as the presentation also, so don't worry about that. The fourth thing is expiration date. So all options will have an expiration date. It's kind of like car insurance, right? So who doesn't know how car insurance works? Me, I'm in New York, although my car is registered in California. So in California, we have like, I think mostly California, 6-month policies. So my policy goes from, let's say, I don't know, January 1st till June 30th or whatever that is. That's the term, the length of that particular contract. Options are going to be the same thing. They all have an expiration date. We're going to talk more about that as it goes. And then premium, obviously, that's the name of the game here, guys. That's why you're selling options, to collect premium. What is premium? Premium is the money that you get paid when you sell an option. So I'm going to go through that in more detail, but basically just to give you a preview, when you sell an option, you are committing to do something. So you have a commitment, and for that commitment, you are paid a premium. You get to keep that no matter what happens. And that's the most important thing. One of the things, listen, I've been teaching so many people over the past, I don't know, like bunch of years. It's, why I teach people? I don't even make that much money from it, honestly, but I'm passionate about it. I love talking about this, and I love to see people like, first of all, I don't know, I guess from an ego standpoint, it makes me feel really good when I can change somebody's life. Like this is life-changing stuff. This is going back to my example on driving a stick shift. This is kind of like once you learn something like standard stick shift driving, riding a bicycle is the same thing. Oh my gosh, it's kind of like when you're a kid, you try riding a bike and maybe like it's hard to balance and you fall down and you scrape your knee. But you learn, and then once it clicks, and once it clicks, you have that for the rest of your life. I haven't ridden a bicycle in a while, but I'll tell you what, I'm very confident that I could just hop on a bicycle and ride it no problem. This is going to be the same thing once you have it. So going back to premium, one of the biggest things that people don't recognize at first is that you keep the premium no matter what happens. It's kind of like this, guys. Let's go back to car insurance. I pay car insurance, and what am I paying for? The car insurance company is charging me a premium. I pay them money, right? Also called a premium. And for that money, What's their commitment? They're committing to fix my car if I smash it. Basically, that's kind of it with the car insurance. They're going to take care of my bills if I have a car accident, right? Now, let's say I drive, 6 months, a year, 2 years, 5 years, 10 years, and I never have an accident. Do they give me any of that money back? Heck no, they keep the premium. This is the same thing. When you sell an option, you keep the premium no matter what happens, right? So let's say, let me go back to my example. I sell a put, a $90 put on ABC stock. ABC stock is at $100. I'm committing to buy 100 shares at $90. That's the strike price, by the way. If it goes down to $90 before Friday, that's the expiration date, by the way, for that commitment that I'm committing to buy those shares, if it drops below that price before the expiration date, I'm paid a premium. I keep that no matter what happens. If the stock goes up, if the stock goes down, if the stock goes bankrupt, it doesn't matter. I keep that premium no matter what happens, right? Okay, so going forward. So I'm going to break those things down that we just talked about in these bite-sized pieces. So options can be basically traded on anything, right? So again, that's called the underlying security. So that could be a stock. It could be an ETF, which is an exchange traded fund. It could be cryptocurrency. You can trade options on Bitcoin, actual Bitcoin. I'm going to show you in this presentation on how you can trade options on stock crypto companies. That's even better than trading it on Bitcoin. I don't know if you guys are Bitcoin believers, cryptocurrency believers. I am personally. I mean, first of all, it's never going to go bankrupt. It's just not going to happen, and it's only going to go up. And so right now, there's a lot of really great opportunities. I'm going to show you MicroStrategy is my favorite one. I'm going to show you how much I made in MicroStrategy last year. And you can do the same thing. And MicroStrategy is a little bit more expensive, but you can do it in other stocks, and I'm going to go over that as well. Okay, commodities, you can also trade. That's how I got my start, right? So I started way back in 1997. And by the way, I did not grow up in a family that was affluent or that invested in the stock market in general. I didn't even know what the stock market was. Listen, I made a video a couple days ago on YouTube, and I think it was good. My daughter gave me the idea of it. Schools teach all these things in school, right? All these subjects. And some of them are important. Like I truly believe math is important. It is. You don't have to be a math whiz, by the way, to do what I'm doing. But they teach all these like other things, history, I don't know, geography. I guess that's important too. Cooking, shop, whatever. But nobody teaches finance. I had no idea what stocks were. And so when I was 23, I think I was 23 at the time, this friend of mine was talking, and he was telling me about like how he was trading commodity futures and options. And I was like, what the heck is that? And it's stuff like gold, silver, currencies, pork bellies, soybeans, that kind of thing. And this was old school. This is before computers. So that's really when I started, and I became passionate about it. And my I guess I don't want to say breaking point. My click for me at the time was, oh my gosh, like I just always thought like, you have this 9 to 5 thing. 9 to 5 is like, I was telling the doorman in the building that I live, I think I said this to him yesterday. 9 to 5 is the biggest farce, the biggest American farce. You don't need a 9 to 5. I'm telling you, Wall Street and the government wants to hold people down. They don't want you knowing this stuff. So yeah, that's what like sparked my curiosity at the beginning. Like, oh my gosh, I could actually make a bunch of money and not have to like physically go somewhere and like work for somebody. Yes, you can. But going back to my, I don't want to get off target too much. Underlying security, you could trade options on lots of different things. That was my point. But me, I specifically stick with stocks, and that's what we're going to talk most about in this presentation. Puts and calls. So let's see, puts and calls. Basically, again, there's two kinds of options, right? You have a put and you have a call. And as we go, it might be confusing at the beginning. It's like learning a new language, right? So I was living in Bali for a couple of years, and I was learning Indonesian, which is actually quite an easy language, they say, like easier than, let's say, Mandarin or something like that, of course, way easier. But it was still kind of hard. Like it takes a little while to like, get the sense. And this is kind of the same thing. So I'm going to say a lot of these things over and over again until it really like starts to click for you. But basically a put, the buyer of a put. Now we're not buyers, by the way, and I'm going to talk more about this as we go. We sell options. So that that is super important for you to remember as we go. We are always going to be option sellers. But when we sell something, there's a buyer on the other end of that transaction. The buyer, when they buy a put, they want the price to go down. And just remember that I'm putting a coffee cup down, put down. A call, right, is the opposite. It's just the opposite. The buyer, not the seller, but the buyer of a call wants the price to go up. Call up. I'm calling this dude up on the phone, right? So that's an easy way that you can remember that. Strike price. Strike price was the other piece that remember we had those 5 pieces: underlying, put or call, strike price. Strike price is the price at which you're going to make the trade, right? How much you're going to pay if you have to buy the shares. So if I sell a put, I am committing to buy that stock at a certain price. That's the strike price before a certain date. That's the expiration. We're going to talk about that in a moment. Conversely, if I sell a call, I'm committing to sell my shares. When we talk about calls, guys, we're always going to talk about covered calls. So a while ago, somebody had asked about put, cash secured put versus naked put. Calls are kind of the same thing. And I can talk about both, but I only trade covered calls. And what that means is I already have the stock, or I buy the stock right now. I could do that too. And we're going to go through lots of live examples, guys, as we go. But basically, I have the shares, 100 shares of this particular stock, and I'm committing to sell those shares at that particular price, which is the strike price, right? So one's down, put down, call up. That's the difference. They're just opposite. Strike price is the price at which you're going to make that trade. Expiration date is the term of that contract. So again, typically it's going to be every Friday. So the big ones that I trade, and certainly the ones that we talk about this week, are going to have every single Friday. Now as we go through the content, you can there's different expiration dates, right? So like for example, Apple, let's say I want to trade a contract on Apple. It can be an expiration date of this Friday, an expiration date of next Friday, the following Friday, the Friday after that. I can go 1 month out, I can go 2 months out, but it's always going to be on Friday. So that's the important thing. Friday at the close of the market. Okay. Premium. So premium, that's the 5th part of our 5-piece thing about options. That's the best part, right? Because it's like a bag of cash. How much money are you going to get paid when you make the trade, right? So everything, every contract will have what's called a premium. It's very much like car insurance. What's the premium I'm going to pay? I'm going to pay that amount of money to the insurance company. This is the same thing. And when we look at a chart, we're going to look at some charts in a moment. That way you can get a sense of what you're going to be looking at. It's going to look very foreign to you at the beginning. But again, it's going to be one of those things that you just kind of just keep familiarizing yourself. And all throughout this week, it's going to start to click. But basically, when I look at the premium, if the premium is, let's say, $1.20, it might say 1.2, right? I'm always going to multiply that by 100 to know how much cash I'm going to put in my pocket. And the reason for that is each contract represents 100 shares. So that'll start to become automatic for you. So if the premium if the price on a contract is 5.0 or $5, people say $5 price, it's 500 because it's multiplied by 100. And don't worry if I'm going fast. I'm going to keep reintroducing a lot of these things, and I'm going to slow down as well. Okay, so as we talk about all these things now, I don't want you to be super confused. When I look at this at first, if I don't know what the heck it is, it's like, oh my gosh, what are all those things on the screen? But I'm going to break it down so easy for you. Basically, this is a snapshot of my trading program. Now, we're going to talk more about where you trade. Most of that comes on the last day, like who should you open an account with? There's different brokerage companies. There's, E-Trade or Fidelity or Tradier or Schwab, Interactive Brokers, lots of different companies. They're all kind of similar in lots of ways, but their platform might look a little bit differently. But they're all going to have this type of information. And don't worry, if it looks confusing, I'm just going to walk through the important things. So I have some red arrows. So for example, this is a screenshot of Tesla. So you're going to see in the upper left-hand side, that's going to be the ticker symbol, right? So that's the stock that we're making the trade on. That's the symbol TSLA, right? Then if I look at the second arrow on the left side, it's the date, right? We see 29 August 25. That's the contract expiration date. So that is going to be the date at which that contract will expire, right? And if you look down toward that page, on that page, you'll see 5 September, 12 September, 19 September. Like I said, most contracts, especially the big ones that we talk about, have these Friday expiration dates. So you can just open that up and get the data for any particular date that you're interested in. Me personally, I always look at 1 week. Again, I don't know what the market's going to do in 2 weeks. Plus, I want to make money every single week because I have obligations, financial obligations that I want to take care of. The other pieces on the slideshow here, the screen, is the circles. So look at the circle on the left and the circle on the right. Calls are going to be on the left and puts are going to be on the right. Again, it looks confusing, but as we talk through this, it's going to start to click. So if you're looking, or if you want to find the price of a put contract, you're just going to follow the strike price down the middle. So you'll see strike, the middle arrow. The strike price, what does that mean? That means the price at which you're going to buy or sell that particular stock. So if you're looking at selling a put, you're going to, let's say, I'm going to give you an example. Tesla, when I put this slide together, I think it was a couple days ago, was trading at $340 per share. The way I see that is there's a last piece. So if you look at where it says Tesla in the upper left and go down a tiny bit, and a little bit over to the right, it says last X 340. It's kind of like hidden some of that information by the red arrow. That's the last price that it had traded. So Tesla is trading at $340 per share. Let's say I want to buy, or I want to sell rather, a $330 per share put, and I want to see what the price is, right? I go down to 330. I don't know if you guys can see my mouse here, but go to the strike price in the middle and go down to $330. And if I'm selling a put, I'm going to go to the put side, which is the right side, right? And I'm going to go to this last column here, this arrow, right? So a $330 put, if I just move my mouse over, it's 3.77. So that's the price at which that contract is trading, right? Or which that contract last traded. Now, what did we say a slide ago? We're always going to multiply that times 100 to know how much cash we put in our pocket, right? So if the price on that contract is 3.77 times 100, that means that we are paid $377 in our account right then and there. Instant gratification, people. So this is how we kind of like read this. We're going to go through this all week. Again, today is kind of like that intro day. We're going to, today might be the most confusing day for you guys, in all honesty, especially for those of you who may not have that much experience in stocks or options. But as we go through, we're going to keep talking about a lot of these things. Alrighty, so here's an interesting slide. It's like being in the supermarket. So this slide here, right, with all this goop on here on the screen, it's kind of like, okay, I've been in New York for about a year now. I've lived in lots of different places throughout the past few years. And when I first came to New York, I usually shop at Whole Foods. I don't know where you guys are, if you guys have Whole Foods. Whole Foods and Trader Joe's are kind of like my go-to supermarket. And so when I moved to New York, and even though it's the same store, Whole Foods, it was very different than the one in LA. So I go in and I'm not sure where things are at, that kind of thing. But once I kind of like go to the store a few times, okay, I know the mangoes are over here. I know the bread's over here. I know this is over here, that kind of thing. This is going to be the same thing. This looks confusing, but I'm telling you, I'm going to break it down easy for you guys. Let's keep talking about, this is the most important thing is understanding the concepts of options, how they work, buying an option, selling an option. And that's like the foundation of what we're going to talk about all week. So I want to kind of like discuss that a little bit further. I want to talk about the difference between buying an option and selling an option. So we, again, what are we? Do we ever buy options? What do you guys think? Do we buy options? Yes or no? Absolutely not. We are option sellers. We only sell options. We collect the premium, right? So buying is on the left, selling is on the right. Option buying, they pay the premium. They're kind of like the consumer of car insurance, and they pay the premium to the insurance company, right? When we sell options, we collect the premium. What do? We put that in our pocket right then and there. Right then, we can spend it. Option buying. Why do people buy options? Like, what's the intention of that? Like, what are they trying to get at? They think they can pick the direction, or they think that they know the direction where the stock is going to go. But they also have to be correct on the timing. Not only do they have to be right at, okay, I think Apple's going to go up this, right now, but they also have to be correct on the time. I think Apple's going to go up, exponentially over the next 7 days, and for that, if they're right, they can 10x their investment. What do I mean by that? 10x. They can buy an option, let's say, for $100, and they can make $1,000. And they can, and some people do that, like especially if you're right about it. Like I don't know, let's say, sometimes things jump up significantly, right? Like Intel, I hadn't traded Intel for a while, and then it was kind of low, and then I looked at it the other day and I was like, whoo, went kind of like up, shot up. So it gives someone an advantage of, they think or they like a stock, but they don't, maybe they don't have a lot of money, but they think that they know where that stock is going to go, and they want to put in a very small amount and make a very big amount. It's kind of like buying, honestly, it's kind of like buying a lottery ticket or a scratch ticket. I hope none of you guys in my audience here are buyers of lotto tickets or scratch tickets. I'm not judging you. And if you are, it's all good, but maybe you might think about it after this presentation. Listen, you could win the lotto. I don't know. Like, you could buy is a ticket still $1? I don't know. I'm not sure. You could put up $1 and then hit a jackpot and win, I don't know, $20 million. But the likelihood of that is very, very low. Options is the same way. In fact, most options expire worthless. So if most options expire worthless, what that means is, okay, all the people that buy options every Friday when the market closes, their options aren't worth any money. So they invested, let's say, $100. They were trying to like 10x their money, make 1,000, but they lost their $100, right? That's typically what happens. And when you hear people talk about options, sometimes people will say goofy things, and I don't think they mean any ill will by it. They just don't know any better. Like, how many times I've heard option trading? Oh my gosh, that's so stupid. Like, that you can lose all your money. But there's different ways. Like, are you buying options or are you selling options, right? So that's option buying. Option selling, conversely, we are option sellers. We collect the premium. We're going to use sound reasoning and logic. We're not going to be gamblers, right? Option buyers are gamblers. We are not option, we are not gamblers. We are not option buyers. We're kind of like the insurance company. We can also make money regardless of where the market goes. And I can't stress this enough. This is so important. I say that a lot, but these are really important things to like really understand. The market goes like this, right? If you only make money when it goes like this, what about all those other times? So option selling, you can make money regardless of market direction. Now, I want to kind of explain a little bit more specifically option buyers. Option buyers, they want to make a killing. They want to put up a small investment. They're gamblers. It's like the casino. right? So people, slot machines, and hopefully none of my audience are slot machine players either, because that is the absolute worst game for somebody to play at the casino. Like because listen, those machines have like you open you open the inside of the machine and it's set to like a percentage. It's going to pay out X%. It's going to pay this. It's going to pay that. The likelihood of, like, I think I saw online recently, like the likelihood of hitting a jackpot in a casino is like 1 in 100,000 or something ridiculous like that. I don't want to do that. I want to make money all the time. The the casino, so you have the player of a slot machine, right? Then you have the casino, right? So what do they want to do? They want to take in more money than what they pay out in winnings, right? And the more money that flows through that casino, the more money that they make. And that's just how statistics works. Now, statistics, oh my gosh, I can't even say it right. Statistics is not this big, hard, confusing word to understand. It's just like, what's the likelihood? What's the approximation? How likely am I to walk into a casino and hit a jackpot? How likely am I to buy an option on Apple for $100 and turn that 100 into 1,000? That's what statistics is. Insurance companies use statistics all the time. I mean, how do you think that they calculate the premium that you pay for your car insurance? Listen, guys, here's the way car insurance works. And it sounds, at the beginning, it sounds like, oh my gosh, statistics. I remember taking statistics in college and that was so freaking hard. I want to get that word out of my head. No, this is like the easy way to understand statistics. It's just the statistical likelihood something's going to happen. So when you have car insurance, right? When you pay for car insurance, they look at a few things. Where do you live? I mean, like, for example, you live in like New York City, do you live in Los Angeles, or do you live in like Wichita, Kansas? I think that might be a small town, but I might be wrong because I'm not great at geography. My point is, if you live in a big city, there's probably more of a chance for you to smack up your car, or maybe somebody steals it, that kind of thing. So they might charge you a little bit more. If you're 16 years old and you just got your driver's license, are you going to pay the same as if you're 50 and you've been driving for 30 years? No, you're going to pay more because you're not as experienced and there's a higher likelihood you're going to have an accident. So what the insurance company does is they kind of like try to calculate using different numbers how likely you are, and then they charge you the appropriate premium. And then what their intention is, they want to take in, right, a little bit more in premium than what they're paying out in claims. So that's their intention. They obviously, the insurance company can't charge you like, okay, they're going to charge everybody like $8,000 a year for insurance, no matter what, or because they want to make it affordable or attractive, right? Because there's different insurance companies, so they can't charge you too much. They try to take in a little bit more than what they pay out in claims. Does that make sense? So yeah, our focus, we don't want to be the guy that walks into the casino that pulls that slot machine. It's luck. Like, you might, a broken watch is right twice a day, right? This is the same thing. You might walk in and hit a jackpot, but the likelihood is very, very small. What we want to do is we want to, like, it's like baseball. We want to hit singles. We want to hit singles. We want to make small incremental gains. So going back to us and how we want to make money in the market. So think of it as we're a baseball player and we don't really care about a home run. We just want to make incremental gains every single week. It's kind of like just stepping on the stairs. I just want to make X dollars this week. I want to make X dollars in premium next week. I want to make X dollars the following week. Make sense? Let's see. Let's talk a little bit about what stock to trade, because a lot of people, as we talk about like options and the stock market, that's kind of like the first step that people say, like, where do I start? Where do I go first? It doesn't have to be that hard, guys. Like, listen, there is a such thing that's called analysis paralysis. That means like studying too much, looking at things and trying to be perfect. There's no perfection in option trading. It's like you can be wrong and you can be kind of sloppy a lot and still make a very, very good amount of money. but you just want to start somewhere. So I'm going to give you guys some ideas on well, how do I think of a stock? Just start small. Start with something that's less expensive, maybe. So when we talk about trading options, obviously there's always going to be risk. And I didn't say this at the beginning of the slide, but I'm going to say it now because I do want everybody to understand this. There is always going to be risk in the stock market, right? I mean, if there was no risk, I mean, you know what no risk is? I don't know. There's nothing no risk. Like not even putting money under your mattress is really no risk. You just want to understand like what is the risk, evaluate what the risk is, and then is that a risk that I'm willing to take? How do I mitigate that risk? So at the beginning, it's always good to kind of like start small. Start with a very inexpensive company. I'm going to give you guys some good ideas as we go. Also start with something familiar. Like I don't know, when I started more on the stock side, I think like Apple was always, haven't traded Apple in a really long time, but Apple at the beginning, or a long time ago rather, was always kind of like my go-to, right? Like, because, I'm a big Apple believer. I have a MacBook, I have an iPad, I have an iPhone. You start with something that's familiar. You can also, I want to give you guys so much information, not too much because I don't want you to be confused, but I want to give you so much actionable information. And I want you guys to say, man, I can really see myself doing this. You can, if you want, just trade what other big people are trading, right? And what do I mean by that? I made a video on this, I think it was yesterday on YouTube. I hope you guys are all subscribed to my YouTube station. I've been putting up a video every day for like, I don't know, I think it's been like a couple months now. And I think it's just, I hit 1,000 subscribers yesterday. Now it's a little bit more. But yeah, anyway, I put up a video about trading what other big people are trading. So I don't know if you guys know this, maybe you know it if you saw my video yesterday, but big traders in the world, like billionaires, like, I don't know, Bill Gates, Warren Buffett, George Soros, all these like powerhouse type people, when they buy or sell stock, they have to disclose what they're buying and what they're selling, no matter how many shares, even if it's like one share, not that they typically trade one share. But if they're an insider, if they're a controlling shareholder of any public company, they have to disclose it to the SEC. What's the SEC? That's the Securities and Exchange Commission. That's like the entity that regulates all these like banks and broker dealers and stocks and that kind of thing. They have to disclose their trade within 2 business days. So what does that mean? That means that you could do one of 2 things, actually. You can literally just copy them, or you can like, let's say if Warren Buffett is a good example of this. Let's say he's got like a lot of like Walmart stock or something, and you have Walmart stock as well, let's say, as an example. And then you see on the SEC page that he just sold, $8 million worth of his stock. Well, I mean, do you think that he knows what he's doing? Because he's Warren Buffett. He probably knows what he's doing, right? So you might want to get out of your stock as well. So it's very helpful to kind of see that. So it's all public information. So I'm going to click here, open link, and we're not going to spend a lot of time, but I kind of want to show you a little bit. So it just brings you up to the SEC page, and I'm just going to look at like Apple as an example. AAPL. You guys can all see my page, yeah? Apple. And then it brings you up to this page, and there's a whole bunch of things. Okay, well, things can be as hard as you make it or as easy as you make it. I'm going to tell you exactly where to go. You're just going to click on filings here, ownership disclosures, and these sorts of forms. It's just called the Form 4. It just means like this is the form that big people, billionaires and such, have to file when they buy or sell stock. So this tells you Deidre O'Brien, who is the senior vice president of Apple, on 8/8, and then this gets posted online within 2 business days. Sold, right? Disposed of, sold. Shares, 34,821 shares. How much did she get per share? This amount here. How many shares does she still have after she owns the stock? I don't want to get too much in the weeds, but I just wanted to kind of let you guys know that this is all public information. See, Wall Street doesn't tell people that, like they have to display it because it's like rules and regulations and that kind of thing, but they don't actually tell people like, man, you can be empowered to trade your own account. And you don't have to make 10% per year, 12%. You can make 50%, 100%. It might sound like unbelievable, but it's not unbelievable. I'm telling you. So let's get back on track. All right, let me go back to my, oops, sorry about that. Where's my presentation? Oh, I put a note here. I did, for a long time, I had some apps. A couple of years ago, I had some programmers that were working for me to push this information electronically. If you haven't already, be sure to join my inner circle. It's free. It's just basically an email list that I'm collecting. And I'm going to be pushing out like, hey, this trading tool is ready. If you're interested, that trading tool is ready if you're interested. Because instead of searching this stuff manually, I've had it in the past, and I'm going to change the platform a little bit in case you're interested in that. Paper trading. So personally, I'm not really a big believer in paper trading, although a lot of people are big believers in that. I mean, I don't know. Here's the thing, guys. I'm not a guru. Sometimes I think I call myself a guru, but I'm really not. I have been doing this a really long time, and I do 100% exclusively make my living off of options trading, and I make a pretty good living as well. So, and I'm not saying that to brag or impress upon you. I'm just saying, like, I don't know everything. So maybe somebody might have a different thought that's equally or even better than my thought. My thought about paper trading is kind of like you're just using practice money. It's kind of like playing Monopoly or something like that. It's not real money. Really, you don't really feel the trade unless you're using real money. So that's why I don't really like it. I think it's better just to start with a small trade, like super small, something that's not going to really get you hurt at all. And I'm going to give you different ideas as we go. Now, I'm not a financial advisor. I'm not giving you specific investment advice. I mean, honestly, like, people aren't allowed to give specific investment advices anyway, unless they're like registered or something like that. I'm just kind of giving you all the information that I have to try to help you make the most educated, decisions. Now, when you think about what stock to trade, here's my friend Warren Buffett here. Ask yourself this. This is what he says. He's a super smart investor, right? Would I mind owning this stock for the next 10 years? What I mean by that, and this actually has to do with someone's question here that said something about which stocks have options. You really want to try to, I would encourage you to stay away from like the meme kind of stocks, right? Like a while ago, I mean, you guys remember the GameStop kind of like GameStop sort of event that happened over the course of a period of time. So it was like a meme stock. It's like not a great company, but it's like it was being pumped up, or it was being, manipulated by the market. You really want to be a little bit more kind of like, would I mind owning, like, if I'm trading Apple, would I mind owning 100 shares of Apple if I had to for the next 10 years? No, I wouldn't, because I don't think Apple's ever going to go out of business. I think they're, a powerhouse type company, and I think overall it's very safe. Would I mind buying it at this particular price? So when you sell an option, you want to ask yourself, if Apple is, $100 per share, and you're selling a $90 put, you're committing to buy 100 shares at $90. If the price goes down, would I mind buying it at $90? Here's the thing why a lot of people lose money. They put a trade on, and they don't actually like go through those questions in their mind. They freak out when the stock goes down, and then they sell, and they lock in a loss. So you want to kind of like ask yourself certain questions ahead of time. How would I feel about owning this particular stock over the next 1 year, 5 years, 10 years, right? Don't get stuck on the price, guys. Listen, highs go higher, lows go lower, and volatility gives us opportunity to make a lot of money often. And the reason I say that is this. I've been talking a lot I mean, not a super lot, but a fair amount on about crypto. And I'm going to talk a little bit about crypto as we go. Actually, I think it might be the next couple slides. I'm a big believer in crypto. I mean, just fundamentally the way, cryptocurrency works and blockchain in general and the advancements and the technology behind it is good. But sometimes my point is this. I don't know where's Bitcoin these days? I think it's like 100 and something. Let's see. 112,000. So I remember I started trading Bitcoin. Oh my gosh, I forget when that was. 2017, I think it might have been. And I remember it was like hit 10,000, then it dropped and everybody freaked out. Now it's 100,000. I'm telling you, it might be a million soon. What my point is this: highs go higher, lows go lower. It's 112 grand. That doesn't mean that you missed the boat. That's what I mean by that. I put some slides up. Intel, I just kind of like put these up here because I want to remind myself too. I want to give you guys some good ideas about trading and stocks that are kind of not that expensive. Intel is only less than 25 bucks a share. I'm going to go over some examples because I want to give you guys actionable steps. I don't want to just talk about stuff like listen, knowledge is power. People say knowledge is power. Knowledge is power. Knowledge is power, but knowledge without execution or without action is just like nothing, right? So I want to give you guys stuff that you take action. Intel, recently, I didn't know about this. The US government recently bought 10% of Intel. It has something to do with some, I don't know, some news thing. Again, I don't spend a lot of time like doing stuff like that. I spend, I don't know, I just try to make things simple and I don't have this analysis paralysis and try to find every little thing about a company, but I just put up some little tidbits. Bitmine, actually Bitmine, somebody on my YouTube channel told me about Bitmine not long ago, and I hadn't heard of it before. It's like the Ether way, Ethereum, right? So you guys probably have heard of Ethereum. It's a way that you can invest in Ethereum, but using options in the stock market. And then, of course, MicroStrategy, that's like my all-time favorite. Michael Saylor, uber smart. It's so funny. MicroStrategy, they just changed their name to Strategy recently. But the company, they used to be just like this tech company. And it was like, they were public, but it was like this nobody company. But when Michael Saylor started buying Bitcoin, and he wasn't just buying Bitcoin and holding that, in MicroStrategy, but he was actually borrowing money, buying Bitcoin and leveraging it. So, people say like, don't borrow money to invest. I mean, he's a very good example on why that, might not be great advice. Like it might be very sound advice and a good strategy to borrow money and invest. I'm not telling you to do that. I'm just saying Michael Saylor is super, super smart. MicroStrategy, I put some, and again, I hope I'm not being pompous or anything. I enjoy what I do, and I also like sharing these things, and I want to show people like you can do exactly what I'm doing. This was, I printed this, it's like a screenshot from my my trading account. Last year, how much I made in MicroStrategy. So different companies, the reason why I have two on here, different broker dealers, they kind of display their information different. So last year in MicroStrategy stock, just the stock, I made 184,000, just that one stock. It's fucking, so here's my point. My point is people think Bitcoin, oh my gosh, it's too late to invest. No, it's not too late. It's never too late. Highs go higher. That's my point. And the bottom screen with Schwab, you can export data into a spreadsheet. And so this was like, I sorted it and then I had to kind of manipulate it to add up. Well, I don't want to just know how much I made with MicroStrategy, but also with options. So with options, 246K, that's dope. That's like my all-time favorite. But I don't want you to think that you need like a ton of money to make a ton of money. These strategies I'm telling you work if you have a small account, mid-size account, big account. Also, I want to talk about like what's a small account? Small account is I would say like how much money do you need to trade options? I think comfortably like 5K. If you open an account with 5K, you could do it with a little bit less, let's say $2,000. but 5K is like a comfortable level. So we're going to look at the chart. So now that said, there's not a lot of stuff that you have to learn to be really good at selling options. Not a lot of stuff at all, but you do kind of have to have some basic concept, some general knowledge on like what's a chart look like. So this is a chart. This is MicroStrategy. It's my favorite stock, and this is a 1-year chart. So there's a couple things that you want to notice here. Now, me personally, I use bars. There's a couple different ways. I think it's in my next slide here. Bars are like this right here, which is the way I structure my charts. And then these are candlesticks. It's just like how the data is being presented to you. But basically, each of those little lines, so this just kind of shows you, well, what did MicroStrategy do over the last year? And each little line represents 1 day in the market, right? And they're different colors. A green line just represents that the stock went up that day, and a red line represents that the stock went down. But basically, you just want to visually kind of see like, okay, well, what do the stocks do? You know, they go up, they go down, they kind of stay sideways, and that sort of thing. I want to kind of get through a few important things. Here's what you need, guys. So today's kind of like this intro day, and then we're going to really jump into puts, calls, how do you sell them? Let's walk through some trades, that kind of thing. But ahead of time, I want you to know what's important to have and what you don't need. You don't need to be you don't need to be have a PhD in math. You don't. You don't need to be even really good at math, right? You don't need a crystal ball to predict the market. You don't need a ton of money. You don't need to be trading all the time. You don't need some insider info. Here's what you need. You need risk management. That's super important. Especially, I'm going to talk about this more as we go, and specifically in day 5. But if you are using margin, it's super important that you understand how margin works. If you're not using margin, you don't have to worry that much about that. What do I mean by that? I'm going to give you an example. Let's say you have, and I don't know, everybody's in their own scenarios, and I'm not sure what position you guys are in, how much you have to trade, that kind of thing. But let's just say you have $10,000 in an account that you want to start trading with. If you're not using margin, that means that you can, let's say, sell a put, and the strike price is $100 because you're committing to buy 100 shares at $100 per share, and that's $10,000. And then that's how much cash you have in your account, and you don't have to worry about anything, right? You don't have to really understand or really get in the nitty-gritty of margin because you're not using margin. But it's important to understand risk management. So we're going to talk about that mostly toward the end. At the beginning, we're going to talk about all the fundamentals. You have to be patient. This is about consistency also. It's about just like hitting those little singles on an ongoing basis and just making cash incrementally. You have to have a basic understanding of probability. We're going to talk more about that as well. When we look at a trade, we're going to look at what's the likelihood it's going to go from here to here between now and the expiration date. Also, it's important to have a community. I think, listen, I am a big fan of, number one, aligning yourself with people that are similar to you, right? Like you got the same kind of, interests and that kind of thing. I'm a big believer. For so long, I worked with a coach, right? Like a life coach, you might say. And some people think that's goofy. Oh my gosh, I worked with her for like 5 years. We just sort of took a break recently, just because I think it's more like on a time level. I just am focused. But the purpose of having a coach, and I'm not pitching myself here, by the way, I'm just saying like it's important to align yourself with other like-minded people, because it helps you, it helps you progress. It helps you understand things. I'm in the process of building this new community. Some of you on this call, I know we had some issues on Discord recently. So I used to have this like community on Facebook for a while, then I was with Mighty Networks. Now I've had Discord, and then there was somebody like pretending to be me and messaging people on Discord, and then also we had some spammers in there. I'm building on my website a community. I'm not done yet, because I'm doing it. When I say I'm building it myself. I'm programming it. I'm not a programmer, but now I am. I'm becoming a programmer. When you want something done and you can't find the way, you make the way, and that's what I'm doing now. Hit this link. It's free. and then I'll let you know once that's done. But I think that's super important to have a community to ask questions to or to bounce ideas off of. Hey, did this happen to you? Here's the kind of week I had. Let's talk about that. I want to create that. So that's something that you need. Mistakes, I want to go over kind of like, what to do, what not to do, right? Because you don't want to, again, it's easy to make money. It's not as easy not to lose it. One of the biggest mistakes people make is they trade too much. Diversification is like one of the biggest farces in investing. I'm going to say that again. I'm going to make a video on that for YouTube. People talk like spew diversification, having all your lots of eggs in different baskets. And it is true that you shouldn't have, let's say, one thing, right? Like I don't only trade MicroStrategy because I don't know, like what if the company did go bankrupt? I don't think it would. I think it's very, very unlikely. And there's other reasons why you don't want to trade one thing, but you definitely don't want to trade too many things because then it becomes like you can't handle it all. You can't pay attention to what might be going on. Let's say that you might want to know about, and it's not manageable. Like things that are easy and easy to replicate are things that are simple, right? So we keep it simple. You have to understand margin. If you're using margin and you're not understanding margin, you will blow up your account at one point. It's almost like a mathematical certainty. I've blown up lots of accounts before, but now, for a long time now, I calculate, okay, if I have, A, B, C, D, 4 stocks in my portfolio, I want to see, okay, if this stock goes down 20% and this stock goes down 10% and this stock goes down 30%, is my account going to like blow up? What do I mean by that? Like what I mean is this, and this is more like as we go a few days in. When we use margin, we're borrowing the bank's money, right? To make these trades. So what happens is as the stock price goes down, our account value is shrinking, and it's shrinking faster than the calculated margin to hold that position. And I know that sounds confusing. What that means ultimately, I guess in layman's terms, is if it's the amount of cushion that you have in your account. Like if I'm using like all the money I have and all the bank's money, and then if the market goes down a little bit, I don't have that much cushion, and then I might have to break a trade. They call that a margin call, right? So a margin call is when you have to either put money in or you have to like liquidate something. So really the name of the game is mitigating that. Like it's easy to make money, it's harder not to lose it. If you're using margin, you have to understand that. So that is one of the biggest mistakes that people make. Also, people try to predict where something is going to go. Dude, I don't have a crystal ball. I don't know. Also, when people like think about like the fundamentals, oh, the iPhone like 18 is coming out next week. I think now's a good time to buy Apple stock because this new iPhone. Listen, the price of a stock is already being reflected by all the news in the market right now. So there's nothing that you can know or can find out. There's no like insider thing that any of you or me is gonna be able to find out. That's gonna be able to like say that this is a good time to buy because it's gonna go up. So don't really look at that. Also, you don't want to be disappointed about not making enough money. I want to say this. This happens a lot with covered calls, which we haven't talked much about. But I'm gonna give you a tidbit now. When we own stock, let's say I buy 100 shares of Apple and I buy it for $100, and then I want to sell a covered call against it. What I'm doing is I'm just committing to sell my shares at a higher price. Let's say I want to sell a $105 call. I'm committing to sell my shares at 105 if the price goes to 105 or higher, right? If it doesn't go to 105 or higher, I keep my shares. Either way, I keep the premium, right? But what happens is this. First of all, that trade is so like low risk, no risk, actually. What happens though, I see people sometimes, let's say Apple goes to $200 per share. Sometimes people will be like, man, I should have kept it. I could have made this. I should have made this if I blah, 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 blah. Man, don't be talking like that. just don't be talking like that. just be happy with that $100, couple $100. Those dollars will take care of themselves. If you're like, again, you're a baseball player, you're hitting singles and you're just making $100 here, $100 there, a couple $100 there. Don't ever be disappointed by not making more money on a trade. And then last but not least, absolutely do not freak out when your stock goes down. Oh my gosh, I was teaching somebody recently, a friend of mine actually. And so this was a friend of mine who had mutual funds, right? He had all these stupid mutual funds. And I'm like, why do you have all? He was talking about he wanted to do this financially, right? Like he had these goals that he wanted to do: buy a new car, buy a house, blah, 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 whatever. But he didn't make enough money. So he's got a regular job. He doesn't make enough money. And I was like, dude, just like move the type of account that you have. So he was investing in these stupid mutual funds, seeing his stupid number on a paper go up. Who cares? Like, you can't spend that. Like, if you want to buy a house or you want to buy a car, let's create some income. And you could do that. So anyway, I was looking at his mutual funds for him last year. And I think he had, I don't know, he had like one fund that had like a lot of NVIDIA in it, right? So NVIDIA. And I was like, you own NVIDIA already in these funds. Why don't you just trade options on it? So I taught him. And then, he bought 100 shares, sold the call, sold the put. He never really understood it because he didn't here's why he failed. He didn't commit. You have to believe in yourself and you have to like take the time to learn and then take the time to practice afterward. Like it's not like effortlessly. It's not effortless. You do have to put a little bit of energy in. Anyway, long story short, he did what I suggested that he do. He was trading NVIDIA. NVIDIA like dropped down, I don't know, like the few months back or something like that. He freaked out. He sold all his shares. He, I'm laughing because it's funny because he didn't listen to me. He locked in his gain, or his loss rather. So he sold all his shares at a loss. He lost a bunch of money. Where's NVIDIA now? NVIDIA's higher. He just had to wait. So don't freak out and sell your stuff at a loss. Like that's, listen, putting stop losses, I'm going to talk about this in a couple days. The Wall Street makes you think, or it encourages you to think that you should put stop losses in. Okay, I bought 100 shares at here and I don't want to lose all my money, so I want to like sell it if it goes down. Don't do that. There's a better way. I'm going to talk about it as we go. Let's see. Two things that you have to pay attention to, or I would encourage you to pay attention to. Number one, this is something that a lot of people miss, right? Number one, when is the next earnings per share on that particular stock? What do I mean by that? Stocks will have quarterly earnings per share that they report to their shareholders. And basically what that is that that's the company and the people that run the company are sharing their information about that company with the public. How much money did we make this quarter? How much profit did we make? What kind of problems do we have? What are our expectations moving forward? That kind of thing. Now, that's typically done on a quarterly basis. And what's important to you with regard to that is that right before earnings comes out, like let's say it's going to be next Tuesday, the market will be pretty volatile or can often be pretty volatile Friday, Monday, Tuesday, Wednesday. So you want to be aware of when the next earnings per share is. So for example, let's say I want to put a trade in, we're learning this week, and then Monday I want to put a trade in on Intel. I'm just giving you an example. I want to look to see first when the next earnings per share is to be reported is. I don't know why I wrote per share. Earnings reported. That was my bad. When's the next earnings being reported? If it's, let's say, Tuesday, Wednesday, I'm not going to put a trade on Monday. I'm going to wait. So that's something that you want to keep in mind. You can, after you get some more experience and you get the hang of things, you can use earnings to like boost the return or make even more money. I don't typically, sometimes I do a little bit of that, depending on what I have going on. Most of the time these days, I do very easy, like not a lot of work kind of stuff. 15, 20 minutes worth of stuff. And then I'm spending all my day doing some other like programming these days. But if you have a lot of time and you want to kind of like, maybe make a little bit more money, you can use that to your advantage because you can trade and use the volatility. We're going to talk more about that as the week goes. But that's something that you want to be aware of. And then the second thing that you want to be aware of is buys and sells from big players. And what I mean by that is this. Let's say you're starting to trade and you're trading Tesla. You want to be aware if, let's say, Elon Musk goes and sells like, half his shares of Tesla, because when big players buy or sell shares, it kind of moves the market a bit. Actually, that's what kind of moves the market is, big buys in a stock brings that stock price up, and significant sells will push that stock price down. A few years ago, I did a video. I'll have to find that. I think it might be on YouTube, although I'm not certain. If it's not, I'm going to put it on YouTube soon. I did it on like insider trading, a video. And it was about Jeffrey Sprecher, which is like the guy who runs, I don't know if he still runs, but at the time he ran the New York Stock Exchange. And so he like sold, like, again, like insiders have to disclose it to the SEC, right? So within 2 days of making the trade, which is a pretty quick turnaround time, he sold tons and tons of the stock that he was like the director of. Like, he was running this company, and he sold oodles of his stock. His wife sold a bunch of that stock. Some friends, I think, at the golf course sold a bunch of that stock, that kind of thing. It made the news. It was all like, I don't watch the news, but it was a very newsworthy event because it was like an insider trading thing. He never got arrested or went to jail or anything. But my point is this: if you're trading a stock, it's a good idea every so often to know if there's big sells on that stock, because if there is, that might be something that you might want to adjust your strategy with, right? Is this helpful for you guys? Can you guys see yourself doing what I'm talking about here? I know day one is always kind of like, sort of like that, I don't know, like a fire hose kind of day, like lots and lots of information. And if you didn't have a lot of like experience or knowledge about like stocks or options, it can be overwhelming. I highly, highly, highly encourage you, take a deep breath. It will get easier as we go along. This is kind of like a lot of the fundamental stuff, and then as we go, it's going to start to like click. I'm telling you. Yeah. Time, I want to say time is, when we think about time and option buying and option selling, this is super, super, super important. Time is our best friend as an option seller. All things being equal, as time goes on, the value of that contract is going to go down. What do I mean by that? That means that I don't have to determine where I think the stock is going to go. And the stock can go in lots of different ways, and I can still make money, even if I'm wrong, right? Because let's say I sell a put. I'm going to use Apple. Apple's not $100 per share, but I'm just using an example. Apple's $100. I sell a $90 put, right? I'm committing to buy Apple if it drops to $90. If it doesn't drop to 90, I don't buy the shares. But either way, I keep the premium that I got paid, right? I keep that no matter what. Now, let's say the stock kind of chops around. It's $100 now, goes down to 95, goes up to 100, it goes down, it goes up, it goes down, it goes down. As time goes on, the value of that option is going down, right? And that means that's good for me, because I want the value to go down, because I got paid like whatever that was, $100, $200, and then as the price comes down, even if the price goes into like my strike price, let's say $90, depending on the time frame and how the market's moved, I could still, let's say, make money and buy my option back, and still make a profit on that. So in other words, what I'm trying to say is, and I don't want to get too much in the weeds, and tomorrow and Wednesday, as we talk more specifically about options contracts, selling puts, how they look, what does it look like, and selling calls is going to make a little bit more sense. But what I want to impress upon you now is that you can be wrong, and you can sell, like, let's say, a put on $90, a $90 put on something, and have the price go down, and you still don't lose money. Like it's like one of the only things that you could be wrong other than being a weatherman, right? So if you're a weatherman, you could be wrong about the weather all the time and you could still make money. And that's kind of normal with weathermen. But other than that, like options is like the only time that you can like be wrong a whole bunch of times and still make money. Hey guys, Michelle here. I'm just gonna pause the video for a quick moment and remind you to subscribe to my channel if you haven't already done that. This channel is all about options trading, helping people just like you, selling puts, selling covered calls, walking through different tickers. The link is below. Thanks again. All this content, really, we're gonna have two things that we're gonna talk about: selling a put and making money, and selling a covered call and making money. That's it. We're going to go over all those details all throughout the week. And cool. So we're going to get started. I like to be prompt. Welcome to day 2 of our Lunch and Learn. So yesterday we had our rock star day to start off. We kind of went through some information, some basics, kind of how stocks work, how options work, that sort of thing. Today, we're going to really dive deep into option trading. Don't worry if you don't have any experience. And I'm going to break it down very, very easy for you guys in a lot of different examples. So just like we had yesterday, keep it very interactive. My goal, like I mentioned yesterday, is I really want you guys to learn the content that you're here to learn. I want you to understand and to be able to see yourself doing exactly what I'm doing: selling a put, selling a call, collecting income from week to week, and living an amazing lifestyle in the process. So that is really my intention. So let's start with day 2. So today we're going to really dive deep into selling a put. But remember what we talked about yesterday. There are only 2 strategies that you need to know. Now listen, guys, trading and selling options, it can be as hard as you make it or as easy as you make it. Oftentimes I hear stories about people, they look at charts, they do this all day, they do that, they subscribe to all these different expensive things, and you really don't need to do that, especially at the beginning. You can have a small account, not have any experience, and just start off with like baby steps. So really, those are the things that I'm going to focus on this week, right? So 2 strategies that you need to know. Number 1 is selling a put. Number 2 is selling a covered call. So today we're really going to dive in on selling a put. Let's get started. What is selling a put? We kind of touched on this a bit yesterday, but today we're going to go in a lot more detail. Basically, selling a put is this: you are agreeing to buy 100 shares of a certain stock. That's called the underlying. Remember, we talked about that yesterday. And you're agreeing to buy those shares at a specific price. That's called the strike price. We touched on that yesterday. And then the third part of that is that you're agreeing to buy those shares at that specific price before a specific date. So that's going to be the expiration date. So really those are the 3 main pieces of selling an option in general: the underlying, what stock you're trading; the price, the strike price, how much you're going to buy those shares for if you get assigned, if the price drops down, right? And then there's a time frame. It's not some unlimited time frame. The stock has to go down to your strike price before the expiration date for you to have to buy those shares. So those are the 3 pieces that we're going to talk about starting off: the underlying, the strike price, the expiration date, right? So for that commitment, you are paid money, right? You're paid what's called a premium. Very similar, we talked yesterday about car insurance. I have a car, I pay the car insurance company a premium, right? They are committing to fix my car if I smash it. It's that simple. And the contract lasts for a certain date. Now, what happens when I have car insurance for 6 months, and let's say my car insurance expired yesterday, but I didn't renew it. I didn't pay the premium again, so I didn't renew the policy. It expired yesterday. Today I'm driving and I have an accident. Do they pay? No, because the term is over. This is the same thing, right? You're agreeing to buy a certain stock at a certain price before a certain date. You're paid a premium. Now, keep in mind, you keep that premium no matter what happens. That's one of the things that oftentimes, especially new traders, they get a little bit confused about. It doesn't matter what happens to the stock. The stock can go up, The stock can go down. The stock can stay right where it is. The stock can even go bankrupt. It doesn't matter. You keep the premium no matter what happens. When do you get paid the premium? You get paid the premium when you make the trade. So when you commit, right then when you input the trade to buy those shares at that price before a certain date, if it reaches that price, you're paid money. It goes in your account. You keep that no matter what. So that's something that you want to keep in mind. Now, I think we touched on this yesterday, but we're going to talk a little bit about it today, especially for all the new people out there. You can be a buyer or you can be a seller, right? So there's always going to be two people, two different people on each side of this particular transaction. The person that's buying the put, the person that's selling the put. We, as a reminder, are always going to be the people that are selling the put. The buyer, they pay the premium, right? And the reason why they're doing that is they want to make money if the price goes down. Now, I said they can make money if the price goes down on this slide because it's not like a static equation. So, and I don't want to get too much in the weeds here, but I do want to impress upon you this. If somebody buys a put and they want the price to go down because that's what a put buyer does, right? They want the stock price to go down. Even if the price goes down, that doesn't necessarily mean that they make money because time is the other part. As time goes on, time is like eroding the price of that premium. So that's to our advantage. Now, I don't want to confuse you guys. I just wanted to kind of throw that in there. We're going to talk more about that as we go this week. But basically, they're paying the premium and they want to make money if the price goes down. The most that they can lose when you're an option buyer is the price that they paid for the premium. So that one of the advantages of somebody buying an option is they don't have unlimited risk. So that is one of the advantages. However, it's still not a good not a good strategy. So like I said, we're always going to be option sellers. Most options, like I mentioned yesterday, expire worthless. That's good for us because that means that we got paid the premium. The option expires worthless. There's no more risk after the expiration date. We're going to talk more about that as we go on today. The option seller, that's going to be us, right? We keep the premium. We keep it no matter what happens. For that premium, we are making a commitment to buy a stock at a certain price before a certain date. Now, you also can get out of a trade at any time. And I put this on the slide early, and we're going to talk about this throughout the day, probably later in today's session. But I want you guys to understand that when you make a trade, you're not stuck in that trade. Here's the thing. Everything is super flexible. You can make a trade now. You can get out in a minute. You can get out in an hour. You can get out tomorrow, the next day, anytime before the expiration date. I'm going to talk more about how that works. But I wanted to make sure that you guys knew that you have some flexibility to do that. It's not, you're not stuck in stone to be able to keep that trade open until that expires, right? Let's see. Option sellers. So again, you choose three things. You're choosing the stock price, the price you want to pay for it, and the time frame. It is very, very easy. I think as we move on, it's going to start clicking. There's not a lot of like pieces to what we're doing. It's just like a handful of things here and there. And as you practice, it will start to click and make more sense and become automatic for you. Let's see. When you choose this strategy, when you use this strategy, rather, when do we want to sell a put? That's a great question, right? Really, there's two times when we want to sell a put. If you want to buy a stock anyway, so most people are on this session. Typically, they're on, my trainings that I do because they want to trade options. But sometimes people just want to straight up buy stock. Like, hey, I really like Apple, and I don't have any Apple stock, and I don't have any stock in general, and I want to buy some stock. So you can use this strategy to be able to buy stock. Like, here's the thing, guys. Like, why would anybody want to pay sticker price for anything ever if you have the ability to pay at a discount? If it's the same thing, right? So, like, I think I mentioned this yesterday. I go to buy a car and I see the MSRP sticker on the window. I don't want to pay MSRP. I want to talk to the sales guy and I want to get a better deal. If I go to the mall And shopping, I mean, retail stores don't typically, bargain with you, but let's say I go to some, flea market kind of place and I see some things that I like, I want to bargain with them and I want to pay a lower price, because why would anybody want to pay a higher price? It's just not logical. So if you're in a position where you kind of want to buy some stock anyway, you can use this strategy. The second thing that's probably more applicable to us is when we want to create weekly income. So here's the thing. You can do this on a small scale, mid scale, big scale. It's whatever you make it be. Part of that has to do with, how big your account is when you start and how much, confidence that you have and that sort of thing. I encourage you when you're new to get your feet wet, learn how to, walk before you run rather. But the strategy that we're using selling puts is to create weekly income. You can also create income in a different way because the expiration date, and we're going to talk more about that today. But you don't have to. I say weekly income a lot because that's really what my focus is. But you don't have to sell a contract that expires this Friday or next Friday. You can choose a contract that expires like a month from now. Now, when might somebody want to do that? Here's a great example. Let's say somebody has, a bunch of money in a savings account, right? And they're getting, I don't know, a few pennies of interest, whatever. And let's say it's a significant amount. Now, I'm a big believer that everybody should have savings. That's important, like a rainy day kind of fund. However, sometimes people, keep too much money in there and you're losing income that you could be making somewhere else. And this is kind of what I'm talking about. Let's say if you have a savings account somewhere else, you can shift part of that into a brokerage account, use the strategies that we're talking about here, and create income for yourself on an ongoing basis. That can be significantly higher than, some saving. I don't know what savings rates are. I think they're, I don't really pay attention to that because it's such a small, percentage. But that's another way that you can use this strategy. So selling a put, really, it comes down to this. All this stuff, honestly, I think by Friday, many of you might be like, man, this is a lot easier than I thought it was going to be. Because really, it's not that hard. Selling a put is what? You're buying a stock that you like anyway, and you're buying it on sale. So that's the worst thing that can happen. That's your commitment, right? You're buying something that you want, that you like anyway. You're buying at a cheaper price than what it's selling for today. And yeah, that's like worst case scenario, right? So let's go through the three things that we always want to look at and decide as we're selling a put. One is the stock price. What stock are we going to trade, right? Is it going to be, ABC, XYZ, Disney, Tesla, General Electric, whatever? The strike price. How much are we going to commit to pay for those shares, right? That's important. And then the third thing is the expiration date. How long are we comfortable for maintaining this contract? Again, I talk a lot in my trainings and my videos that I do online on YouTube and such. I talk mostly about short term. I'm a big believer on short term for a couple reasons. Number one, I don't know what the market's going to do tomorrow. And oftentimes there's a lot of volatility. Something big can happen. Trump can say something big on the news. Elon Musk can say something big on the news. There could be some crisis in another country, and that could significantly, affect the market in a very quick fashion, right? So I want to kind of like be in fast, get paid, and then exit. Be in fast, get paid, and exit. It's kind of like a rinse and repeat process, right? Number one. Number two, oftentimes I talk about short-term trades because I live off my income. So this might not be you. This, you might have your 9 to 5 job, or you have your own business, or maybe you're retired and you want to do this as, let's say, some supplemental income, some cash flow, side gig, right? You might say. But me, because I live off of my income, I'm doing it every single week because I have commitments that I need to take care of financially on a week-to-week basis. So that's why I use weekly contracts. The stock you're choosing the strike price, and you're choosing the expiration date. Let's see. So the stock, what are you okay buying if you had to hold it for a long time? Are you okay with that? So we talked yesterday, like Warren Buffett says. Now Warren Buffett, he's like the cornerstone of investing. Everybody knows who Warren Buffett is, right? And he says like when he buys stock, he plans on holding it for like 50 years. Now that doesn't really, he does sell stuff, so he says some things and then he does some other things. But by and large, the point he's making is valid. What kind of stock are you going to buy? And are you comfortable holding that for a long time? And what I mean by that is this. Sometimes we can get, especially after you start trading, you can get kind of like wrapped up in like excitement. Oh my gosh, I'm telling you, you heard it here first. If this happens, you're going to be thinking at that time. Michelle talked about that on one of her sessions. You start making some money, you you start telling your friends about it, they start talking about different stocks, and you start kind of kind of veering off the track a little bit, right? GameStop is a great example from that. Like how many people started trading GameStop when all that stuff was in the news, I don't know, a couple years ago. But you want to recognize, like, you don't want to trade some crappy stock like that you wouldn't be comfortable maybe a couple years from now because it's not that great. You don't want to just look at the dollars that you make on it. You want to have you want to have a comfort level of being like, I traded a put on this stock, and that's a great stock. It's a solid company. It's been around 100 years, 50 years, whatever. It's one of the biggest in the industry, that kind of thing. So keep that in mind for the stock. Now, what are some examples? I just put a handful of examples. I'm not recommending anything in particular, but especially when you're new, I always recommend a big company because listen, you want to like have as little amount of risk as possible. Like it's not about just making money. No, it's not about that. It's about like making money, being sustainable and having as little risk as possible. So it's kind of like all those pieces. It's kind of like a dance, right? Like it's kind of like all these different things. I don't want to just sell a put on, oh my gosh, I'm going to sell a put on Meta because it's, a great stock, but it's $700 a share. Like I want to kind of like think about that when I'm new. Maybe I want to stick to for sure like some lower price stocks. I think Intel is great. Intel is like one of those stocks like you can never get hurt in, honestly. It's only 25 bucks a share. Long term, it's a great stock. If the price goes down, it's okay. It's going to go back up again at some point in the future, most likely. So those are just some examples, right? The second thing, what did we talk about? We talked about price, right? That's a strike price. How much do you want to pay for those shares? Now, what you want to keep in mind is this. When you're selling a put, let's say I'm selling an Apple put and it's $120 right now per share and I'm selling $100 put, right? I want to recognize that, you know what that means is I'm committing to buy 100 shares at $100, right? Sometimes what happens, oftentimes, we let our emotions get in the way. The market starts like, let's say dropping, something happens, it starts dropping, then we start freaking out and we say, oh my gosh, I really don't want to buy that stock at $100. Well, you want to like kind of have that thought with yourself before you make the trade. Listen, you want to eliminate emotion as much as possible. Most of the people lose money in the market because they get emotional. They freak out. They get euphoric when prices are high. They get excited. Oh, I want to buy because everybody else is buying. They see what everybody else is doing. They kind of like want to jump on that train. And then when something goes down, they freak out and they sell their shares. Don't do that. I said this yesterday. I'm going to say it again. Some of these things I'm going to say multiple times because it's just important. And I want to like hammer it into your head. You only lose money if you sell your shares for less than what you paid. If you don't do that, like you don't lose money. It is, I heard somebody else say this a long time ago. I forget who it was. I think, I think it might have been, maybe it was Ray Dalio or something. Some big investor said, maybe it was Warren Buffett. I don't know. But somebody said, the easiest way to make money is when you're small. So sometimes people will think, and sometimes people say this to me now, like, okay, like, you've been doing this for all this time, or you got a bigger account than I have, or whatever. Of course you make money, and of course it's going to be easier for you. No, that's not true. It's probably easier to make money when you have when you're starting off, when you have a, not starting off with like no experience, I don't mean it that way, but when you have a smaller account, that's probably the easiest way that you can make money. And the only time you're going to lose money is if you sell something for less than what you paid. So you're not going to do that. Now here's the rule, right? So when we talk about like how much are we paying for how much what strike price are we going to sell this put option for? How much do we want to buy that stock for? Here's what it means. The closer the price is, the strike price to where it's trading now, the more we're going to get paid, right? So let me go back to my example. Apple's $120 per share and I sell a $100 put. It's kind of far away, so maybe I won't get that much money. But if I sold, let's say, a $110 put, I would get paid more money. Why? Because it's closer to where it is, and it's more likely that it's going to stay in that range when it expires. So it's kind of like a logical thing, right? Some of these things, they might seem confusing at the beginning, but then when you think about it, that kind of makes sense. And then let's talk about the conversely the other way. The further away the price is to where it's trading now, the less you're going to get paid for the option. And let me give you an example. So Apple's $120 per share. Let's say I want to sell a $50 put. I don't want to pay $100. I don't want to pay 90. I want to pay $50. That's so far from $120. You're probably not going to get that much money if there's even like a buyer out there to make that trade, right? So that's something to keep in mind. What was the third part? So there was the stock, there was the strike price, and there's the expiration date. So what's the expiration date? How long do I want to commit for? Now remember, what I'm doing is I'm committing to buy the stock if and only if it drops below the certain price. And I wanna take a moment and a few moments and really make sure that you guys understand what that means, right? Let me take a sip of water. What that means is this. When I sell a put, what I'm doing is I'm committing to buy this stock, the stock that I pick at the strike price, the price that I pick, if and only if the price drops below the strike price before the expiration date. So an example is this. Apple's $120. I sell a $100 put. It expires next Friday. The stock has to close below $100 for me to have to buy those shares. Now, as I said a few moments ago, it could chop around. It's really up to whatever that particular option buyer, if they assign it. So once it drops below, you have to be prepared. Oftentimes, I would say 90%, more than 90%. I think all that I don't even know how many trades I've put in my life, thousands, tens of thousands, hundreds of thousands, I don't know, a lot. And I would say probably I was assigned early, typically only when it went down a lot. So let's say in my example, I sell $100, Apple put. Let's say it went down to 70 and then it got assigned, right? I don't think I've ever been assigned at like 98, 99, 97 early. It just doesn't happen. I mean, not to say it can't happen, because it can. So you have to be prepared to buy those shares anytime before the expiration date, but usually it's on the expiration date. If it expires below the strike price, if the price closes below the strike price, you'll see your shares pop in your account on Monday. So that's something that you want to be aware of. When we talk about expiration date, how long do we want to commit for? So a few moments ago, I talked about that, when are expirations for options? They're every Friday. I mean, not all of them, the big stocks are. So what we're talking about are the big stocks, this Friday, next Friday, the following Friday. Sometimes in the past, and it depends on the market cycle, right? So right now, overall, the market is pretty high, like super high. Now, let's say, I don't know, I'll use 2008 as an example, because that's like a really good example, like with a credit crisis. When everything crashes, that can be a really good time to commit for longer periods, if you have cash and if it fits into, what your intentions are. And the reason I say that is because the best time to sell puts is when the market is down, because everybody else is freaking out, the price is more expensive, we're going to get paid more. I think it might have been Warren Buffett, maybe, or maybe some other big traders. Lots of probably big traders did this. When everybody is freaking out, they're selling puts because they're capitalizing on that. Listen, it's kind of like the tide. The tide, think of the tide in the ocean. The tide rises, all boats rise. What that means is the stock market's going up, everybody makes money. It's super, super easy to make money. But when the market goes down, that's when, if you're smart, if you got good strategies in place, if you have good discipline and you're not emotional, that's when you can make a lot more money. I don't want to say a fortune, but you can make a lot more. So the market goes up, it's super easy. Everybody kind of makes money. The market goes down, you can make more. So let's say we enter a super bear market. Bear market just means that prices are really, really low. That could be a good time to sell longer term options, because the longer you go out, the more money you're going to make. Actually, I think that's the next slide. The longer time you commit for, the higher your premium. And the reason is because you're committing for a longer period of time. So it's just like a logical thing. And the converse is true as well. The shorter time frame you commit for, the less that you're going to get paid. So if I'm selling an Apple $100 put that expires this Friday, I'm going to get paid a little bit less than if I was to sell an Apple $100 put that expires next Friday or the Friday after that. So those are things to keep in mind. Okay, so moving along, let's see. Let's go through a live demonstration. I mentioned I wanted to do this. Somebody asked yesterday about looking at some stuff live. So let's look at some stuff, right? I want to clean this stuff up. Let's look at Amazon. So let's see, hang on a second. The first thing I look at anytime I think about, and don't get confused. I don't want you to look at this screen and say, oh my gosh, what is all this crap on the screen? No, don't think like that. I do want to mention that depending on who you're trading with, your screen might look a little different. And also, even if you're trading at the same company, your screen might look a little different, because all these screens are customizable. You can add some stuff, you can take some stuff out, you can, make it look a different way. This is the way I have my screen look, and it works for me. I usually don't have all these stocks on the left here, but I was putting together these slides and I was just kind of looking at some different things that I thought might be interesting to talk about. So so usually my stuff looks a little neater, but when I look at selling a put, at first what I do is I look at the chart, right? And I just kind of want to get a sense of where the stock has been. Now, this particular chart is a 1-year chart. So usually I'll look at, this is Amazon. I'm not trading Amazon. I have traded Amazon, but not for a while. But I thought it would be an interesting one to look at. This is a 1-year chart. So me personally, I use bars. So I think, I don't know if we went through that yesterday, or if maybe that's upcoming, I can't recall. But basically, you can look at bars on your chart, or you can look at candlesticks. So bars are kind of I don't know, that's the way I learned a long time ago, old school. Most people look at candles. I'm just the opposite. I look at bars. But you can look at either. It gives you the same information. But basically, a bar, each one of these lines it represents 1 day in the market. You'll see, I think you can, it's kind of small, and I'm always wearing glasses, but you can see you see the notch on the left and the notch on the right of each of these ticks. What that represents is the notch on the left is where it opened at, the notch on the right is where it closed at. The top part of the bar is just the high for the day, and the bottom part of the bar is just the low for the day. It might look confusing, but it's one of those things, like we said yesterday. It's I just moved to New York and I go to Whole Foods and I don't know where anything's at, because I'm trying to get used to things. This is the same thing. Once you get used to it, it's easy. But as an example, I'm going to look at the chart for 1 year. I can change the date, by the way, if I go here. So typically, I'm only ever looking at 1 year, 1 day, and 1 day, 1 minute. So that's kind of it. So this is like a 1 day, 1 minute. You'll see the gray shaded here. That was yesterday, and then this black is today. Actually, the gray shaded is the overnight. and you can customize this. Some people don't look at the overnight. I look at the overnight. So this is kind of like when the US was sleeping, other countries were trading Amazon, and where did it go? Oftentimes when we look at an overnight data, it doesn't trade as much. So you'll see kind of like choppy, choppy lines because it's not as active. The US is much more active in US stocks. So that's what I kind of look at. One minute, and 1 year, 1 day. And then I just kind of get a sense of that. And then if we look at, let's look at selling a put. So let's look at the trade section, right? So this is kind of like if I close this, this is our what's called our option chain, right? So it's always called the same thing. And here's all of our dates, right? So let's say I want to look at this Friday. Today's the 26th of August. And I want to look at the 29th. Amazon is right now, it's last trade right here, or over here, we can see it as well, $238.11. And let's say I want to sell a $200, put as an example for this Friday. What we're going to look at, we're going to talk another time about bid and ask, but right now we're going to look at just the last price. So that's kind of like, where did it last trade? That we can also say like, what's the current price? It's the same thing. 0.03. What does that mean? You might remember from yesterday, hopefully, that we're always multiplying times 100 because there's 100 shares in a contract. So 0.03 is $3, right? And that means that it's not much money. So that means we would not make that trade. I'm just kind of like walking through some different scenarios on what you look at and how you look at things. That means that we would get paid $3 for committing to buy 100 shares of Amazon at $200 per share. Now, why is the price so cheap? The price is cheap because there's not much likelihood Amazon's going to go to 200 between now and Friday. And the reason I know that is because I look at this is like a cheat sheet thing. It's kind of like, I use Delta all the time. There's some other traders, friends of mine, actually one really good friend of mine who never used to use Delta. And we used to like kind of bicker a little bit about what Delta means. Delta has this kind of like technical explanation that it's like the rate of change, blah, 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 which it is. However, it's also sort of like the cheat sheet way of how likely is something going to go from where it is now to the strike price between now and the expiration date. It's a statistical likelihood. So where does that number come from? It comes from, it's like mathematics. It's coming from the broker dealer that I use right now. So this is Schwab as an example, but it's also provided by, Interactive Brokers, E-Trade, whoever it is that you're trading with. So they're saying that there is a 1%. See, if I go down, Delta's here, puts are here, by the way. Remember, calls are on the left. So we're just talking about puts right now. I'm going to go down the strike price right here, down the line, 200. I'm going to scooch over, and it's 0.03 for the price. It's who cares about the negative? Ignore the negative, but the number itself is 0.01. That means it has a 1% likelihood that Amazon is going to go from 228 to 200. Today's Tuesday before Friday, right? So it's not very likely. And because it's not very likely, the price is not that low, not that high, right? So that's what I'm talking about. Now let's look at something else. Let's look at the price is 227. Let's look at a 225 put as an example. So the 225 put is going to be more expensive. Why? Because it's more likely that it's going to land at that price before the expiration date. So 225, we're going to go down the line, the strike line, 225 puts are over here to your right. And we're going to scooch over. Where did that last trade? 99.99, which means $99, right? And you see how this flips all the time. Now it's 101. That's because this is live data. So anytime you trade, you're going to automatically make sure what you're looking at is live data. I was like teaching somebody not long ago, and I don't remember exactly what happened, but I didn't even realize, they didn't realize, I don't know, they weren't looking at live data. It's free. First of all, you don't have to pay for it. And there's no reason in the world that you would not opt into live data. There might be like a form you have to sign electronically with your brokerage, but make sure you have that and you're not looking at delayed stuff. Now it's 103. See, that's flipping all the time. What's the delta on this? Well, this was 0.29, right? So there's a little bit more likelihood that it's going to drop down to 225. So you see kind of like what that correlation is. Right now the price is 227 and change, almost 228. The 225 put is more expensive than obviously a $200 put because it's closer to where it's trading. I'm going to use SPY as an example because SPY, let's see, August 29th, SPY is something that for some reason, I always encounter people that trade SPY. And I want to show you, SPY is an ETF. It's the S&P 500 exchange traded funds, right? And people will think that it's not as risky because it's a whole bunch of stuff in there, right? I think they're just brainwashed from like Wall Street, like telling them that diversification is good and, you know, buy this thing. Like we talked about yesterday, I don't know how much, let's see how SPY, you guys can see my screen, right? SPY AUM. I'm going to see how AUM is assets under management. I'm going to see how much assets under management SPY has. 650, wait, I don't even know what that number is. That's a bigger number than I can comprehend. 651, but it's million. So I think does that mean, I don't know what that means. Wait, what is 625 million? That number is too big. I guess, I don't know. I don't want to spend a lot of time. My point that I was making on this, oh gosh, where did I go? The point that I was trying to make was this. People talk about SPY and they're brainwashed because Wall Street wants you to trade SPY because they are making oodles of money. The number is so big that what they're making, I can't even comprehend it. But let's walk through an example. SPY right now is $643 per share. So let's break this down easily. First of all, what does that mean? That means that if we sell a put on SPY, let's say a 600 and let's see, and you could change. I like to look at all the strikes, but let's just look at some of them, and that way we have less stuff on the page, right? Right now, SPY is $643 per share. Let's say I want to sell a $640 put, right? 640. Now, what do? We go down the middle, strike price. We go off to the right because puts are on the right. And that last traded at 2.18. That's $218. Now, before you say, Michelle, $218, that's a lot of money. And that's more than what we're talking about for Amazon. Yes, correct. However, let's look at the whole picture here, right? It last traded at 643. If I sell a 640 put, I am committing to buy 100 shares at $640 per share. Let me pull up a calculator. Let's see. Applications, calculator. Okay, I could do that in my head, but I'm going to show you how easy it is in case you can't do it in your head, right? 640 times 100. That is $64,000. Okay, now I'm committing to buy 100 shares at $640 per share. That's $64,000, and I'm making 188 bucks. Now let's bring it one step further. Let's look at the delta on this. What is the statistical likelihood that SPY is going to drop from 643 to 640 between now and Friday? It's 34%. Now that's not that low. I mean, it's not super high, but it's also not that low. Why would I want to make that trade? Let's also, I'm gonna give you guys some more info. This is how I check. Now you can check a few different ways, but the easy way to check, since I'm looking at this page, is how much, if I don't use if I use margin, how much money do I have to put up? Now, if I don't use margin, I have to have 64K or 60K rather. Or what am I looking at? 64K, sorry. 64,000 in my bank account, in my brokerage account to make this trade. But if I use margin, I'm going to click on the bid, and I don't want to bore you with getting the weeds too much, but I want to see like how much is the margin on this. Okay, so I have to have $9,600. This is the margin requirement, 9,600 to make that trade. Let me back up, and I want to say this a couple times because I want to make sure that you guys understand, right? SPY is 643 a share. I'm going to sell a 640 put, right? I'm going to get paid $184, right? If I don't use margin, I need to have $64,000 in my account to make that trade. Why 64,000? Because 640 times 100 is 64,000. I get paid $187. There's a 34% statistical likelihood that I might have to buy those shares. If I'm using a margin account, which I use margin personally, if I'm using a margin account, I have to have 9,600 bucks in my account to make that trade. Now I use calculators that I'm going to release to the public soon, but I'm going to show you how easy it is to give you like a rough idea to calculate that. Is this a good trade or is this a shitty trade? I already know the answer, but I'm gonna illustrate it to you, right? I'm gonna make $187, right? We see it, right? 1.87 in the last column here. I'm gonna make $187 and oops. And I'm committing right here $9,600. That's my margin. 9623 to be precise. 9623. Okay, if I make that trade and it expires worthless, I'm making 1.9%. That's not like terrible based on the margin amount that you need. Really 64,000. Let's break this down a little further. If 100% of the money is 64,000, but my brokerage account broker is telling me I only need less than 10,000, that means that he's giving me a lot of margin, right? Like he's saying, man, you can make this trade. You don't really have enough money. Let's say if your account's smaller, but you can make this trade anyway. They set this is like the scamminess. I'm gonna include some of the sliminess in Wall Street. First of all, different broker dealers have different requirements for stocks, right? Number one. And number two, a different broker dealer will have a different requirement for SPY versus MicroStrategy versus Apple versus whatever. And really the idea behind that is they're kind of evaluating what's the likelihood that, you're going to have to buy those shares, right? The reason they give you some margin is because right now SPY is here. And if you're selling a put here, it's probably not going to happen because there's only a 34% likelihood. But if it does, that's kind of like included in how they determine how much money you need. In my opinion, and this isn't like written down somewhere, but the reason why you get a lot of margin ability for SPY, like, if I needed all the cash at 64 grand, but the bank will float me the money and I only have to put up less than 10 grand. It's because they want you to trade SPY. They want, like, it's $1 trillion ETF. And remember, they make shit tons of money off of that. Anyway, going back to my example, you're making, let's say, almost 2%. So 2% per is not that bad. Let's say you hold it for a week times 52, right? I know it's not a full week because it's like 4 days, but I'm just going to give you an idea, an approximation, right? So you're making like 101% on your money if you calculate it using your margin requirement. For certain things, I encourage you not to calculate it using your margin requirement because it can be like a fictitious thing. If the margin starts to drop, so here's what happened, and somebody asked a question earlier. This is a really good session. This is for those of you that have a little bit of options kind of like experience, this is going to be amazing content. Where was my train of thought? So for your margin is less than 10,000. However, really like there's a little bit more risk to that because it's pretty close. I mean, $643 right now is where it's at. And if I sell a 640 put, let's calculate that based on the money that I need to put up if it came down. Because here's what happens. If I put that trade in and my margin is $9,000 right now and SPY drops, and let's say something big happens. I don't know, there's some war with, China or whatever, I don't know, something big happens and SPY drops to 600, my margin is going to go from 9,000 to 39,000 like this. And somebody asked a question a moment ago, like, is the broker dealer going to call you? No, they're going to just break your trade and they're just going to like make you lose money. So that's why some of these chips are stacked against you. You don't want to make these mistakes. Let's calculate if I had to use all the money, right? So let's I think it was $187, 187 divided by, let's say if I had to put up all the money, 64,000, right? Oops, 64,000. Let's see what that rate of return is. That's 0.002 times 52 weeks a year to get our annualized rate of return. Now we're only making 15%. So now we're making 100%. Now we're making 15%. You know, it's a big difference. Don't trade SPY. Let's look at something else. Let's look at Intel because I talk about Intel with young, new traders. Let's look at the chart. This is like a 1-year chart. This, by the way, I'm going to give you some tidbits. You see, when we look at a chart, somebody asked like about technical analysis and what I use. I don't use any indicators ever. Sometimes in the past, I've used some moving averages. I haven't lately. I look at certain things like gaps. Like, see, look at this day right here where it dropped, and then the next morning it opened like way lower, right? That, when we see that in a chart, it's called a gap, GAP. That means that it closed here, right? And then it opened the next day much lower. How did that happen? That happens because when the US goes to sleep, other countries are trading. And so when other countries are trading, it drops significantly. Something must have happened in the news, I don't know, whatever, to cause that. Now, the reason why gaps can be helpful, and might be a little bit more information than what you guys are here for, because I know that some of you are beginners, you want to learn the basics, but this is kind of good to have as well, just some extra information. Gaps will typically fill. What that means is if I'm looking at these dates here, like this was, I can see the date up here, like right here is your date. I think you guys see my mouse hovering. So this is like August, right? Early August, 8.5, 8.6. So really, like if there's a gap in the chart and then the price is trading much lower, if I want to trade Intel at that time, it's a pretty good trade because it's probably going to go up, gaps will fill, and you see that's exactly what happened. Gap, like the price started going up, and then now it's kind of like went even higher. But let's go back to our example. Intel is $24.28 per share, right? And let's say we want to sell a $24 put, right? So I'm going to look at August 29th. I'm going to look at a $24 put. And where did it trade right now? 40. Or let's even go a little bit cheaper. Let's go do a 23.50 put. Now, by the way, you guys might notice as we talk about this, when we look at the strikes in the middle, they're not always the same thing. In other words, when I look at an Intel chart, it's $21, $21.50, $22. But when I look at SPY, that we were looking at before, it was, 645, 644, 643. So it depends on what the particular stock is, the increments that the strike prices are. So that's something to keep in mind. Yep. So let's go back to Intel. It's 24.25 per share. Let's look at a 23.50 put. Right. So right now it's trading at $22. 0.22, which means that we're paid, we multiply that times 100. We're paid $22 to make that trade. What's the likelihood that it's going to reach 23.50 between now and the expiration date? 28%. So not that likely, but not super, super low. Let's see if that's a good trade. Let's just, I don't know. I wasn't planning on talking about calculators and calculating that stuff today. But let's just talk about it to kind of see what that looks like, right? So 23.50 is $22, right? $22. Let's see how much money we need to make that trade first. So if we have a Schwab account, you just click on the bid here. I right click and then I click analyze trade. And it's like an easy, quick way. I already had some stuff here, so that's what I'm deleting. Sometimes when you look at things, it'll save it until you delete that window. This is actually a really good teaching moment. 2350 put that expires Friday, August 29th. Right now, and this number is going to change. Remember, this is live data, so it's going to go up and down. Right now, it's 23 bucks. How much margin do I need? $450. So this is an example of you don't need a lot of money to trade. You just don't. I need to have $450 in my account to make this trade, right? I get paid 20, now it's $24. Let's see what that rate of return would be. $24 divided by 450 is 5%, 0.053. That's 5% for the week. Now, if I annualize this out times 52, and I know I'm just kind of using approximations here because today's Tuesday, it's not a full week. I'm just giving you an idea. I would encourage you, if you want like tools that will help you do that, join my inner circle. It's free, and when that tool is available to the public, I'll be sure to let you know. It's off the hook. It's amazing because I used to input into a spreadsheet like manually. Okay, here's my premium, here's the margin, blah blah blah. What's my rate of return? But the tools that I'm making as a feed, like API feed, that grabs that data and calculates it and fills it all automatically for you. Okay, 55% per week. Oops, sorry about that. Times 52, 277%. Yesterday, I think it was yesterday, I did a video. People think like if you tell people that you're making over 100% each and every year, people think you're full of shit. Like it's not possible. It is possible. I mean, you see what I'm talking about, right? So let's use not margin, but let's use like, okay, let's assume you don't want to use margin and you want to have all the cash in your account. If I sell a 2350 put, how much cash do I need if I'm not using margin? This is how easy it is to do yourself, guys. Do you see yourself doing this on a regular basis? Send me some love in the in the presentation. Make sure you're still paying attention and tell me if you see yourself doing this. 2350. Come on. Oh, there's some love. I see it. Thank you. 2350 times 100, right? Is $2,350. And let's go back to my price. Thank you for some love. I appreciate that. $23 for the week divided by 2350. If we're not using margin, what's our rate of return? It's a little bit less than 1%, right? Times 52. Here's what that means, guys. I'm going to break it down in plain English for you. Even if you're not using margin and you're putting up all the money to make this trade, as an example, Intel, I don't have the screen, the slide in front of me, but Intel is, I think they've been around like 60 years. I think the government just invested 10% into Intel for some, I don't even know a lot about the details, some public thing. They want to like encourage US chip makers or something like that. Long term, it's a good solid company. Might the price go down? Okay, maybe. I mean, the prices always go like this, but long term, is it likely to go bankrupt or go out of business? Probably not. And even if you don't use margin, if you have all the money, if you make a trade like this or similar to this on a weekly basis, you're making 50% on your money. Like anybody can do this. So I hope you can start seeing yourself be able to do this. Where's the risk? You may have to buy. So when we talk about, let me back up for a moment. When we talk about selling a put, where is the risk? We might have to buy that stock cheaper. Let me go back to my Apple example I was using before. Apple's 120 per share. Let's say we sell $100 put, and let's say something happens and Apple is now trading at 80 bucks, right? And Friday comes, and then we say, oh my gosh, I have a $100 put. Well, guess what? You're committing to buy Apple at 100 bucks, and Apple's at 80 bucks. So you might have to buy it cheaper than where it's trading now, right? I mean, that's just part of the game. It's not like a game that's like no risk. It's like low risk, evaluate the risk. Is that something that you have to do? There is a way to combat this. I'm going to talk about in a moment, but that's something to keep in mind. Now, also, I do want you to understand, in my scenario, Apple's 100 bucks. It drops to 80. Apple's 120. I sell a $100 put, it drops to $80. If and when I buy those shares, that will only be a paper loss unless I sell those shares. Now, I want you guys to really understand and listen to what I'm telling you. What that means is even if the price goes super low and I have to buy it at that higher price, it's only a paper loss until something happens. What does that mean? That means the price is going to go like this. Just wait till it goes back up. Wait till, like, if you're not living on it. So for me, this is why it's easier trading for small people, I think. For me, as an example, I'm living on my stuff, right? So like right now, for example, I have a bunch of Coinbase, and Coinbase dropped a lot. And I can't, it's hard for me to sell calls against it right now. I'm not talking about calls yet until tomorrow. But what I mean by that is it's a little bit harder for me because I'm like depending on generating more income. If you're starting off and this is like a side gig for you, and you're thinking like, oh my gosh, how cool would that be if I can make a couple $100 a week extra? Like how would that change my lifestyle if I can make an extra $1,000 a month? If that's you, if you're the person that fits that description, then who cares what the paper loss is? Because you're not depending on that money. You just wait until it goes back up. Also, here's what you can do. So worst case scenario, it goes super low. You buy it at a higher price. I just talked about this. Also, what you can do is you can average down your price. Now, let me spend a minute and talk about this, right? It is like one of the biggest, what's another word for farce? It's like one of the biggest misconceptions that you should use stop losses, right? And I've gone through different cycles, and sometimes I use stop losses, but by and large, I don't. Here's what a stop loss is, as an example. Let's say I buy Apple at 100, and then I say, okay, and you could do this. If this works for you, great. For me, it really doesn't work for me. What you do is you say to yourself, okay, I'm buying Apple at 100, but I don't want to lose all my money. So I want to have like a safety net. I want to put a safety net on that trade. And I want to only lose, let's say, I don't know, $30 per trade. I can put in an order to sell my shares if it goes down to 70. That way I don't ride it all the way down. I could, get out at 70. Here's the problem with that strategy. So many times, countless times, the price comes down and then it goes back up again. Because here's what happens. If you're trading a good stock, Apple, I don't know, Google, Amazon, like all these big companies, if you look at extended periods of time, what do? They go like this, but overall, they go up. So why would you want to take, okay, the price came down. I have a paper loss, which doesn't mean shit, right? You can wipe your ass with a fucking paper loss, right? It doesn't mean anything. Sorry. Oh, my language is going a little bit. It means nothing, right? Let me get back on track. It means nothing, but instead you're going to take that loss. When you take a loss and you sell your shares, now you recognize that loss. That actually is a loss that like comes out of your pocket. So there's a very big, you have to understand if you're trading, you really, really have to understand the distinction between a paper loss and a real loss, a paper gain and a real gain. So instead of recognizing that loss, you can do this. You could buy more shares and you average down your costs. Warren Buffett says this. I don't know why I keep talking about Warren Buffett because I don't even really follow him that much. But I know that a lot of people know him and he does say amazing things and he is a super smart and successful guy. He says if you like the stock at $100, it's still a great stock at 90. It's a great stock at 80. In fact, it becomes an even more attractive purchase as the price comes down. So when you average your stock down, what that means is you're just buying more shares cheaper. So this is an example. Let's say you have 100 shares of ABC, you paid $30, right? And this is your cost basis. Oh, I was missing a parentheses there. Okay. The stock goes down to $20, right? You paid 30, now it's 20. Don't freak out, right? You traded a good stock, you didn't trade some crappy stock. What you can do is you can buy another 100 shares at $20. Now your basis is 25. I'm going to show you how easy some of this stuff is to compute. You don't have to be a math whiz. You don't need, like, I use like a lot of spreadsheets and calculator tools, but you could just use this, right? So I paid $30 for shares, and then I bought some more shares at $20. And then I divided by 2, That means my new basis is $25 per share. Now you have 200 shares at an average $25 each. So it's like a way to, it's a very good trading strategy to use to average down your cost, right? I want to get through some of this. Let's see. The only way to lose money, like I said, is if you sell something for less than what you paid. Don't do that. At expiration, this is important. When your contract expires, one of two things is going to happen. The stock price will either be higher than your strike price, or it will be lower than your strike price, right? So what that means is, let's say I sell a $100 Apple put. When it expires on Friday, Apple's going to be more or less than $100, right? That's what that means. If the stock is higher than your strike price, that means your contract is going to expire worthless. There's no more risk on the table. It's called out of the money. That means that you already collected that money, right? And that's it. Next week, you look for another trade. If the stock is lower than your strike price, that means you're automatically going to be assigned the shares. Now, we talked about that a moment ago. If I sell a put on Apple, $100 put, and the price is $90, those stocks are going to show up in my account on Monday with $100 basis, right? That's called being in the money. The stock is in the money. Now, you could also, instead of waiting until expiration, I want to make sure that you guys understand that you can close your position early. I touched on it earlier in the presentation that you have a lot of flexibility. Like when you make a trade, you don't necessarily have to stay in that trade. What do I mean by that? That means that, like, if I'm selling a $100 put, let's say, I don't know, something happens in a couple days and I just change my mind. I don't know. I'm Aquarius, so I change my mind a lot. And let's say you want to change your mind and you don't want to, like, be on the hook to buy 100 shares at $100. You can close your position. You could, what that means is you buy it back. Most people get confused by that. I encourage you to just use, like, easy terms, liquidate. You can liquidate your position. The reason why you're buying it back is because when you sell a put, you're actually short a contract. I don't want to get too confusing and I don't want to lose anybody. So I just want to be easy. You liquidate your position at the market. That might be more or less than what you originally got paid for it. Here's what that means as an example. I didn't have any puts in my account. So I sold this NVIDIA put before this class started, like, I don't know, a couple hours ago, because I wanted to show you how it looks. This, I just did a screenshot from my account. And I screenshot each piece because I didn't want to, honestly, like, I don't put all my business everywhere. Like, this is a public thing, right? I don't even know who's listening. So I don't want to show you exactly everything that I have, but I just gave you, like, examples and to illustrate sort of what these things mean. So this is the trade that I made this morning. I sold a NVIDIA put. Let's look at a NVIDIA, right? For example. So NVIDIA right now, let's look at the chart first. So we always look at the chart, right? So here's where NVIDIA is. It's kind of like chopping around. And the price right now is 181.43, right? What did I do? I don't even remember. I sold a 165 put. Let's look at it. And I got paid. The cost per share is how much I got paid. So -1 because I sold the put. The cost per share I got paid $102. 1.02 means $102. Let's look at that. Let's see. So NVIDIA is 181 and change. And remember, I'm going to go down the middle of the aisle. Strikes. Off to the right is the puts. And what did I sell? I think it was a 165. Yeah, 165 put. It's right here. So here's what that means. So right now it's trading at 1.07, right? There's a 13% likelihood that it's gonna go down to 165 before Friday. So it might happen. If I wanted to buy back that position, because I just sold it just to give you an illustration. Oops, sorry. And I sold it for 102. I could buy it back right now, right? And the way I do that is I would just click on here. I would buy 165 put. Right now it's trading at $106, $107. What does that mean? That means I got paid 102. I bought it back for 107. I would lose $5. That's what that would mean. But here's the thing, guys. Like options are super flexible. It gives you the ability to change your mind and get out of positions. You don't have to hold it to the expiration date. I also had some examples here, like MicroStrategy. I have MicroStrategy, 200 shares at the moment. My average price is 433. Right now, MicroStrategy is a lot lower, so I bought those at much higher. 415 call that I sold, I think, a couple of days ago. Or maybe it was yesterday. No, Friday. I don't remember. Anyway, I got paid like $100 for it, $99. Not that much money because it's super far away from where it's trading, right? $415, and it's trading, lower. If let's see, this was this morning at $10, but let's see where that contract's trading right now. A 415 call. I know we're not talking about calls yet, but it illustrates the same idea. Let's see. So 415 call right now, last traded at $11. So here's what that means. That means that I sold the contract for $100. Right now it's worth $11. If I wanted to, I could buy it back and pay $11. How much money would I make? Let's take a look. I sold it for 99. I would buy it back for 11. So I still made $88, and then I close that position. I take that risk off the table. Maybe I wait until MicroStrategy pops up, and then I sell another call or something like that. So it's very, very flexible. If you get assigned the shares, right? So that's the other thing. So like if you wait until expiration and you get assigned the shares, you're going to buy those shares at the strike price. But I want you to be aware that your cost basis gets adjusted. Now, this might be a little confusing, and honestly, if you tune out a little bit, it's okay. This is like maybe something that it's important to know, but not uber important as far as, it doesn't help you, put the trade in or understand it. But I do want to let you know that if you sell a put and you have to buy those shares, your basis gets adjusted. Now let's talk about that. And I hope I don't lose anybody because of some math here. Let's say I sell an ABC put at $100. I take in $100, and then ABC stock closes at $47, and I have to buy the shares, right? They show up in my account on Monday, typically, with a price of 50, because that was the strike price, right? However, it depends on your brokerage firm. I use Schwab, and usually it happens on Tuesday with Schwab. On Tuesday, the new basis, which is the actual cost that you own the shares for, will become 49. And the reason for that is they adjust it by the premium that you got paid. So if I got paid $100 on the trade, that's like $1 per share because it's 100 shares. So my basis goes from 50 to 49. So it's a little bit more advanced, but I just wanted to kind of clarify that for anybody who might have been curious about that. Somebody was talking also about the wheel. Let me talk about the wheel for a moment. I find that term like cringy. I don't know why, but people talk about wheeling, right? What that means basically is that you sell a put and you're collecting premium, right? What is selling a put? You're committing to buy those shares at a particular price if it drops below that price before the strike price. Now, if it doesn't drop, you don't buy it. But let's say it does drop. The shares drop. I buy the shares. Now I have 100 shares of that particular stock. What do I do on Monday? Now, Monday, I sell a call against it. It's like, that's a really good strategy. So you're selling a put. You're keeping your money in cash initially. You're selling a put. You're committing to buy the shares if it goes down. If it doesn't go down, you don't buy them. If it does go down, you do buy them. What happens if you buy the shares? You bought stock that you like anyway at a price on sale. Like what's the problem with that? And then you sell a call against it on Monday. So that is a really good strategy. Let's see. I think just to wrap up kind of like what we talked about, it's kind of like hits all home. And like I personally just try to keep things simple. just do the same ones over and over and over again. But as you go, if you find something that works for you, like if you look into something, okay, well, I want to look into trading during earnings, right before earnings, or I want to look into what's overbought, what's oversold, and you get in a rhythm, that's fantastic. Keep your rhythm. Like, listen, my way is not the same way for everybody. To wrap up, kind of like, like just solidify kind of what we were talking about. What is a put? Because really, again, like I said earlier when we first started and yesterday, there's only two strategies. There's lots of different ways that you can trade. Spreads, a lot of people trade, credit spreads. But there's two main strategies that you need to know to be successful. Only two. You don't need any more. Selling a put and selling a covered call. Selling a put, what does that mean? That means that we are agreeing to buy 100 shares of this particular stock at this particular price if it drops below that price before the expiration date. For that agreement, we're paid a premium. We get paid the premium right away when we enter the trade, and we keep that premium no matter what happens, right? How does that sound? Does that make sense? At expiration, well, we did talk about this already. If the stock is higher than your strike price, you do not buy the shares, right? If the stock is lower than your strike price, you do buy the shares. They will show up automatically in your account, and either way, you keep the premium. So that's something that you want to keep in mind. Now, I know that sometimes, I know some of this might sound confusing, right? Puts and calls and delta and strike price and all this like different like terminology, that you're not familiar with. But the simple fact of the matter is this: all you need to do is practice. So the best way to practice initially, um, especially like maybe this is something good that you could do today. And as we go through the sessions, it might like click a little bit faster for you. Just open a trading account, open an account, and then you can open a paper trading account, right? So most big broker dealer firms have what's called paper trading, and it's like practice. So it's just it's not real money. It depends on, I don't know, it might like be $100,000 or $250,000 or whatever. But it's practice that you can kind of like, then you can kind of go like this. You can click around. Okay, well, I want to buy, let's say 100 shares of Meta, and let's see, I'm going to buy this, and I'm going to look and see how that works, and blah, blah, blah. And then you can, put a trade in today, and then you can follow those trades for a period of time, and you can kind of get a sense of how that works. Or you can open a regular account and you can just start small. I would say be very, very careful when you start. First of all, I want to make this clear. I know I said it before, but I can't say it enough sometimes because I don't want anybody to misunderstand. I'm not recommending any particular trade. I'm just kind of sharing what works for me. I truly 100% believe that Wall Street, like I'll just say Wall Street because I just termed them all, and I live in New York City. I just term them all Wall Street. Uh, puts people under a spell and makes people think that like, you need to depend on somebody to help you with investing. And the fact is this: nobody's going to ever treat your money better than you will. I guarantee you. These are strategies that I have not been using, for a short time. I've been using them for a long, long time. And I think they're strategies that work whether the market's going up, whether the market's going down. Now, that said, sometimes puts might be more advantageous in down markets, and calls, selling covered calls might be more advantageous in up markets. But as a general rule, like both of them are always applicable in all market cycles, in my view. But it's important to use the community for help. So like I truly believe that it's important to, sync with other like-minded people. Hey guys, you're probably about halfway through right now. Pat yourself on the back. Bravo. If you like the content, be sure to like the video, send it to a friend, and be sure to subscribe to this channel for more daily videos. Let's get back to it. Hey everybody. Welcome to day 3 of our Lunch and Learn. Hopefully you guys got a lot of great content yesterday. Thanks for coming yesterday. Thanks for checking in again today. We're going to go over some awesome things today. Covered calls. First, before we start covered calls, we're going to kind of recap yesterday. My intention, as always, is that you guys get tons and tons and tons of value out of this program. So yesterday, we talked a lot about selling a put. Basically, we spent the entire day about selling a put. And what does that mean? Basically, when we sell a put, we're taking in premium. For that taking in premium, we are committing to buy 100 shares of a particular stock at the strike price if the price drops below that price before the expiration date. Now, remember, if the stock does not go below your strike price, you don't have to buy the shares, but either way, you keep the premium. So you can use that as a strategy to not only create weekly income for yourself, but you can also, if you are interested in perhaps purchasing a stock instead of paying full price, sticker price on that stock, it's a way to actually buy it cheaper at a discount. Worst case scenario, you guys might recall from yesterday, worst case scenario, the stock goes down and you buy that stock on sale. Now, remember, you pick the stock, you pick the price you're going to pay, you pick the time commitment that you're going to be in that trade for. So you are in the driver's seat on all of these decisions, and you have the flexibility after you make the trade that you can get out early. Remember, we talked about that yesterday. Now, if your put gets assigned, don't worry, because you already thought about this ahead of time. You traded a stock that you wouldn't mind owning, and you chose the price. So don't freak out if your shares get assigned. The great part about that is that you get to sell a call against those shares on Monday. So that's kind of called the wheel strategy. So a lot of people talk about the wheel strategy on the internet, and basically that is just selling a put, taking in income. If and when the price goes down and you have to buy the shares, you turn right around and sell a call against those shares. And then you just rinse and repeat, rinse and repeat. It's a way to really compound your weekly income on an ongoing basis, right? Now let's talk today. Today, we're going to go over all about how to sell a call. What does that mean? Different strategies and how does that look? But basically, selling a call to start off with, you can sell a covered call or an uncovered call. Basically, when you're selling a call, you are committing to sell shares at a certain price. That's the strike price. If the price goes higher, right, before the expiration date. So it's very much like a put, but it's just the opposite. So you're agreeing to sell your shares if it goes over that strike price. Now, when I say that you can sell a call in two different ways, you can be covered or you can be uncovered or naked, right? Now, we are always really going to be talking about covered calls. So this entire presentation, I'm going to talk about covered calls. What does that mean? That means you already have the shares. So I have 100 shares of Apple, and I bought them at $100, and I'm going to sell a $105 call against them, right? If you sell an uncovered call or a naked share, the difference with that is that you don't have the shares. And that's a very aggressive strategy. Some people do that. I never do that. I probably have done it, a handful of times in the past, but it's very, very, very risky. Why is it risky? Because if I'm agreeing to sell shares, if it goes over a certain price and I don't have those shares, if I get assigned and the stock ends up over my strike price at expiration, I have to deliver those shares. Now, it doesn't mean that I can't do that, but basically what that does mean is that I have to go to the market and buy those shares. So typically I'm going to end up losing money. And really, like the ability for a stock to go up, it's really like infinite, right? So I want to sell a call on Apple, $105 call, but I don't have those shares. Let's say the price goes up, and really the price can actually go up to infinity, right? There's no ceiling as far as how high a price can go up. So let's say the price goes up to 120, 130, 140, or whatever that number is. If that contract expires and I have to deliver those shares, I have to go buy them in the marketplace. So I have to buy them at sticker, right? Like $140 or wherever the market is trading at that particular time. and then I'm selling them for $105. So it's very, very aggressive. So we're not going to talk too much about naked calls, because really the strategy that I use and the strategy that I love to share with other people is a strategy that's sustainable, consistent, sustainable, as low risk as possible. Now, there's always obviously going to be risk in the stock market, but really the trick is to identify what that risk is, understand it, and mitigate it. And yeah, so we want to make sure if we're selling a call that it's always going to be covered. Now, I do want to specify you don't have to have the shares for a particular time in order to sell a covered call, right? So what do I mean by that is this. You might already have shares of Apple as an example, and maybe you bought them last week, last month, 2 years ago or whatever. You can sell a call against those shares. You can also, let's say if you don't have any shares of Apple at the moment, you can go buy shares and sell a call right afterward. So there's no time frame in which that you have to hold that stock for. So that's something to keep in mind, right? Now, we talked a little bit about what does a covered call mean, but again, it's going to be basically the opposite of a put. So you already own the stock. You're agreeing to sell your shares at a specific price. So that's going to be called the strike price, if and when the stock price goes higher than the strike price. And that has to happen before the expiration date. Remember, guys, once the contract expires, it's over. It's kind of like car insurance. I have car insurance for my car and I pay a premium of $1,000 for 6 months. Let's say my car insurance comes up for renewal and I don't renew my policy. If I have a car accident the following day, the car insurance company is not going to pay my claim because the contract is not in force. This is the same thing. So the stock has to go higher than your strike price before the expiration date. Now, just like selling a put, like we talked about yesterday, anytime you agree to do something like this, you're agreeing to sell your shares at a certain price, you're paid a premium. And you get to keep that no matter what happens. So that's important. It doesn't matter if the stock goes up or the stock goes down or it expires worthless or you liquidate your trade. You keep the premium that you were originally paid on that contract. So that's really good to know. When you sell a call, you are always going to want to choose a strike price higher than your cost basis. Let me explain to you what that means. Now, basically, cost basis, that just means how much did you pay for the stock, right? It's a fancy term. Some of these terms might be new to you, but as you get moving along, I promise you that they will start to click and stick. So an example that I'd like to use is, let's say Apple. I bought Apple a month ago and I paid $100 per share for the Apple stock. If and when I want to sell a covered call against those shares, I always want to choose a strike price higher than what I paid for it. Now, what do you think the reason might be for that? It's very logical. What we're doing is we're committing to sell our shares if it goes higher than a certain price, and we never want to sell our shares for less than what you paid. Here's the name of the game, and this is the thing that many traders really, I don't know if they forget necessarily, but they don't really specifically adhere to. You don't want to sell something for less than what you paid. So if I bought Apple as an example and the price goes down and I still have Apple, it's okay because it's a paper loss. But once you sell that stock, you're actually recognizing and realizing that loss. So think of like paper gain, paper loss, realized gain, realized loss. Think of it as like cash in your pocket. When I take a realized gain, when I'm selling options and I'm taking in premium and that becomes a realized gain, it's like cash in my pocket. I can spend that however I want. Well, the same is true for the other side, right? If and when I was to take a realized loss on something, I have to take cash out of my pocket and I never get that back. So you want to really keep in mind to minimize ever taking a realized loss. Now, does that mean that never happens? No. I mean, sometimes things happen, a scenario might come up, but you want to minimize that as little as possible, right? Let's see. So I kind of went through an example already. I just hadn't flipped the page. If I own 100 shares of Apple and I bought them at $100, I want to sell a call at least $100, 100, maybe 105, maybe 110. We're going to talk as we go through today, like what sort of factors would help us determine how much we would want to sell our contract for. Now, just kind of like a put, I want to just make sure that you guys understand what is the difference between someone who buys an option and someone who sells an option. Now, remember, we are always sellers. We are never buying options, right? We are selling options because we want to be the casino. Remember our example yesterday, the casino does what? They take in all this money from people like playing slot machines, and their intention is they want to take in more money than what they pay out in jackpots. We are doing the same thing. So an option buyer, that's the guy who goes into the mini mart and buys a scratch ticket because they want to spend $1, $2, and they want to try to turn their $2 into $200 or $2,000. They're gamblers, right? They can make money if the price goes up, but most of them lose. And like we talked about yesterday, most options expire worthless. That's why we want to be option sellers, right? Also, keep in mind that you can get out of the trade at any time. So here's what I want you guys to understand. You do want to give a lot of thought into the factors and the elements before you place the trade, but it's very good to know that everything is always flexible. If you want to change your mind, you can do that. So keep that in mind. We're going to talk more about that as today goes on. So let's go back to selling a covered call. You own the 100 shares of stock. You're agreeing to sell your shares at a certain price, and you're getting paid a premium. Now, one of two things is going to happen. If the contract expires, the stock is either going to end up higher than the price or lower than the price. Either way, you get to keep the premium. So keep that in mind. That is, I know I said this before, but I reiterate it because for some reason, sometimes, especially when traders are new, they neglect to remember that you keep the premium. Once you make the trade, that premium goes into your pocket. So you don't ever have to give that back. Just like the car insurance analogy, right? I pay for car insurance for 5 years. I never have a car accident. The car insurance company never has to pay for a claim because I never smashed the car. They never give me back any of my premium. This is the same way, right? So as I said, for yesterday with puts, the same is true with calls. Now if selling a put started to click for you yesterday, then this is actually really going to be easier for you because puts and calls are very similar. Oftentimes they're just opposite, right? So a lot of these things are the same for put selling and call selling. So yesterday we had a similar slide. When we sell a covered call, we can either wait until the contract expires, right? And then one of two things is going to happen. It's either going to expire worthless, which means that the price is lower than our strike price, or it's going to get assigned, which means the price would end up higher than our strike price. But during the time that we hold our position, we also have the ability to buy back our position or liquidate our position. Now, that might be more or less than what you originally paid or received in income, rather. So you would do that at the market. And don't worry, we're going to go through a lot of examples as we move on today. What I want to talk about at the beginning is really just the foundation of selling a call, how that works, what it means. That way it starts to click for you. And then when you go over the examples, it will be that much easier for you to understand, right? So at expiration, I touched on this already. Same thing with a put. The stock is going to be in one place or another. It's going to be higher than your strike price, or it's going to be lower than your strike price. So very, very basic. If it's higher than your strike price, we're going to sell our shares. And if it's lower than our strike price, we get to keep our shares, and then we can sell another call Monday. The following week. I'm going to talk more about that as we go. Either way, as I mentioned already tons of times, you get to keep the premium that you collected, right? Now, if the stock is lower than the strike price, that's called out of the money. So we don't necessarily have to maybe remember these terms, but it is helpful as we get more experienced and as we kind of get our feet wet and start trading, that some of these terms start to become familiar to us. Out of the money just means it's lower than our strike price. It will expire worthless, right? That means that there's no more risk on the table. Next week, we choose another trade. If it's higher than the strike price, so let's say in my example, I have 100 shares of Apple and I sold a $105 call. Let's say Apple price ends at $110 on Friday. My shares will be called away, right? What that means is I'm automatically going to sell those shares. Now, you don't have to do anything different. It all happens automatically. Your shares get removed from your account, and the value of those shares get dropped into your account, right? This is called in the money, right? As I mentioned before, you can also liquidate your position prior to the expiration date of the contract. And that's very helpful because, we want to have flexibility. So when we sell an options contract, we have these ideas in mind and we think through all the different scenarios. However, we want to have some flexibility in case something comes up. Let's say, I don't know, something comes up in the overall economy that we didn't anticipate. Let's say we had to access some of the money that we hadn't anticipated. You do have the ability to liquidate your position and buy that back at the market, which might be more or less than what you originally sold your contract for. Now, I want to go through an example. Some of the examples, I'm going to share my screen again throughout the day, as well as the rest of the week. And I also have some screenshots of my account to really illustrate sort of how some of these processes work and what that means for you. So BMNR, this is just a screenshot of 100 shares of BMNR in my account. That's BitMine. It's kind of like an Ether, Ethereum type stock. It's fairly new. And actually, interestingly enough, someone had mentioned this. I had never heard of BMNR previously, and someone mentioned it not long ago on my YouTube channel. And I looked into it and I was like, oh, that's interesting because I'm a big Bitcoin believer. And so, Bitcoin, Ethereum, cryptocurrency, they represent really good opportunities because a couple of reasons. Number one, I don't want to get too off track about cryptocurrency, but I think this is relevant and I think you guys would find it interesting. Bitcoin has been going up, right? Like it's exponentially increased. The problem with buying Bitcoin, couple things, or Ethereum for that matter. Number one, you have a paper gain. So it's very much like stocks, right? So the price goes up. I buy Bitcoin today and then it shoots to the moon, but I can't actually spend any of that money or Ethereum or Ripple or whatever. I can't spend any of that unless I sell it. Well, guess what? What if I don't want to sell my Bitcoin because it's going to keep going up, I think? Then I can't ever spend the money that I'm making, and I just get to see it on my statement on the computer screen, kind of like toilet paper, right? As good as toilet paper, like we mentioned yesterday. And then the other part about Bitcoin, and I don't know who's familiar, who's not, it's a pain in the neck. Like, you have keys and online account or different types of ways that you hold it. It can be very challenging. If you lose the keys to your account, it's like losing your wallet, all your money's gone. But this is a much more safer way to capitalize on movements of cryptocurrency like Bitcoin or Ethereum in the stock market and create yourself income every single week. So going back to my example, BMNR. So I personally have 100 shares. I ended up buying these, and I'm going to tell you in a moment how I bought them about 2 weeks ago. And I paid the cost per share a little bit less than $57 is that's my cost basis, right? Now, Bitcoin or BMNR rather, this was as of, I think I put this slide in yesterday. So right now the market's open. It might be a little different, the price, but at the time I made this slide, the price of BMNR was $47.90, right? I also have a call against it underneath on the bottom line, but we're not going to talk about that yet. Right now, we're going to talk about having 100 shares I paid $57. I'm just going to round it off. I paid $57 and now it's worth $47. Oh my gosh. So what does that mean? That means I'm losing $900, right? The value is down $906. Now, how did I get to that that number? Let me just show you. You guys can all see my calculator on the screen, I think, right? Just send me a thumbs up if you can. So 56.96 is what I paid minus 47.90. That's $9.06, and then I have 100 shares. So that's how I got to that number. So again, you don't have to be a math whiz or anything like that. You can just use a calculator for lots of this stuff. So I'm down $900 on the stock right now, but guess what, guys? That is a paper loss. So this way, this is how I'm going to really illustrate the differences between paper loss, paper gain, realized loss, realized gain. It doesn't really matter to me. Am I freaking out and ready to jump off the bridge over there? No, I'm not. And let me show you why. So here is I kind of cut and pasted and then I just added some text on here. I kind of am trying to illustrate. I know it looks confusing, but I'm going to illustrate, kind of walk through all of this with you. I want to illustrate kind of the transactions that I've encountered in the last 2 weeks for this particular stock, right? For BitMine, I'm going to say. So on the 13th, which was about 2 weeks ago, I sold a put, a $59 put. The stock price at the time was higher, right? For that contract, I got paid $205. So what does that mean? That means I was committing. BitMine was higher at the time. I don't remember exactly what the price was, but let's say it was $65, whatever it was. I was selling a $59 put. What does that mean? That means I was committing to buy 100 shares if the price dropped below $59. Now, for that commitment, I was paid a premium in the amount of $205. That money got dropped into my account. I can spend it if I wanted to. I could do whatever I wanted with it. Now, a few days afterward, the price of BitMine dropped, and it dropped pretty significantly, actually. And what happened was it closed underneath my strike price of $59. So what does that mean? That means I was assigned those shares. So that means 100 shares of BitMine showed up in my account, and now I had 100 shares. Now, it was a $59 strike price. However, like we touched on yesterday, the price, your cost basis gets adjusted a little bit. So instead of owning the shares at $59, my price became adjusted to this number here, a little less than $57. Now, I don't want to get too much in the weeds. And if I start to lose any of you guys, it's totally okay. Some of these things, like it might be, okay, that's nice to know. And I'm giving you sort of like an idea about it. And then you'll revisit it at a certain time. So it's most important to understand conceptually how that works. But just to kind of walk through the mathematics of it, if I bought 100 shares at $59, but remember, I got paid $205 for the contract. So once I get assigned those shares, my new basis, or the new amount that I own those shares for, becomes that lower amount, right? $57. Because now I have 100 shares of BitMine, right? Then what do I do right afterward? Remember what we said a moment ago. If I sell a put and then the price goes down and I have to buy those shares, I'm going to sell a call again, or already right against those shares. So that Monday, I think it was Monday, but I don't know, I'd have to check the date. I sold a call against those shares. How much did I get paid? I got paid $200. So remember, I got paid $200, 205 the first time I sold the put. Then I got paid another 200. Then the following day, you'll see the days over here on 8/19, I bought my call back. So we kind of touched on the past couple days flexibility and being able to, let's say you input a trade and then you want to change your mind or whatever, for whatever reason, you can buy that trade back. So I did that. So I bought it at the market, right? And I paid $50 for it. But here's what that means, guys. Originally I sold the call for $200, so I got paid $200. Then I bought it back for $50. So I still, on this particular transaction, I still netted $150. Here's what I'm doing, guys. I'm just trying to like hit the bat, right? Hit the ball, baseball. Like I want to like hit a single, and I want to collect bits and pieces of money on a daily, perhaps, or weekly basis. And then when that adds up, that's my cash flow. That's the money that I live off of. That's the money that I do stuff with, right? So that's how that works. Then the next day, I sold another call. But instead of selling a $59 call, I sold a $58 call. I own the shares, remember, for a little less than 57. So as long as you sell a call for with a higher strike price than what you own it for, that's okay. And how much did I get paid for that? Well, now this time I got paid $70. And the reason I got paid so little, I mean, little compared to, let's say, 200, is because the price was going down. So as the price goes down, I don't make as much money on a call because it's further away from where the price is trading, right? But I still make money. So here's the thing, guys. Make money, make realized gains, don't take realized losses. So those are some of the things that will start to click for you. Then what I did the following day on the 21st is I bought that back. So I sold it for $70. I bought it back for $17, right? I made 70 plus 70 minus 17. And then the next day, the following day, I sold another call. And you might be asking yourself, Michelle, why are you doing that? Why are you selling stuff, buying stuff, selling stuff, buying stuff? The reason I do that sometimes is this, and I don't do it all the time, but sometimes if I have some extra time on my hands and I'm home, most of my trading revolves around what I'm doing, right? So the past, I don't know, week or so, I haven't really put many trades in. I've just been busy with this class and maybe some other things. But if I have some extra time and I want to create some extra income for myself, I sometimes more actively put trades in. You don't have to do it this way. I'm just illustrating to you the ability to do it this way, and kind of how that would look. I sold another call, again, a $59 call. And for this one, I made $160. So if I add up all those things so far, if I go back to how much am I down in the stock, I have a paper loss right now of $900 in this stock. I don't really care about a paper loss because I don't have to sell the shares. I'm keeping the shares. It doesn't matter to me. And I'm still generating income on an ongoing basis. Do you guys see the power of selling a covered call? Let me know if that makes sense to you. A lot of these things, guys, there's not like any right or wrong answer. This isn't like black and white. This is like dancing, right? Like it's kind of like, you know, as you get more familiar with these things, you'll start to kind of feel whatever your groove is, and maybe some things might work for you a little bit differently than they work for me. Maybe you might want to sell monthly puts and monthly calls because you don't want to look at the stuff that much. You want to just sell something, take in the premium, and not look at it as much for a month or something like that. So it depends on really, like, you know, what fits into your schedule, what your overall intentions and goals are. So just to put things in a calculation, right? And make that make a little bit more sense. 100 shares of BMNR is what I have. How much did I have to invest? Well, I originally invested 5,900 because remember the strike price that I bought the shares for was 59. So 59 times 100. So 5,900. On this particular trade, I didn't use margin. Margin is different based on the brokerage firm that you're with, as well as the underlying, the stock that you're trading. So some stocks you cannot even have margin. And the reason for that is the brokerage company is saying, you know what, this stock is kind of risky. We don't want to float you any of the money. You got to have all the cash to put up your trade. So in this particular stock, you have to have all the cash. So I put up 5,900, but guess what? I care about realized gains. That's what pays my bills. That's what sustains my beautiful lifestyle that I have. I've made $568 in net income, realized gains, since August 13th. So that's about 2 weeks. That's about almost 10% in 2 weeks. What does that annualize out to be? 250% if I was to make this kind of trade on an ongoing basis. Now, I want to stop here and say a couple things. Number one, obviously, and you guys all signed disclosures before you came in this class to confirm that you recognize that there's no guarantees in investing. I'm not saying you're gonna do this or you're gonna do that. I'm showing you what I'm doing and what I've been doing. And also, I want to say that Wall Street, I keep terming it Wall Street, um, tells people and tries to hypnotize people by having them believe that, if you do 10% a year, that's great. And, you can't do 20%, you can't do 30%. And if somebody's telling you they're doing 100%, they're full of shit or something like that. That's absolutely not true. So here's the thing with options. You can be wrong a lot. You can make money if it's going up, down, sideways. As long as you keep like hitting these singles, you can absolutely make triple digit returns. Is that guaranteed? No, but it's very, very doable, and it's also sustainable. So I just want you guys to recognize that. Trading gives you the ability to make money over and over and over again. Like here's my 100 shares, right? So I only had 100 shares, and look at 205 plus 200 minus a little bit, plus 70 minus a little bit, plus 160. You could just keep flipping that money over and over on the same shares. What else can you do that for? It's like clockwork. If I want to, now this is something that I wanted to talk about. Some people might say, well, I don't want to have a paper loss of $900, Michelle. Like, how can I combat that? Like, what if the stock like drops to the floor? We talked a little bit about this yesterday. I'm going to talk a little bit more about it now. It's interesting because stocks and buying stocks is the one thing that people sometimes have to really rewire their brain, right? Warren Buffett says, I'm going to quote him again, if I like the stock at $59, I still like the stock at $47. I can buy more shares. And if I do that, I'm averaging my cost down. Now, let me show you exactly what that means. And this is like kind of contrary to people saying, put a stop loss in. Like stop loss, we're going to talk about that either later today or tomorrow. A lot of the finance, I don't know, people, right? The finance economy or whatever the word is, they will kind of talk about, okay, mitigate your losses, right? If you buy something for $60, maybe you only want to risk, $10. And if it drops to 50, sell it, cut your losses. They say, cut your losses, right? The problem with that, cutting my losses, is two things. I just turned a paper gain into a paper loss rather, excuse me. I just turned a paper loss into a real loss. And what's a real loss? A real loss is like money coming out of my pocket. I don't want to do that. So sometimes what I do is I buy more shares and I average my cost down. And let me show you how easy that is to calculate. Okay, I bought 100 shares at 56.96, right? I think you guys can all see my calculator on the screen. So I'm just going to add 56.96. And I'm going to add 47.90, 47.9, and then I'm going to divide it by 2. And that means now I have 200 shares with an average basis of 52.43. So I could do that if I wanted to. Or also, if I wanted to, I can sell a put on the same stock. So let's hop into my trading platform, and let's see. I think let me make it bigger so you guys can see it. So BMNR right now is trading at $46.64. Holy smokes, it's down 6% today. Am I freaking out and jumping off the bridge? No, I'm not freaking out. Let's see if I sold another put, how much money I could make. Well, I always look at short-term trades. The 29th, that's only in a couple of days because today is Wednesday. So let's start by looking at Friday rather. Let's say if I wanted to sell a $45 put, right? So right now the price is at $46.53. It's obviously changing because this is live data. If I wanted to sell a $45 put, I'm not going to talk about the bid or the ask right now. We're going to hold that off till probably tomorrow. I'm just going to look at the last trade. How much is the price right now? Well, it's 1.2. What does that mean? That means 1.2 times 100, because each contract is 100 shares. That means I'm going to collect $120, right? If I was to sell a put expiring Friday. So I only have a 3-day obligation today, tomorrow, Friday. I take in $125 in premium, or 123 now, $123 in premium. I'm committing to buy 100 shares of BMNR if it drops below 45 by Friday. If it doesn't drop below 45, I don't buy the shares, but either way, I keep the 123 bucks. And if I do have to buy the shares, that is an example of, now, again, averaging your cost down. Does that make sense? So you have a lot of flexibility when you're trading. Now, some of this stuff might be confusing, and I encourage you, don't get frustrated. Don't like throw your hands up. Oh my gosh, I can't listen anymore. It's too much stuff for me. It's okay if you're not clicking with some of these things. This is one of those things, like, it just takes practice, right? So as long as you understand the basics of the fundamentals, which I'm going to kind of stress as I go, that's the most important thing. And then you can kind of, improve, I would say, your skill as time goes on, right? Basically, even when the price goes down, selling a covered call is literally like having a house and Airbnb-ing it out. Like I have my stocks is my house, right? And I'm renting my stocks out via the covered calls and taking in premium. Same as Airbnb. I own a house on the beach, let's say, and I rent it out, and somebody's paying me to stay there, and I get paid on an ongoing basis. But the best thing about covered calls versus Airbnb, because I used to have villas in the Virgin Islands for a long time, many years, 10 years, and it was great. Many aspects of it was great. But I'll tell you what, like, the biggest pain in the neck part was customers, number one, and then like workers, employees, right? This is getting all the benefits, but having no workers, no employees, no customers. Be a part of our community. So I haven't built the rest of it yet, but it is coming very, very soon. Sign up to join the inner circle, and then I'll put you on the list, and then I'll let you know once that's done, because a community is the best place to get support. I'm telling you, like, as you get going, you're gonna have questions, and I'm just to give everybody sort of that preview of that. That's normal. That doesn't mean that you're not smart enough, or you can't do it, or it's too hard or something like that. The only thing that will make you guys not successful selling options is if you quit. I'm going to say that again. It's important. The only thing, I have never met anybody who could not do this. You don't have to be good in math. You don't have to have experience in stocks. I know the first day I kind of talked a little too fast, perhaps. And some of you, especially if you're new, sometimes it's hard to keep up. If you watch this material again, and as you practice, you will become better and more versed in it. Open a paper trading account. We're going to talk about that Friday as well. And you will become more versed in it. This is something that anyone can do. Obviously, you have to have a little bit of money to start, right? Like at least a couple $1,000 or something like that. But if you have a couple $1,000 and you don't quit, you can be successful. All right. So it's kind of like this. So my example of BMNR, me having bought it at 49, now the price is, or 59 rather, 59. Now the price is like $47. Oh my gosh. Should I freak out because I'm down $900? No, it's kind of like this. It's kind of like having a house. I paid 500K for my house, and I Airbnb it out. Now the real estate market is down, and if I sold my house, it's only worth $400,000. I bought it for 500,000, my house. Now it's worth 400,000. Do I freak out? No, because it doesn't matter unless you sell your house. This is the same thing. My BMNR stock that's down $900, it doesn't matter unless I sell those shares, and I'm not going to do that. Guys, you only take a loss if you sell something for less than what you paid. I'm telling you, Wall Street hypnotizes people and puts into your mind stop loss, like limit your losses, blah, 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 because they want you to rely on them. They don't want you to do it yourself. But you can totally do it. I'm telling you. Selling a covered call is literally the most conservative option strategy there is. You cannot lose money. And the way I say that, I'm going to say that in a caveat. You cannot lose money selling a covered call if you do it like this. I have 100 shares of this stock. I sell a call against it that's higher than what I paid for it. And even if the stock goes down, I don't sell my shares. I never take a loss, right? It is literally the most conservative strategy that there is. Now, where's the risk? Some people will say, okay, Michelle, I just don't believe that. There has to be some sort of risk. Here is the risk with a covered call. Now, let's say, I'm going to use my scenario. Let's say I have these 100 shares of BMNR and I own them for $57, and then I sold a $59 call against it, right? And I took in $160 or whatever that price was. Let's say something happens and crypto goes crazy, because that happens often, right? And let's say, Thursday, tomorrow, BMNR, Bitmine, goes up to $70. Well, guess what? I already committed to sell my shares for 59 or 58, whatever my strike price is. So if it goes super high, that means I don't get the rest of that gain. Now, in the past, I have had countless people be like disappointed. Oh my gosh, I should have done this. Oh my gosh, I should have done that. Do not, I encourage you, do not be one of those people. Be happy playing baseball. I'm going to hit a single. I'm going to hit a single. I'm going to hit a single. I'm going to collect $160 here. I'm going to collect $70 here. I'm going to collect $50 here. And that's going to allow me to live an amazing life. Don't worry about the money that you could have had if you had a crystal ball, which nobody has. So don't get that right out of your head, right? So where's the risk? That's the risk. That's the only risk in selling a covered call. Don't be greedy. So when I first started trading, oh my gosh, 1997, we didn't even have computers. Like, I used to call this dude in Chicago, like old school, like call this broker, right? And he told me, it's interesting how sometimes we remember certain things throughout our life and they just stick with us vividly. He said, in the market, don't be a pig. Pigs get slaughtered, right? That's what he said. And I never forgot that. And as I've traded over the years, I keep that in the forefront of my mind. Don't be greedy. Just hit singles over and over and over again. Guys, this is not that hard. Listen, I don't have a job. I have this, right? Trading. Like, I don't even know how to explain. Sometimes people say, what do you do? And I tell people I trade options. They don't know what the heck that is. Or if they do, they think it's risky or it sounds goofy or it's too good to be true or something. But I feel so blessed on a day-to-day basis. I wake up, take the dog out, go to the gym, come back, make breakfast, kind of like clockwork, all these things. I'm going to go see my kids in LA in a couple weeks, and I think I might change my flight and go next week instead. And I have the beautiful flexibility that I could just go wherever I want, whenever I want, and do whatever it is that I want to do. And I'm not saying that to impress you or brag or anything. I'm just saying that to impress upon you that if I can do it, you can do it. And these are very simple strategies. Sell a put, sell a covered call. If it sounds confusing, just keep going over this content and practice. Practice in a paper trade, practice in a live trade, join our community, my community, and talk to other people about it. You can totally do it. Only 3 things that you have to choose, right? You have to choose the stock. You have to choose the strike price, the price at which you're going to sell your shares, and the date that the contract expires, right? Very much like yesterday, we talked when we sell a put. What do we choose? We choose the stock that we're going to trade. We choose the strike price, and we choose the expiration date. This is the same thing, guys. So like I said, 3 things when we sell a covered call: stock, strike price, expiration date. Same as yesterday, yeah? Choosing the stock, a company that you're familiar with, right? So if you already have stock, great, you can sell a call on it. If you want to sell a covered call now, choose something that maybe you're familiar with. Choose something that's low priced maybe when you're new, so you don't like maybe overextend yourself. Look at what other big successful traders are trading. We talked a little bit yesterday, I think it was, or maybe the day before, on looking up the SEC Edgar page, what other people are buying and selling. I would encourage you, when you're new, to start with selling a put first. I think baby steps and learning to walk before you run is a valid thing. And I think selling a put is a good start. And then you sell a covered call after, if you have to buy the stock after you buy the stock. I think that makes the most sense. Choosing the strike price. So what price are you comfortable selling your stock for? Now, me, what I usually do, because it's interesting because I have the mentality like I share all of my information. Sometimes some people might say I overshare. Your success never minimizes my success. So I want to kind of tell you what I've been doing. Here's what works for me. Here's what hadn't worked for me in the past. Here's what I learned from these scenarios. And I hope that helps people, honestly. Like I don't know, again, it's like maybe ego, like it just feels so amazing when I can teach somebody how to do something so cool like trade stocks. Trading options is like, I don't want to say magic, but it is literally as close to magic as you can get. Like I said, you could do it from anywhere in the world. You could do it in your gym clothes or your pajamas, and you got no employees and no customers, and you make money for yourself every single week. Like, I don't know why everybody doesn't do this, honestly. So you choose the strike price. Getting back to what I was going to say, personally, I always choose a strike price at what I paid for the stock usually, or somewhere close to that. So if I ended up paying $100 for a stock, sometimes I sell $100 call, or maybe I sell $101 call or something like that, very close. And the reason I do that is twofold. Number one, I don't really care so much about making money on the stock volatility. And here's why. I don't have a crystal ball. I don't know what's going to happen tomorrow, next week. I don't want to have to care also what's going to happen tomorrow or next week. I want to just make money on the premium, on the income. So I want to be kind of like a casino. The casino has all these players come in and everybody's like playing slot machines or playing craps or blackjack or whatever. I pick on slot machines usually because it's like the worst game. It's always like way in favor of the house. So many people in the past have said, oh my gosh, I always win at the casino and I play slots and blah, blah, blah. It's mathematically impossible for that to happen. It's a mathematical impossibility. It's like 1 + 1 = 2. It doesn't equal 3. It just is, right? The more you play at a casino playing slot machines, you will lose overall. It's a mathematical guarantee. So for me, I just want to take in more money than what I pay out. And that's just all I want to do. And I just want to create cash flow on a regular basis. So I want to, typically I'm selling stuff, covered calls as an example. I bought the stock for 100 and I sell $101 call or $100 call. And yeah, so that's kind of me, but what works for you might be something different. Remember the rule. We talked about this yesterday. It's the same thing. It was the same for puts as it is for calls. The closer the price is, the strike price to where it's trading now, the more money you're going to get paid, right? Conversely, the same thing. The further away it is from the strike price, the less you're going to get paid. So it's identical to the rule that we spoke of yesterday regarding puts. How do we choose, right? I mentioned that I choose what we call at the money, right? If I own something at the money means I own it for 100 and I'm selling $100 call, or I own it for 100 and I'm selling $101 call. It has the highest likelihood my shares will get called away, but I make the most amount of money. So I like to maximize my income, and that strategy works for me. Some people, now we haven't talked about delta yet. I don't think, maybe we might have touched on it, but delta is basically kind of like the statistical likelihood that the price is going to go there before the expiration date. So if you choose a 30 delta, it's kind of like a good sort of middle of the road thing. Let's look at an example. So I'm going to use my BMNR example, right? So let's say I'm selling a covered call right now. And let's say I don't even have any BMNR, but I want to buy some right now, and I buy it right now, 100 shares. And then I want to sell a call against it that expires Friday. So delta, you remember the strike price is down the middle, right? Right here. And then puts are on the right side of the screen, calls are on the left side. We're going to look at delta. There's a delta column for calls, and there's also a delta column for puts over here. And you don't have to pay attention if it says positive or negative. Just look at what the number is, right? So if I'm looking at these numbers, for example, let's say I buy the shares now and I pay 46.45. That's what it's trading for now in that range. If I wanted to do, let's say, a 30 delta, you're not going to find exactly that. See how it goes from 29 to 33. These are going to be the percentage of the likelihoods, right? Or now there's a 30. So again, these numbers are always changing because it's live data, right? But what I want to do is maybe come close to a 30, and I might choose to sell a 49.5, $49.50, 50-cent call. All right, so the price of that, I'm going to go to the last price, 0.9. What does 0.9 mean? Again, we're going to multiply times 100. So we're going to get paid $90 for that contract. Now me, that might work for you, and that's kind of like a middle of the road. Me personally, if I was to buy 100 shares right now at 46.59, I would sell whatever's closest to the money. So I would sell like a $47 call, and I would get paid $165. And again, the reason behind that is I don't really care about the price appreciation so much. I want to maximize how much premium am I going to make? How much income am I going to make? But it's not like a one size fits all. You have to find your groove as you go. Yeah. Also choosing the expiration date. So this is kind of similar, right? So let's go back to our example. Let me just close this. Now, BMNR, I can trade August 29th. That's this Friday. September 5 next Friday. September 12 the following Friday. Let's say I have a 9-to-5 job and I don't want to really have to pay that much attention to this kind of stuff on a regular basis. I might go out a little bit longer. Maybe I go to September 26th. And let's say if I buy 100 shares now and I bought them for 46.49, and then I sell a $47 call, right? $47 call. So remember, go down the strike and then go off to the left. Now, how much would I make for that contract? 6.8. Okay, let's talk about that for a moment. I'm going to buy 100 shares now at $46.55. As soon as I buy the shares, I'm going to sell a covered call against it. Remember, you can't sell a covered call unless you have the shares. So you have to have the shares first, right? So that's a requirement to be covered. That's what makes it covered. So I buy 100 shares at $46 and change. Right away, I sell a $47 call. I get paid $680, right? 6.8, $680 gets dropped into my account. I can use that if I want. I can spend that. What's the likelihood that the price is going to end up higher than $47 before September 26th? It's about 56%. So it's more likely than not. Now, is that number a black and white thing? No, it's just a rough idea. And so it comes from the brokerage companies. They just, display it to the public, big traders, small traders, all traders, right? And it just gives you kind of like a general sense of, how likely is the price going to go to $47. Now, in my view, this stock is based on Ethereum. So, I mean, you could also look at what does Ethereum do on a week-to-week basis or a day-to-day basis? What does Bitcoin do? What does cryptocurrency in general do? Well, I mean, you don't have to follow crypto to know that over time it goes up. It's like always, like maybe it chops around, and there were periods before where like Bitcoin crashed, right? When something crashes, it gives us an opportunity to buy more if we have money to do so. And that's how we can make a lot of money. But this could be a good trade. Let's calculate to see if this might be a good trade. Okay, let's calculate it on the put side. I know we're talking about calls right now. However, like I said, if you're new and you start putting a trade in, really, I would highly suggest that you start with just selling a put, right? So let's just go through an example. This is such good content. You guys like this content? Man, I think everybody should sell options. It can honestly like create an amazing lifestyle, and it's not that hard. And once you look at all these hearts and thumbs up, I appreciate that. I think the only people that don't trade options are people that They just don't understand and they don't want to understand. But that's why kudos to you guys for being here. You are in the right place at the right time. I promise you. So I get so excited talking about this stuff. All right, so BMNR is at $46 and change, right? Let's sell a put against BMNR. We're looking at September 25. Now I don't usually go out a month, but we're gonna go out a month because lots of people watching this content have 9 to 5 gigs and maybe they don't have a bunch of time or they don't want to pay attention that much. So we're going to use this as an example, a good learning example. So let's start somewhere. Let's say I certainly don't want to buy it at 46 because why? I don't want to pay sticker for anything ever, right? And certainly not for my stock. So let's say I want to buy BMNR if it drops below 40 bucks. And by the way, we haven't talked about volatility yet, but I want to talk briefly about volatility. See this row right here, implied volatility? So we talked about delta. It's all the way to the right of the screen, implied volatility. And there's also obviously implied volatility for calls. Whatever there is for puts, you're going to have the same information for calls. We talked a little bit about this yesterday, and it's on our agenda to talk about today as well. And I think somebody also asked in the question today or yesterday, the higher the implied volatility, the more premium you get. So look at the implied volatility for this, 115%. It means it has a lot of swing. So as long as I'm comfortable holding it, and I'm not going to freak out if it goes down, which I'm not, right? Because I took Michelle's course and I'm not going to freak out and jump off the bridge if my stock is low. So I'm going to sell a $40 put. Here's what that means. Now pay attention. I'm going to say this a couple times because I want to really hit this home. BMNR is 46 bucks a share now. I'm going to sell a $40 put that expires on September 26th. I'm going to get paid $295. You guys see that number, right? $295. What that means is I'm committing to buy 100 shares of BMNR if the price drops below $40 between now and September 26th. Now, it could drop below and then pop back up and drop below and pop back up. It's up to the particular person, the individual, honestly, to exercise that option. But usually, it doesn't matter if it goes up and down, up and down. It has to close, generally speaking, under $40 on September 26th for me to have to buy those shares, right? For this commitment, how much money do I have to have? Anybody know? There's no chat, so how can you answer? I'm going to answer for you. If I'm committing to buy 100 shares at 40 bucks, what do? I do 40 times 100, right? 4,000 bucks is not that much money. Can I use margin on this? Well, you can't with Schwab because they say that BMNR is too aggressive and you have to put up all the money. So I have to have $4,000 in my account to make this trade. And I'm going to make $295. Now, let's see if that's a good deal. Now, I have tools that I'm creating to make this easier. But in the meantime, just use a simple calculator, right? $295 is the income that I make, right? $4,000 is the money that I have to have in order to make that trade. What is that? That's 7%, 0.07375. We're just going to round it off to say 7%. What does that mean? That means I'm making 7% on my money. However, I'm only keeping that money wrapped up for a month because I'm looking at a September 26th contract. So I'm not going to get super detailed and calculate the days, but I'm going to say that's about 1 month from now. Is that fair to say? It's about 1 month. So I'm going to take 0.07375, this number, and I'm going to multiply by 12. Why? Because there's 12 months in a year, guys. That's why. This is not rocket science. Anybody can do this. I'm telling you, if it sounds confusing, it's okay. It's new. So if it sounds confusing, it's not you. It's just that the content is new. Man, when I was living in Bali and I was taking Indonesian, I was like, oh my gosh, everybody says that this language is like the easiest language to learn, but I couldn't remember it. But then I just kept practicing, right? I kept reading my content. I was working with a tutor every couple days a week, whatever. And I was practicing with some friends and practice. This is the same thing. If you're confused, don't worry. 7% I'm making my money. I'm making 7% for 1 month. I'm multiplying by 12, and what do I get? 88% per year, guys. So you see how easy it can be to make triple digit returns? It's not that hard. And by the way, let's look at all the numbers, all the relevant numbers actually. What's the delta? What's the statistical likelihood that BMNR is going to go from where it is now, $46 and change, to $40 before the expiration date of September 26th? It's 26%. So it's not that high. So it's more likely that it won't close lower than $40. What does that mean? That means we make the trade, we get paid the $295. The contract expires worthless because the price stays higher than $40. And then there's no more risk on the trade. Then I can do another trade that following Monday. That trade is over, right? So that's what that means. This is amazing stuff. Expiration date, moving on. Like I said, let's look at BMNR again. This is a good example. August 29th, September 5th, September 12th. You choose the stock. You choose the strike price. You choose the expiration date. Me, I usually just look at this week. And sometimes because today's Wednesday, I might look at next week, like BMNR, probably after this video is done. Maybe I'll look, because I have 100 shares at a higher price, and right now the price is down 6%. When stocks are down and other people are freaking out, that's the best time to sell a put because you get paid more money. So I might look at next Friday, maybe, let's say a 40, let's say if I feel comfortable to, selling it closer to the money, a $45 put. You see how the price is down 6% right now. This contract is up $92 from yesterday. So when prices are down, puts are more expensive. When prices are up, puts are, prices are up, puts are cheaper, right? So it's always going to be the opposite. And don't worry if you forget, it will start to become logical, because here's the thing, when something's going down, 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 and everybody's freaking out, that's when the price is highest, right? It's kind of like, I don't know, sometimes when there's limited resources in something, and then that particular item goes for sale for a higher price, kind of similar. So let's say I wanted to look at next Friday, and let's say I want to be closer to the money. I can sell a $45 put for $252. Let's see what the rate of return is on that. Let's see. So I'm going to take in $252, right? I'm going to commit $4,500 because it's a $45 put times 100 shares. That's 5.6%. And I'm going to multiply that times what? Maybe it's a little bit longer than a week. I'm just going to do divided by 3, because I'm going to hold it for 3 days. Or no, not 3. Monday's a holiday. No, maybe not Monday. Let's say 8 days. Wednesday, Thursday, Friday this week, and all of next week, right? So 8 trading days. The times 252 trading days per year. I'll just get a more precise number for you guys. 176% on my money. It's a pretty good deal. So you can see how you can start to, become a believer that you can totally make 100% triple digits on your money, and you don't necessarily have to take a lot of risk. You don't. The longer you commit for, it's just like the put yesterday that we talked about. The longer the time frame is, the more money I'm going to get paid. The shorter the time frame, the less money I'm going to get paid. I like weekly because I just like to flip things like every week and lock in my gain, my realized income, and move on. Calculate the premium. So we kind of went through that on how that works. I encourage you guys to calculate it both ways. What I mean by that is this. We just calculated the premium, the rate of return on BMNR, and I used how much money I need to put up, and I did not assume any margin. But let's look at something assuming margin, right? So let's look at Tesla as an example. Tesla, you can use margin on. And the easiest way to look at some of this stuff, first I'm going to look at a chart. I just always kind of look at a chart, and you see kind of like, okay, well, where's Tesla been going for the past year? let's say Tesla's right now $350 and change. And let's say I'm going to look at a contract for this Friday. And I'm going to look at a strike price of, I don't know, let's say $340. So right now it's $350. And I want to look at, a $340 put that expires this Friday. Well, it last traded right here, 1.59, right? $159. By the way, it has a delta of 21, so it's not very likely that it's going to go from where it is now down $10 in just the next couple days, right? But if it did, you're committing to buy 100 shares, right? So let's first we can calculate what we need for margin. So depending on who you trade through, is different. So this platform is Thinkorswim. So I'm going to click on the bid, and then I'm going to analyze the trade. Let's see, right click. And then this is going to tell me sort of what my, you'll see the top here, naked. One, if I sold a naked put, a $340 put, how much margin do I need? $9,914, right? So then what we do is we calculate what the rate of return is. It's $160. So $160 divided by, it was like $9,900, right? Margin. That's like 1.5%, 0.016, but that's only holding it for 3 days, right? Because this is an August 29th expiration date. So what am I going to do? I'm going to do divided by 3, and then I'm going to times 252, because there's 252 trading days in a year. And that's 135% on my money. It's pretty good, right? But let's also calculate if I had to put up all the money to buy the shares, because here's the thing, and we're going to talk more about margin tomorrow and the next day, Friday for sure. But margin is the one thing that gets most people in trouble. It's like the one thing that can totally blow up your account if you don't understand it, if you don't prepare for certain things. Because even though I only need $9,900 to put this trade up, if the market goes down, my requirement is going to go up. And I don't want to get too detailed here, but I will say this. I mean, really, you're committing to buy 100 shares at $340. That's 34 grand, like not using the bank money. So let's calculate it in that regard as well. So we had $160 premium, and let's assume I have to put up all the money, which is 34,000, right? So 160 divided by 34K. That's for 3 days. Remember, Wednesday, Thursday, Friday. So divided by 3. And then I'm going to times 252. That's still 39%. So this is what I'm talking about. Wall Street, like brainwashing people and telling you that be happy if you make 10% on your money, 12%, like you can't do 20%, you can't do 30, 100% is unheard of. No, even assuming putting up all the money and making 39% of your money, it's not too shabby. Yeah. Calculating the rate of return, it's easy. How much premium do you need? Or how much premium are you making, rather? How much capital do you need to make the trade? How many days are you holding it? And then you just calculate it, right? You just do exactly like I just did on a calculator. I'm building some tools to make that stuff automated. If you want to go on the list to be the first to know about it, that's going to be a paid program. Yeah, I'm going to be done with that pretty soon. But that can be very beneficial, but you don't need it either. You could just use a calculator if you want to do it manually. That's how I've been doing stuff for years until I started being automated. Aim for trades that make over 100% annualized. People might think you're crazy doing that, but like, here's the thing. This is what I do. This is what I do in general in my life. I aim for the moon and I hit the stars. So if you have like a super high goal, like, okay, if I aim for 100%, and I make 80, oh, that's not too shabby. 80% of my money, it's all good. So yeah, I will tell you this, I never, ever put a trade in without calculating the rate of return, because sometimes it's not worth it. Like, you don't just look at a static number. You don't just look at, okay, the premium is $200. Remember yesterday, I like picking on SPY because it's like the most misunderstood thing ever. Like, it's $646 per share. And let's say I sell a put on SPY, a $640 put. I'm making $100, $108. I'm committing to $64,000. Okay, the broker dealer is going to give me a lot of juice for that, like margin, right? They're going to let me borrow a lot. Why? Because SPY is a scam. It's like this $1 trillion, fund that the guys on Wall Street make oodles and oodles of money and pay for their houses in the Hamptons for. That's why they want you to think that's good, and they want to like give you a lot of flexibility to do that. So it's kind of like the subprime days, back in, I don't know, 2007, 2008, the housing crisis, the financial crisis happened, and people were lending people, money, like everybody should be able to buy a house. Well, the fact is, not everybody's in the position to be able to buy a house, and there were subprime banks, preying on people, giving them these mortgages, giving them these high, interest rates. And who cares if you don't pay your debt, because we're going to foreclose on the house, and, we're going to have a bunch of equity the way they structured the notes. And then who loses? The little guy loses. This is the same thing, this is the same thing. Delta, we talked a little bit about before. What's the statistical likelihood that the stock's going to go from where it is to the strike price between now and the expiration date, right? It gives you a comfort factor, right? So it's not a black and white, thing, number, and it's going to adjust as time goes on, but it gives me kind of like a sense of comfort. Let's not look at SPY because that's a crappy stock. Let's look at MicroStrategy, one of my favorite stocks. $347 per share, right? And let's look at this Friday, because I just look at typically short-term stuff. And let's say I don't really want to buy the stock. So I want to kind of, be kind of far away from it. Maybe I'll sell a 330, put. By the way, this is showing 14 strikes. Usually what I do, I did that so it wouldn't look so cluttered for you guys on the video, but usually I kind of like show everything. So let's say I want to sell a $300 put, right? It's so far away from where it's trading now. The price is super, super small, $31. Sometimes I use a lot of these strategies on Fridays, especially if I'm like at home on Friday. Sometimes it depends on what I'm doing, right? Like, but if I'm home, I might say, okay, well, I have some cash in my account, and let me just, sell some way out of the money, expiring later today, and just take in, a handful of bucks, and that's gonna, I don't know, buy my dinner at the cut at the Four Seasons on Saturday, whatever. I don't know. It, like, whatever, however you want to do that. But what I'm saying is it can be very, very flexible. Yeah. The higher the delta, the more you're going to get paid, right? So if the delta is higher, that means it's closer to the strike price. The strike price is closer to where it's trading. The more money you're going to get paid in a premium. The converse is true as well. The lower the delta, the less you're going to get paid. So really the trick is like finding that, I don't know, whatever works for you. And there's no right or wrong. It's like, it's kind of like a dance. Like I said, you kind of, get the groove as you go, and how you feel comfortable, and what sort of strategies you use, moving forward. We didn't talk much about it, but I talked a little bit about implied volatility. That's how much swing you have in that particular stock. Now, the more swing you have, the higher the premium, right? So we look at BMNR, the premium, relative to what the trade is going to be higher than something that doesn't move as much, right? So volatility is always our friend as an option seller. We like time. Time is our friend as an option seller as time goes on. That's advantageous to us. Also, implied volatility, higher volatility is advantageous to us. I just kind of listed just a few, and these aren't recommendations, by the way. I'm not recommending anything in any of these presentations. Your money is your money. You make your own choices. I'm just telling you, I'm educating you, basically. I'm telling you what I'm doing, what works for me, how do things work, but I'm not giving you any specific recommendations. These are just ideas of some higher volatile stocks versus some lower volatile stocks. And if you took the time to like compare the premium difference, you'd see that, you're going to make a little bit less on stuff that doesn't have as much swing to it. Yeah. Yeah, so that's what I just said. The higher the volatility, the more you're going to get paid, and the lower the volatility, the less you're going to get paid. But let's put it all together and kind of go through some just updates on what we already talked about. Only two strategies that we're going to talk about, that we're talking about all week: selling a put, selling a covered call. I know a few of you have asked about some other things. I just don't trade in those other things, and I don't know a lot about them. I just try to keep it simple and easy to replicate on an ongoing basis. Those strategies work for big accounts and for small accounts. Let's look at, I want to look at like Intel. I think that's such a great stock, honestly. And it's great for like people that are starting. So what do I do first? I want to look at like a 1-year chart, right? So this is kind of like, where has Intel gone throughout the past year? And it was pretty down. And then it kind of popped up recently. Let's look at it as an example. I think we looked at this yesterday, but I'm going to repeat it because I think it's good to know. It's almost 25 bucks a share. Let's say I want to look at, a $24 put. It's not that much money. It last traded at $16, right? But let's see how much money I need. I think it was like 500 bucks because I think we did this yesterday. Let's see, $24 put is $450, right? So we make where's that premium? 24. We make $15, right? We put up 450, right? How do we calculate that? $15 divided by 450 bucks divided by 3 days, right? Times 252 days a year, 280%. Now let's calculate it, not just how much margin we need, but putting up all the money, right? If we had to buy 100 shares at 24 bucks, that's 2,400. So 15 bucks divided by 2,400 bucks, right? Still not that much money. Divided by 3 days, right? Times 252 days a year. That's still 52%. You're making 52% on your money. So yeah, I mean, the rate of return is going to fluctuate based on what you're looking at. That's why I encourage you to look around, click around, add stuff, hey, I want to think about, let's see where Google is, or hey, let's see where Amazon is, or whatever. And then you can kind of, take a look, what's the implied volatility typically on Amazon, right? So that's like, Amazon is right now $228 per share. If I'm looking at like, well, this is this Friday. It's not that much at all. Premium. Let's look at next Friday. Let's look at like a 200, and that's not much premium either. The volatility is pretty low, 26%. That's low volatility. That's why the premium is not that much. But click around and check and feel like try to oops, sorry about that. Start getting your your groove, what you feel comfortable doing. Again, only two strategies: selling a put, selling a covered call. But basically, just to reiterate, selling a put, selling a covered call. When you sell a put, you're committing to buy shares at the strike price if the stock drops below that price before the expiration date, right? If it doesn't drop, you don't buy the shares. Either way, you keep the premium. Selling a covered call, it's kind of the opposite. I have 100 shares already. When you sell a put, you don't have any shares, okay? When you sell a covered call, you already have 100 shares. You're paid a premium in both. You're paid a premium. You're committing to sell your shares at the strike price if the price goes higher before the expiration date. So that's what the difference is. Hey guys, how's the content so far? If you like the content, be sure to drop a comment on this video. It's super helpful to help other people find this content as well. Thanks again. So without further ado, we're going to talk about day 4, right? So I am so excited. I hope you guys are excited too. Today is day 4 out of 5 for our lunch and learn. And we're going to go over some cool stuff today, and we're also going to recap what we've talked about so far. Remember, when we kind of go over this information, we're building upon, the basic foundations of options, selling a put and selling a covered call. And as I said before, there's only going to be 2 strategies that you need to know. Are there other strategies for options trading? Yeah. There's, credit spreads, and there's diagonals and all kinds of crazy things that I'm not even that familiar with. However, there are only 2 strategies that you need to know in order to be successful. And I always try to keep things simple. Things that are simple are very easy to replicate. And I don't want to just make money this week or next month. Me personally, I want to make money on an ongoing, regular basis. I think if you're trading options, you probably feel the same way. So it's easiest to just stick with the basics, and that's what we're doing here. So let's go over a recap of what we talked about yesterday. We're going to start with a recap. We're going to talk a little bit more. Now, I don't want anybody to be bored, but it's important to really understand the foundation, the fundamentals, selling a put, selling a call, what that means, calculating the rate of return. I know sometimes I've been doing this so long, and sometimes I might, just kind of go through things fast and assume people can keep up. So I want to make sure I take my time today and go through all that. So we're going to review that. I'm also going to share my screen a lot and walk through a lot of trades today, step by step. I'm also going to talk about order types. I don't want you guys to just learn information. I want you to have the information and learn the stuff so you can actually, if you wanted to, go put an order in on Monday. Now, the platform that I use particularly is Schwab. So if you use a different broker dealer, that's totally okay, but your platform is going to look a little bit different. All the stuff is going to be the same, what the price is, what the delta is, what the ticker is, but it's just going to look different. So keep that in mind. Also today, we're going to walk through closing a position early, because there might be points in time, and I'm going to show you with some of my own trades, where you might want to close a position early. So I want you guys to be capable of being able to do that, right? Let's first go over the foundations, the fundamentals, because I want to make sure that you guys really understand there's not a lot of stuff that we're talking about here. Really, we're talking about puts and calls, and there's just a handful of sort of things that mix up in those puts and calls. But because the content is new, it's very, very understandable that it can be confusing at the beginning. It's just like learning a new language. I'm learning Spanish, or I'm learning Indonesian, I'm learning French, or whatever that is. It gets confusing, especially at the beginning. But just like learning anything in life, as you practice and as you become more familiar with certain things, practicing your different trades. But let's start kind of like in detail. What is selling a put, right? So puts and calls are 2 different things. So think of them very distinctly. We're going to talk about a put first, then we're going to talk about a call. So they're not related. You don't actually sell a put and sell a call at the same time. So they're totally separate transactions. Basically, selling a put, you don't have to have any stock, right? So when you sell a put, you don't own any stock. Your money is in cash. And you have to have either all the money to put up to buy that stock, or some of the money. So what you're doing essentially when you sell a put, you're paid a premium. So that's money that goes into your pocket. And by the way, when do you get paid that premium? You get it paid the same day that you make the trade, right? So I'm receiving a chunk of money, and in exchange, I'm agreeing to buy 100 shares of a particular stock, but I'm only going to buy that stock if it drops below the strike price before the expiration date. And that's important for you guys to understand. So let's go through an example. Let's kind of walk through my screen a bunch of times. I'm going to use, I don't know, Tesla's already up. So I'm going to use Tesla as an example. Right now, the price is $342, right? And change. You can see that up in the upper left. I'm just, I don't know, this was already open. So I'm just going to look at a September 5, which is next Friday. So I'm going to look at a September 5 put. I'm not going to go through a lot of details as far as lots of this content on here. I'm just going to tell you the important pieces. It's kind of like what I want to do is I want to give you like the Cliff Notes version of the book without you having to read the whole book, right? If I wanted to sell a put, let's say I don't want to buy it at 342, right? Do I ever want to pay for stuff on at full price? No, I want to buy stuff on sale. So I'm going to, let's say I'm going to sell a $320 put. I'm just, I'm just picking it out of the air kind of. You go down the middle, you have the strike prices, right? So here's the strike price of $320. Now you're going to move to the right because that's where puts are, right? So you see puts up here and calls are over here. So we're talking about puts at the moment. The price is 342, but we're going to sell a $320 put, right? Now that last traded at 1.61. What does that mean? Let's break it down in bite-sized pieces. That means we're receiving income. We're multiplying that by 100 because each contract has 100 shares. That's just the way it is. Now, somebody had asked before, can you sell like one contract or two contracts or 10 contracts? You can sell as many as you like. And how many contracts should you sell on an ongoing basis? Well, it depends on how big your account is, right? So if you have a $10,000 account, am I going to sell 5 contracts on Tesla? No, because I don't have enough money, right? So in this teaching, we're usually just talking about one contract. And you'll see these numbers flip, right? They change as time goes on. I think it was 161 a moment ago when I started talking. Now it's 160, right? The last trade. So let's say I want to sell this put, right? I'm paid $160. That money goes into my account today, right? Today. And for that money, I'm committing that I am agreeing to buy 100 shares of Tesla at $320 because that's the strike price. If, and this is the caveat, if and only if the price of Tesla drops to that price or lower. So right now it's at $342. It has to go under 320 in order for me to be required to buy those shares, right? So you guys follow me? I'm paid $160 in premium. I keep that premium no matter what, right? We had talked about an insurance company. I pay for car insurance and I'm paying a premium to the insurance company. For that premium, they are committing to fix my car if I smash it. Now, that contract has a finite term, right? I might have a 6-month car insurance policy. I might have a 1-year car insurance policy. And after that policy comes due, if I don't renew it, that's it. The contract is over. So there's no more risk on either side. I mean, there's no more requirement, I should say, on the side of the insurance company. So let's say I pay for car insurance and my car insurance comes due, but I forget to make the payment. And then the following week I get into an accident. Well, guess what? The insurance company, they're not going to pay to fix my car because the contract is over. Also, let's say during the contract, I don't have an accident. They don't give me any of the premium back. This is the same thing. Once you receive the premium, guys, it's yours to keep no matter what happens, right? What happens if Tesla goes bankrupt? I mean, they probably wouldn't, but what happens if they do? We still keep that $160, right? So let's go over, somebody had asked about calculating the premium. That's a perfect segue into, as we're looking at what does selling a put mean? What are the functions of that? How does that work? And then how much money do we make? Because here's the thing, guys. We don't ever want to put a trade in without knowing what the rate of return is. Let me pull up a calculator. Let's see, applications, calculator. Okay, I think you guys can all see my calculator. And I'm going to use this as an example. I'm selling a Tesla. Let's back up. Let's start from the beginning because I want to say this a few times. I want to make sure I don't lose anybody. Tesla is $342 and change per share. I'm going to sell a $320 put. There's a couple things I want to note, right? So I always want to kind of look at the delta. The delta is what? The delta is the statistical likelihood that the price is going to go from where it is now to the strike price between now and the expiration date. So let's fill in those blanks. So the delta is 0.13. Ignore the minus sign. There's a 13% statistical likelihood that Tesla is going to go from $342 and change, where it is now, to the strike price of $320 between now and the expiration date of September 5th, right? Does that mean it can't go down? No. It can. Like that just gives you kind of an idea. Is it likely? Will I be more likely or not to have to buy those shares, right? So 13% is a pretty low number. It's not that likely to happen, but it could happen. So you have to be prepared for that. Now, how do you prepare for being having to buy those shares at $320? Well, there's one of two ways, right? You either have to have all the cash in your account, and how do you calculate that? Well, if we're looking at a $320 strike price, and what we're agreeing to is we're agreeing to buy 100 shares at $320 if the price drops below 320 before the expiration date. If I had to have all the cash in my account, that would be $32,000 that I'd have to have. So 320 times 100 shares for each contract was $32,000, right? Now, I don't have to have all the money if I don't want to. I could, and that's kind of like the safer way to do it, right? That's the most conservative way. But if I want to use margin, I can borrow some of that money from the broker that I'm working with, right? It's kind of like, buying a house. I buy a house for $500,000 and I don't have all the money to put up. I put up a deposit, let's say 100,000, and the bank floats me the rest, the other 400,000. This is kind of the same thing, right? Now, tomorrow, we're going to talk a lot about margin because that's a little bit more aggressive when you're using margin because you can make more money for sure. It gives you the ability to put more trades in and not have as much money like to put up, right? But at the same time, if positions go against you, like let's say Tesla drops to $200, right? Drops from 347 or 342, where it is now, down to 200. Something big happens and it drops like a rock, right? Margin, it's very important to make sure, do you have enough money in your account to sustain that type of a drop? We're going to talk more about that tomorrow, right? So stay tuned for that. But going back to our example, let's calculate. Now, let's calculate it two ways. So usually when we want to calculate our rate of return, it's very helpful to understand it two ways: putting up all the money or using margin. Because if we only look at using margin, it's kind of like half the story, right? And it's kind of like, you're looking at the rate of return under the best case scenario, but we want to also look at the worst case scenario. Trading is all about risk management, right? Anybody can make money in the stock market. I want to say that again. If you learn these things, selling a put, selling a covered call, it is very easy to make money. If you're using margin, it's a little harder not to lose it if you have a significant, market event. The market goes down a lot. And again, we'll talk more about that tomorrow, but just know for now, it's super easy to make money. You heard it here first. It really is. So we're going to calculate it both ways. Best case scenario, worst case scenario type of thing, right? So let's go through the mathematics of it. So this, as I've been talking, this price is changing, right? This last price. Now you'll also notice on the screen bid and ask. We're going to talk about that later in the session, but right now what we're going to just do is we're assuming I'm just going to use 160 because that's what it was a moment ago. It's just a round number. I'm taking in $160. I'm putting up $32,000 to make that trade if I have to put up all the money, right? So $32,000. Let's say I'm not using margin and I'm putting up all the money. So how much am I making versus how much am I putting up? Well, that's a half of 1%, 0.005, which is also equal. You can also say a half of 1%, potato, right? But here's the thing, guys. You don't want to look at like how much your rate of return is on a static basis because you want to look at everything. You want to compare apples to apples, right? So you want to like really, to get a sense of comparing trades and if it's a good deal or not, you want to annualize that number. So assuming I did a trade like this, let's say over and over again, throughout the year, how much money would I make? What would be my rate of return? Well, over this time frame between now, which is what, August 28 and September 5, it would be half of 1%. So you want to first, if you're looking at it like this, it's not exactly, let's say, 1 week, and it's not exactly 1 month. So I want to just calculate, well, how many days am I holding this particular trade for, right? Well, Monday's a holiday. I forgot about that. I think I mentioned that yesterday. And I wasn't sure if it was or wasn't. Monday is a holiday, so the market is closed. Today is Wednesday, right? So I would be holding it today, tomorrow. Oh no, today's Thursday, excuse me. Every day is Saturday for me, right? Like when you don't really have a regular job, every day is Saturday. But no, all joking aside, today's Thursday, tomorrow's Friday, right? So that's 2 days. And then Monday, we're not going to count, but we're going to count Tuesday, Wednesday, Thursday, Friday. So what is that? That's 6 days, right? So I'm holding this trade for 6 days. So I'm going to do divided by 6. And then I could, if I wanted to, I could multiply how many days are there in a year? 365, right? Days in a year. You could just Google that if you didn't know it. But I don't use 365. I use 252 because you don't trade on the weekends, right? Saturday and Sunday you don't trade, and holidays you don't trade. So typically, and I might be off by 1 or 2, maybe it changes from 1 year to the next, but approximately there's 252 trading days per year. So this is how much money I'm making per day, right, on this particular trade. Now I'm going to multiply that by 252. And that comes out to be 21%. So here's what that means, guys. So if I'm not using margin and I have all the money in my account to put that trade up, and if I did that trade like this all throughout the year, how much return am I making on my money? I'm making 21%. It's not bad. I mean, it's not great, right? But it's certainly better than like probably financial advisors give you 10, 12%. They tell you be happy if you get 12%. So it's still almost double that, right? Which is why one of the reasons why you should be managing your own money. So that's kind of calculating it using a cash secured put. Now let's calculate it the other way. Let's calculate it if I have to put up margin. And here's how we're going to talk more about this tomorrow when we talk about margin. Margin, there's like an approximation of how much you need, but the easiest way to figure that out and to see that visually, if you, let's say, use Schwab, different platforms will be a little bit different. But what I'm going to do is I'm going to just click right here, and I'm just going to pull a trade up. So this is your order entry window. We didn't really go too much of that the past couple of days, but this is kind of like if and when you get ready to enter an order, where do the details show up, right? So this is where they show up. And you can see it's red when you're selling something. And if I was buying something, let me change this to buy, it would be green. So am I ever going to buy options? No. I mean, I might buy back my option. We're going to talk about that later in the session if we want to liquidate a trade that we're already in. But if we're starting a new trade, we are going to sell the option, right? So we're always going to be an option seller. So you see how this says -1. So we're selling. The quantity is going to be -2. We could change that quantity, -3, -4, -5, however many contracts we want to do. So we can either do that by the plus or the minus, or we can actually type this in, -1, right? Auto, you're just going to ignore that. Symbol, right now we're just looking at Tesla, right? So the actual stock is, you can call it the symbol, or you can call it the ticker, right? There's different terminology for that, but it's all the same thing. It's Tesla, right? It's going to have the expiration date here, right? So what's the expiration date? We're talking about September 5. So you can see that up here in my window, and you're going to see it here in the expiration date. And then the strike price, what we've been talking about, is a $320 strike. If I wanted to, I can change that by just clicking into the box, right? So I'm going to keep that 320. And then we're talking about a put, right? If we were talking about a call, it would say call, but we're talking about a put. And so it's going to say put, and then it's going to have the price here. And then it's also going to have something called limit, or I can change that to, let's say, market order. We're going to talk about that later on today, what types of orders we can enter. But right now, for the sake of simplicity, I'm just gonna keep it as it defaults, right? And then we're also going to ignore this day. I'll tell you about that, what that means in a moment, but it's not really that relevant. And I'm going to right click and I'm going to analyze the trade. And so different brokers will have different things, but with Schwab as an example, and by the way, I don't make any money or anything if you open a Schwab account. I'm just showing you because that's currently who I have my account with. And sometimes I change from time to time for whatever reason. Different, they're all pretty much the same. They might have differences. We're going to go through probably more tomorrow on what you look for, when you choose a broker dealer, what's important to you and how they compare to one another. But this is how their platform looks. So when I pull up, when I click on that analyze trade, it's going to give me the same information, right? Selling one Tesla September 5, $320 put. And it's going to give me the price. And then also, if I click into this box here, it's going to show naked. What does naked mean? Naked means I don't have to put up all the money. I don't have to have $32,000. I can use margin, and this will show me how much margin I need to put up. And in this case, it's $8,200. Now ignore the top because this is my real account, and I already have some Tesla, and I have a short call against it. So ignore that. I'm just showing you exactly, the stuff that you want to look at in order to, evaluate the trade, right? So once again, let's wrap that up, what we just said. Tesla is 340, now it's $343 and change per share. We can see that in the last price here. We are selling a $320 put that expires on, I think I was using September 5th. Yeah, we are selling a $320 put that expires on September 5th. 320 is the strike price. That is the price that I am agreeing to pay for those shares if and only if the price of Tesla drops below $320. If it does not drop below $320, I do not buy the shares at all. Let's say it's $320 and 50 cents. No, I don't buy the shares. Either way, I keep the premium. It was 160, and by the way, now it's 148. That kind of shows you sort of how things fluctuate. Let's just keep talking about the $160 because that's what we used in our example. I keep that amount of money. Now knowing the, where's my calculator here? Now knowing the margin that's required that we went through, let's see, how much was that margin? That margin was 8,279, right? 8,279. I'm going to divide $160 is the premium that we got paid, divided by 8,269, because that's the margin that we need to put up in our account to be able to make that trade. We have to have at least that amount of money, right? So we're going to divide the premium divided by how much capital you need to make the trade. And that gives you a number. That's 0.019. That's almost 2%. But again, just like a moment ago, we're only holding the trade for how many days? 6 days, right? Today is Thursday, so Thursday, Friday. Monday is a holiday. Tuesday, Wednesday, Thursday, Friday, because we're looking at September 5th. So 6 days, right? So I'm going to multiply, I'm going to divide the total return that we're making over that period by the number of days. I'm going to do divided by 6, right? And then I'm going to annualize it out because I want to compare apples to apples. I'm going to annualize it out by multiplying times 252. Now that gives us a rate of return of 81%. Now, what does that mean? That means that if I'm putting up all the money, I forget what the number was. I think it was like 21%. If I'm putting up all the money to make the trade, $32,000, and I'm making $160 in premium, I'm making 21% on my money annualized, right? If I did that trade all the time throughout the year, that kind of trade, that's how much I make on an annual basis. because you want to like use the same thing for everything. You know, some trades you might hold for 3 days, some trades you might hold for 5 days, some trades you're going to hold for 10 days or whatever. You can't compare an apple to an orange. They're different things. So you want to compare all your apples together. So you want to make this an apple by making it an annualized basis, an annualized number, right? So if I have to put up all the money and not use margin, I'm making 21% on my money. If I want to, you know, use some of the bank's money, use the house money, I'm making 81% on my money. So that's kind of how selling a put works, how you calculate it, you know, that sort of thing. It's okay if it's still confusing, because here's the thing, you will only fail if you quit. I believe in you. You will only fail if you quit. If you keep just understanding this, join my community. We're talking about options. Watch my videos on YouTube. I talk about all these different things and different pieces. Keep practicing, and this will click just like riding a bicycle. I'm telling you. Now let's talk about, that's kind of how selling a put works, right? Let's talk about selling a covered call, right? So let's talk about, again, I just want to make sure you guys understand the foundations. So we're going to talk about what that means. Well, I can sell a call, right? But you can sell a call one of two ways: naked, just like puts, or covered, right? Covered means you already have the stock. When I talk about selling a call, I'm always talking about selling a covered call. Now remember, it's different than a put. So get put out of your head right now. So now we're talking about call. It's two different things. Completely something different. So when I sell a call, it's going to be covered, which means I already own the stock, right? Why am I never going to sell a naked call? Because theoretically, a stock can go to infinity, right? There is no ceiling on the price that a stock can go. So that is what we call unlimited risk. I don't ever want to take unlimited risk, no matter what I think. I might, know somebody that works at Tesla, and I think I know that stock is going to go up, or whatever the case might be. It doesn't matter. Like there's no, you want to evaluate the risk, and you want to identify it and figure out, do I want to live with that risk? I don't ever want to do anything where there's unlimited risk. It just doesn't make sense. So I am always going to talk about a covered call, a call being covered, meaning that you already have the stock. Now, what if you don't have the stock? Well, guess what? Let's use Tesla as an example. Let's say I don't have any Tesla. But I like Tesla, and I don't, and I want to buy some, and then I want to sell a call against it. How would that work? How much money would I make? Well, you don't have to have the stock for any period of time, right? So like maybe you already have the stock and you've had it for a week or a month or a year or whatever. I can also just buy the stock right now and then sell a call against it right now. But you have to have the stock in order to sell the call. So there's an order of sequence, an order of operations in which you do that, right? So first, let's say I don't have any stock. I would buy some stock. Let's use it for something else. Let's go to Coinbase, right? I would click buy. So Coinbase right now is $311 and change. That's kind of expensive. Let's just use a cheaper stock. Let's use BMNR, right? So that's our Ether stock. This, sometimes we have windows left that we had opened before, so I'm just gonna close those, X those out. What I'm gonna do is I'm gonna click on the click on it, right click, because I'm on a Mac. So control click, and I'm gonna click buy, and then it brings up our order entry box. Now I have to make this a little bit. It wasn't visual to see everything, so I think now you guys can see it. So it brings up our order entry system, the same as what it brought up before when we were looking at the Tesla put. It's showing stock though, right? So stock, and it's showing buy, right? I can sell stock, I can buy stock. It's showing how much, plus 100. I can buy 200. Oops. Whoa. I can buy 200. I can buy, 10 shares if I want. I can use this up plus or minus button. But let's say I'm going to buy 100, because anytime you want to sell a covered call, you have to have 100 shares. Why? Because every contract refers to 100 shares of that stock, right? And see how it's blue? If I was selling stock, which we're not going to talk about now, it would be red. So red would be selling, blue or green rather would be buying. There's our quantity. There's our ticker symbol or ticker, BMNR. It's stock. By the way, when we buy stock, usually I buy stock at the market. So that would just fill at whatever the market is last trading. Right now it's $645 and change, almost $46. And then I would hit confirm and send, this button here in the bottom right, right? But let's go back to let's see what our margin is. So we're going to look at, if I have to put up all the money. Actually, BMNR, you have to put up all the money because it's a little bit more aggressive of a stock, right? So analyze, hang on a second, analyze. So this will show you here, unallocated right here, plus 100 BMNR. How much money do I have to put up? I have to put up 4,596. That's because they don't let you have any margin with BMNR. Let's just use a different ticker. Let's use Intel as an, or we used Intel. Who's got a suggestion for a ticker? Anybody want to look at a particular stock? I'm happy to look at what you guys might be interested in. Let's see if anybody's going to answer. In the meantime, in the interest of time, I'm just going to choose Google, right? Everybody knows Google. Google's a solid company. It's been around a super long time. It's a powerhouse, right? I'm going to click on here on the price, and it brings up my window here. Let me just make it bigger so you guys can see it. Whoops. There we go. Stock buy 100 shares of Google. And I'm going to just choose the market. Right now it's trading at what? $212 and some change. I'm going to analyze the trade because I want to see how much margin I need for this particular trade. And let me put this back here. Let me close this, and it brings up my window at the bottom, right? So let's just check it, right? So stock buying 100 shares. What's our symbol? Our symbol's Google, right? What's the price? And then I'm going to click right here, and that will show you, I think you guys can still see the bottom of my screen, what the margin is. So 6,374, that's the margin. So let's calculate that a couple of different ways, right? Now, if I already have the stock and I sell a covered call against it, let's just kind of go over what covered calls are first before we go through the steps of actually looking at the trade. You already have the stock, or you buy it and then you sell a call against it right afterward. How does that work? You get paid a premium, right? In exchange for agreeing to sell your shares at a specific price, but only if it goes higher than that price. So let's give you an example. I'm going to buy 100 shares of Google right now at $212.50, right? I'm going to put up $6,300 because I want to use some of the bank's money. And then right afterward, I'm going to sell a call against that stock, a covered call, because I already have the stock, right? So sometimes I say the word covered, sometimes it's just assumed, but it's a covered call. I choose the strike price, right? So the strikes are down the middle. Now for calls, we're going to look at the left side. So earlier when we were looking at puts, we looked at the right side. Now we're going to look at the left side, right? I'm going to look at the same date. I'm going to look at September 5, which is next Friday. And I'm going to look at some of these strikes, and let's take a look at see how they look. Well, guess what? If I pay 212.50, 53, I can sell a 212.50 call. I'm always only going to sell a call with a strike price higher than what I paid for those shares, right? We talked about that yesterday, but I'm going to explain again what the reason for that is. I never want to lose money, right? So the name of the game in options trading, particularly selling options, the way we're talking about in this session, is we're always creating realized gains from week to week, maybe day to day, week to week. Why realized gains? Because we want to spend that money and be able to live an amazing lifestyle. We don't want to buy stock and hope and pray that it goes up and then have to sell our stock to be able to take the money out. No, we're not doing that. We want to create income. How do we do that? We sell puts and we sell covered calls. So let's say we're looking at this and I'm going to buy 100 shares at 212.56. I personally am going to sell a $215 call that expires next week, or maybe even this Friday. I'm not going to do a 212.50 because I'm going to pay 212.55. You could if you wanted to, but I never want to lose money. So I'm going to do the next number that's over that, right? Could you, if you wanted to, choose a higher number? Could you choose 217.50? Could you choose 220? Absolutely, you can. Listen, guys, you are the driver. You pick the stock, you pick the strike price, you pick the expiration date. This is your world. We're just living in it, right? You make all those choices. Now, how do those numbers like compare to one another? Well, I mean, if I choose 215, where did that last trade? That last traded at 333. Any spiritual folks in there? What does 333 mean? That's kind of cool. So that means I would get paid $333. If I wanted to go higher and I wanted to choose a $220 expiration date, remember the stock has to move a little bit more to get there. So is it more or less likely to do that? It's less likely, right? Because it's got to go more, it's got to go up more. So your price is not going to be as much. So this one is $167. Let's say I sell Google and I love that stock and I want to keep it and I want to make some money because I want to like rent it out to people and make some income, let's say, but I kind of don't want to part with my shares. Maybe I'll sell a $230 call. And there's only a 9% likelihood that it's going to go from where it is now, 212 to 230 between now and next Friday. So it's a little bit less likely. What does that mean? It means I don't get paid as much money. Now I'm only making 45 bucks, right? So you see the relation as you start to trade and you start to like look at trades, put trades in, it will become more familiar to you. It's kind of like, it's like anything. Once you get the hang of it, like when I walk to the gym in the morning, I don't have to take out like Google Maps to figure out which direction I'm walking because I just keep doing it over and over again. I know I'm going to go down this road. I'm going to take a left over here. It's going to be on the left side, 1 block down, blah, blah, blah. This is the same thing. Once you get the hang of it, it will start like becoming more easy for you to identify different things. Now let's go through the rate of return, right? Let's walk through just like we did with the puts. So puts and calls are very similar in the steps that we do. Let's walk through that. I'm going to buy 100 shares at 212 and 45 cents now, which would be kind of cool because listen, if I buy 100 shares at 212.45, I'm going to sell a 212.50 call because it's like a little bit over. And for that one, I'm going to get paid $455. So let's go through that. So my margin is 63.74, right? Where's my calculator? I'm going to get paid, let's see, because I don't care about making money. I mean, your strategy might be different. I'm telling you what works for me, guys. I don't care about making money on the stock. I want to make money on the premium. That's my realized gain. I don't care if I buy the stock now and that stock gets called away from me because the following week I'm going to buy another 100 shares. Do I care where the price of the stock is? Not really. It goes up and it goes down and it like chops around. I just trade the same tickers, the same symbols over and over and over again. Later in the presentation, we're going to go through some of that stuff and it's going to start to make more sense. But let's assume right now, because it's under 212.50, I'm going to sell a 212.50 call, right? It's going for $455, right? So I'm going to collect $455. I'm going to divide it by how much margin I have to put up, which is $6,374, right? So how much premium do you take in? How much money do you have to put up to make that trade? That gives you a rate of return, 7%. 7.13 to be precise. But I'm only holding this trade for how many days? I'm looking at the same date as we did for the put. So we already calculated 6 days, right? Today's Thursday, tomorrow's Friday, Monday's a holiday, Tuesday, Wednesday, Thursday, Friday, 6 days. I'm making 7% on my money. I divide by 6 days. I multiply by how many? 252 to get my annualized rate of return. That gives me a rate of return of almost 300%, 299.8%. Now I know this says 2.9, but I'm translating it into a percentage that's going to make sense for you. You're making 300% on your money. You're putting up, or you're receiving, 400 and whatever that number is, because it's changed now, $440 in income. You're putting up $6,000 in margin, and your annualized rate of return is almost 300%. So sometimes I have care in talking about rates of return, particularly when they're in excess of 100%, because for some reason, people are generally like brainwashed from the fact that like you can't make this, or it's not sustainable. It's too good to be true. Like, we grow up as children and we learn these things, and it's these certain things are like programmed into us from our parents and our grandparents and our teachers and our friends and whatever. And one of those things sometimes that's programmed into us is that it's too good to be true. It's not too good to be true. It's just not. You can. Are you going to make 300% on your money on an ongoing basis? Maybe not. Shoot for the moon, hit the stars. That's what I say. But this is your rate of return on this particular trade. And let's talk about the risk. Is Google a risky stock to buy? I don't know. Google. I don't think so. I don't think Google's going to go bankrupt tomorrow. Might the stock come down in price? Let's say we're going to talk about so many things and kind of like really solidify all of this together. Let's say we make that trade. Let's say I have cash in my account. I don't want to start with a put. I want to start with a call. I want to buy 100 shares of Google, and I want to sell a call against it because I want to make, what was that price? $440. I don't remember. I think it was a little bit different a moment ago when we calculated that, but now it's $440. I want to make $440 for the week. And I have 6 grand, 10. Matter of fact, I have 10 grand that I opened an account with. So I have plenty of money to satisfy the margin requirement. And how cool would that be? Let me ask you guys a question. Would you consider that a life-changing like number, right? My question to you guys is, what would be a life-changing number? What would be a lifestyle change for you? Do you have the thought of, okay, well, if I just covered my car payment, on a monthly basis from options, how would that make me feel? How would that make me feel to like know that one bill is paid every single month? My kids' tuition, I don't know, my parking bill, my groceries that I spend every month. I want to go have dinner out with my kids more often than I do. And the reason why I don't do it that often is because it's kind of expensive. And, dinner would cost me X dollars per month, let's say $200 per month. If you can create that type of money using options in a low risk way, how would that change your life? After this session, don't do it now, obviously, because you're listening to me. But after your session, I encourage you to sit down and think about why you're in this class. What drove you to take this class? Why do you want to trade options? It's not for some piece of paper, because that means nothing. It's like, I want freedom. I want to tell my boss to shove it up his whatever. I want to work less hours. I want to retire. I want to spend more time with my kids, or whatever the case might be. I encourage you to spend some time and think about that, because, and I'm not going to talk about too much spiritual stuff in this presentation, because you paid to learn options, right? But there's a definite advantage of visualizing what you want your life to be, and then putting these pieces in place to make it happen, because you for sure can do it. So let's go back to our example. I'm going to buy 100 shares at 212.46. We calculated our rate of return at almost 300% if we use margin. But let's ignore margin for a moment, and let's say we're going to put up all the money, right? So if we're buying 100 shares at 212.45, we'll say, how do we calculate that? 212.45 per share. How many shares are we buying? We're buying 100, right? Why is it 100? Because we have to have 100 in order to make the trade. Every contract has 100 shares. That's $21,245, right? Now, how much money are we making on this trade? 440. 441 now. We're going to say 440. Remember this number, 21,245. 440 divided by 21, I think it was 445. It was something like that. Yeah, 21, I think it was 21,245 actually. 21,245 because it's $212.45 per share, right? So how much money are we making? What's our income? What's our premium? How much money are we putting up? In this scenario, we're putting up all the money because we're not using margin. That gives us a rate of return of 2%, right? But remember, that's only for 6 days, right? We're only holding the contract 6 days. Why? Because we're looking at a September 5th expiration date. Today's Thursday, Friday, Monday is a holiday, the market's closed. Tuesday, Wednesday, Thursday, Friday, 6 days. So I'm going to divide this by 6. And then what am I going to do? I'm going to multiply it by 252. Why 252? Because there's 252 trading days in a year. Now, what does that give us? Guys, that gives us 86%. So what does that mean? Let's put that into English, plain English, right? That means that if I buy 100 shares of Google right now, and I use margin, and I only have to put up $6,300 in my account to make this trade, and then right after I buy the shares, I sell a call right away against it, and I take in $440, right? And that's what I get for like a week and a half. $440 for a week and a half, that's not too shabby on one trade, right? What's the annualized rate of return if I do that and use margin? Almost 87%. Oh, wait, this was not using margin, excuse me. If I'm putting up all the money. If I'm not using, and I'm so sorry, I didn't mean to, hopefully I didn't confuse any of you. We talked about margin before, and it was 300%, nearly 299%. This is not using margin. I have to put up $21,000 to put the trade in, right? I'm buying 100 shares at 212 and change. I'm putting up $21,232 roughly. What's my rate of return? Almost 80%, 87%. That's a pretty good rate of return. What happens to our premium? Do we keep that or does it go away? We always keep the premium. It doesn't matter. Now, one of two things will happen next Friday, right? So Google will be more than 212.50 or lower than 212.50. What does that mean if it's higher than 212.50? That means we're selling our shares at 212.50. That's fine because we paid 212.45. So it doesn't matter. Again, your strategy might be a little bit different. My strategy is I don't really care how much I make on the stock. I care about the premium in my pocket because that is sustaining. That's paying for my lifestyle. But again, you can choose whatever strike. You can choose a different date. I don't know. Let's say you have a 9-to-5 job and you don't want to look at this stuff, as frequently. And by the way, the rule of thumb, once you learn these concepts, or is 8 hours, 10 hours is generally enough to really understand the foundations. Once you understand the foundations, you're probably gonna have to practice a little bit for sure, just like you have to practice anything. But once you get the hang of things, you will literally only need to spend 15, 20 minutes a day looking at this stuff. Let's say you have a 9-to-5 job and you're doing this just for some side money. You want to make enough money to, I don't know, pay your mortgage every month, a couple $1,000 a month. Well, maybe you don't want to look at weekly stuff. You want to look at once a month. So let's look at that. I'm going to buy Google at 212. Now it came down a little bit, 212.26. And I'm going to look at what's today? Today's the 28th of August. So I'm going to look at September 26th. So that's like a month, right? A month. And let's say I do this a month away. Now you'll notice one thing right off the bat. This is a good learning experience. You see the strikes down the middle, right? So before we were looking at a 212.50 strike, but I don't see that here. Holy cow, what the heck happened? Well, different contracts have different things to choose from, right? So because this is a little further away, it might open up. So as time goes on, like in a couple weeks, there might be a contract, but at the moment, we don't have the ability to sell a 212.50 contract. It's not there. If we don't see it there, we cannot trade it. It's not in the market, right? So what would we do instead? We would buy 100 shares at 212. Now it's coming down a little bit, say 212.12. And then what would we do? We'd sell a 215 contract. Now look at the price of that. It's a little bit more expensive. First of all, the strike is a little bit higher, but also the time frame is a little bit longer. If you go a longer time frame, you're going to make a little bit more money, right? So let's use this as an example. Let's see how much money we can make. And you know, this is a month and not a week. And let's see how that works. I don't know why I closed my calculator, but let me reopen that. Let's see, calculator, applications. Okay, so let's say that I'm selling the 215 call and I'm getting paid $607, right? 607. And let's forget about margin and let's just assume that we want to be lower risk and we want to put up all the cash. So if we're buying the shares at 212.16, we have to put up $21,216. I just did that in my head because it was kind of easy. 212.16 times 100, 21,000, or you could use a calculator. I'm taking in $600. I'm putting up 21,000. My rate of return is this, but that's only for a month, right? Because we're looking at September 26th. So that's a month. Now, if it's roughly a month, I'm not gonna calculate days. I just want to get like an estimate, right? If I'm holding it for a month, right? I'm going to multiply, if I'm making 2% per month, I'm going to multiply times 12, right? And that gives me my annualized rate of return. I'm making 34% on my money if I'm not using margin and I'm putting up all the money. So the numbers are a little bit different. And you see, things aren't static. This is why before you make a trade, it's super important to calculate this stuff. Now you can use a calculator. I encourage people to use a spreadsheet. As you start to trade, just keep I don't know, I'm on a Mac, so I usually use numbers, but if you're a PC kind of person, you can use Excel, you can use Google Sheets. You know, you can use a piece of paper, I guess, if you wanted to. But I encourage you guys to keep track of the trades that you're putting in. Keep a log of notes, right? I use Pages for that because I'm on a Mac. If you're a PC person, you might use Word or notes on your phone. Keep track of the thoughts, like why am I doing this? What am I looking at? Because it's helpful, especially as you're learning. I guess we're always lifelong learners, but me, with all the experience I have, I still keep track of that and keep notes and such because it's helpful to reference at a future time. Now, how does that sound? Does that sound like that makes sense? Does that sound like that's something easy to do? Let's walk through MicroStrategy and then we're going to keep going for sure. MicroStrategy, by the way, and again, I don't make any money on recommending one thing or another. And I'm also not giving you financial advice because it's your money. You make the decision. I'm just telling you what I'm doing. But MicroStrategy is like by far one of my favorites. Why? For a couple reasons. Number one, I'm a big believer in Bitcoin. Bitcoin will go up without question over time. Why? Because there's a finite number of coins. So it's like let's say, you know, the air on Earth is limited and you only have so much. Well, what does that do? That drives the prices up. Maybe that was a goofy analogy, but what I'm trying to say is Bitcoin, because there's a finite number of Bitcoin mined, or however you want to use terminology for that, the price will be choppy, but it will always go up. Also, Bitcoin related stocks are volatile. What does that mean when they're volatile? Well, let's look at the implied volatility. We looked at that a little bit yesterday, but let's look at it now. Bitcoin MicroStrategy is $339 per share, and let's look at, let's say, I don't know, a $320 put, right? The volatility is 56%. Sometimes this is actually much higher. Right now, the premium is not even that much. Last November was my rockstar month, and the premiums, man, were like $2,000, $1,000, $2,500. because there was like a lot of volatility. So the more volatility, the more premium you're going to get. The other reason why I like Bitcoin, I like people, honestly, I like disruptors, and I like people that do things that other people say can't be done, shouldn't be done, that kind of thing. Michael Saylor, who runs MicroStrategy, now it's called Strategy. It was they were like a tech company. I don't know much about them before they, became popular from Bitcoin. They were just some tech company that was kind of like a nobody, right? They were a public company, but they were like nobody ever heard of them. And then Michael Saylor gets this idea, hey, Bitcoin's amazing, let's buy a ton of it. And he didn't even use his own money or the firm money. He borrowed money, and he still borrows money and buys Bitcoin with it. So many people will tell you, man, that's risky. Don't be borrowing money. Don't go get a loan at the bank and buy options or sell options with it. Don't go get a loan at the bank and buy stock. Don't go, you know, don't go take out a cash advance on your credit card and then trade with it in the stock market, because that's stupid, right? A lot of people say that. But Michael Saylor showed them, because that's his whole strategy is borrowing money and buying Bitcoin. And he's a gazillionaire. And the stock is a rock star stock. I mean, I don't know where this is a 1-year chart. I remember trading this chart last year, like $100. And I was telling my kids, man, buy MicroStrategy. Man, look at buying MicroStrategy. And then it was like $500, right? And now it's like, 300 and change. So let's look at MicroStrategy. Let's look at selling a put, particularly because you guys are new, you're in this class, in all honesty, like we're talking about a lot of things here, but honestly, like I recommend, as you start, don't buy stock and sell a call against it. The easiest way to start and to learn is to sell a put, because of a couple of reasons. Number one, right, when you sell a put, your money is in cash, so when you buy a stock, you have some fluctuation of that stock, right? Now it's a paper loss or gain as that stock gets volatile, but especially when you're new, you tend to be a little bit more emotional about things. And also, aside from that, if you can drive a rate of return and keep your money in cash and still make money, that's better than buying stock and driving a rate of return, because it just avoids that paper fluctuation. So let's look at a put instead. Yeah. So MicroStrategy right now is 339, just a tiny bit over 339 per share. And let's look at selling a put. What shall we look at? Well, I mean, if we sell a put closest to where it's trading now, like let's say it's 339 right now, and we sold a 337 put, that's the closest one, right? Underneath where it's trading. Now that's going for almost $1,000, 9.94. So almost $1,000, because we're multiplying it by 100, right? And if we go down, as we go down, let's say we sell a 335 put, it's a little bit less money, 875. Let's say we sell a $325 put. Well, we're going further away from where the stock is trading, so we're not going to make as much money, right? So this is, again, there's no black and white. This isn't like a black and white thing. It's like a dance. You're going to find your groove. How likely do you want to buy MicroStrategy? Now, it depends on what your scenario is, right? So let's say you're just starting off. Now, everybody's different in here. And I'm not giving you specific recommendations because I don't know what your situation is. But I want to try to give you like ideas, and you kind of figure out what bucket you fall into. Now, let's say you have an account at I don't know, at Fidelity, right? And you've been having this broker manage your account, and you got some goofy ass mutual funds in there, and now you're learning a different way, a better way from Michelle, and you want to start managing it yourself. And let's say, I'm just using an example. Let's say it's $50,000, right? You could sell like a put closer to the money. So you could say, okay, well, I have just cash. Let's say you sell all those goofy ass mutual funds, and now you got cash, right? And you don't have any stuff. Maybe you want to take on a little bit more risk because you might be okay with buying the shares. So it depends upon the level at which you are willing to buy those shares. Like if you have cash and you know MicroStrategy is a pretty good stock and you wouldn't mind owning it anyway, then you might want to sell it closer to the money put. And why would you do that? Because you're going to get paid more money. So here's the thing, guys. Let's go back to the basics of a put. When I sell a put, I'm committing to buy the stock, but only if it drops below that price before the expiration date. For that commitment, I'm paid a premium, right? It doesn't matter if I have to, like, worst case scenario, if the price goes down, like let's say I sell this put. Let's look at this Friday because I want to look at like short-term gratification. Let's say 338 and change, right? And let's say I want to sell a $335 put that expires this Friday. The price of that is $325. Now it's not as much money as almost 1,000. Why? Because it's different time frame. So this is August 29th before we were looking at September 5th. So you also want to look at, you want to balance that. You want to calculate the rate of return for each one. You want to think, okay, how long do I want to commit for? Do I want to, short term? I think short term is definitely better for, generally speaking, especially when you're new, because it just makes things that much quicker and you're not like locked in for a longer period of time. So we're going to look at this, look at something different if you prefer, but let's go back to here. Now using our example, let's say we sell this, right? And we make 300, right now it's a 335 put, let's say, or actually let's say a 337.50. Because that's the first strike below where it's trading. It's trading at $338 per share. So let's say we do this one because we're okay buying it if we had to buy it. Now, if Friday comes and MicroStrategy is, let's say, $320, now the worst case scenario is we're going to buy those shares. We're going to pay the strike price. So we are going to perhaps have a period of time where we're going to be down money. When we look at our statement, it's going to have a paper loss. Kind of like Bitmine, when I went over, I think yesterday or the day before, I have Bitmine and I'm down like $900. Who cares? I'm still making money on it. It doesn't matter. A paper loss and a loss on your stock is only relevant if you sell your shares. You will only lose money if you sell something for less than what you paid. Don't do that. Don't be in a position to do that. So most people, like, we're going to talk more about margin tomorrow, but just recognize, okay, if let's say in my scenario, I got this 50K with Fidelity in these goofy mutual funds with this financial advisor. I'm going to move it into another account. I'm going to sell a put that's closer to the money. I'm going to sell a put on MicroStrategy. I like Michael Saylor. I like MicroStrategy long term. I'm going to get paid $425. Worst case scenario, if I have to buy the shares, it doesn't matter if the price comes down and I buy the shares, because guess what? Next week, I'm going to sell a call against it. Let's see how much those are going for. And we'll just kind of get a sense of like this dance and how it feels. Right now, the MicroStrategy is 338. So let's say if I look at kind of like an at the money, a $340 call for next week, how much is that trading for? $1,000, 10.28, right? So that's always going to be times 100. So, I mean, obviously as time goes on, this number might go down a little bit because time goes on. Remember, I talked about this before. With options trading, you are in the driver's seat. You choose the stock, you choose the price that you want to pay. If you're selling a put, you choose ahead of time what price are you comfortable buying those shares. Let's go back to MicroStrategy again. It's $338. Let's say, I don't have a lot of money and I'm just starting off and I kind of don't really want to buy the stock that much, but I still want to make some income. Maybe I use a smaller strike price. Maybe I go down to like, I don't know, $310 or 300. Let's say $300. MicroStrategy is 338, but I don't want to buy it at 338. I want to give myself a cushion that it has to come down a bit for me to buy it. Maybe I want to sell a $300 put. How much is that going for? $180. Okay, I'm going to make $180. how likely is it that MicroStrategy is going to go from the price that it is now to 300 between now and next Friday? And remember, Monday, the market's closed, right? There's only 6 days that that's going to happen. 11%. Might it happen? Yeah, but it's not that likely because it's only 11%. Worst case scenario, MicroStrategy goes below 300. I buy those shares and then I'm going to sell a call against it on Monday. Remember, puts and calls are totally different. So I don't want you to confuse that, but that's how you use them together in order to make weekly income, right? So you choose the stock, you choose the price that you want to pay. So we just talked about you choose the price if you're selling a put. How much are you comfortable buying those shares for? Also, conversely, if you're selling a call, how much are you okay like letting your shares go for? Let's say I buy MicroStrategy for 338 and then I want to sell a call against it right away, a 340 call, right? I get paid $1,050. Are you okay with selling your shares at $340? Or do you want to kind of hold on to it a little bit longer? My strategy is I choose strike prices when I'm selling a call that are very close to where I own it for. Why? Because I don't really care about the market appreciation. I care about the premium. I care about realized gain and realized losses. That's it. I really don't care that much about paper losses. That said, I mean, am I happy like when I see my account and it's down? Like right now, as an example, I have a whole bunch of Coinbase that I paid a lot of money for, and then the market came down. Am I happy seeing that? No. Does that make me make a little bit less money from week to week because the price came down and I'm long these shares? Yeah, I'm not making as much money. But guess what, brother? I'm not losing money. So that's the name of the game. Like, I don't want to take a realized loss because taking a realized loss that actually takes cash out of my pocket and burns it in the corner, you know? I don't want to do that. I'm totally fine with a paper loss. And if I don't make as much cash this week, I'm still straight. I'm still good. So yeah, you choose the expiration date. Me personally, I choose 1 week because I want to do week to week. I want to flip my money as much as possible. I just want to keep flipping it. It's kind of like people that flip houses. I don't know. A house? I never did that myself. I've had real estate before, but I never flipped houses. Do they buy a house and sit on it, or do they flip them? If you're a house flipper, you're gonna want to keep flipping it because the more you flip it, the more money you're gonna make. This is the same thing, right? So we kind of went through calculating rate of return. We talked about that. We walked through some examples. Let's talk about order types. Let's see. So when you place a trade, like what kind of order type is there? We touched on it because we looked at, okay, if I'm gonna, I think we were looking at Tesla at the time or Google or whatever it is. If I buy the stock, typically, now there's different order types. There's a market order or a limit order. Typically, when I'm buying or selling stock, I'm doing it at the market, right? And let's talk a little bit now about bid and ask, right? It's not, I always like hesitate sometimes because I don't want to tell people too much information only for the reason of I don't want you to get confused. And sometimes there's certain things that are good to have and you'll learn as you go. But if you learn it too early, it might like confuse you and then it like knocks you off track. So sometimes I don't really like talking about bid and ask, but some people asked about it and it comes up and it's kind of relevant. So I want to talk about that. So basically, I want to keep it super simple. You'll notice in the option, the trading window here, you'll have a bid and an ask. This is for the stock, right? So here's if I buy the stock. What's the bid? What's the ask? What's the last price? And then you're also going to have a bid and an ask for puts on the right. And then you're going to have a bid and an ask for calls on the left. So here's the easiest way to understand that. People are typically selling at the bid, which is going to be the lower number. So if you look at this bid versus the ask, bid is lower. You don't have to, honestly, I don't even remember sometimes what the bid means and what the ask means, and I've been trading for 30 years. Honestly, it's just not that relevant. The bid is the lower number, the ask is the higher number. So you might, if you have a notepad that you're keeping notes, write that down. Bid equals lower number, ask equals higher number. If you don't write it down, it's okay, because you could just look at this. What's the lower number? Bid. What's the higher number? Ask, right? And the way you remember that is people will sell at the bid at the lower number, and people will pay their buying at the higher number, right? That's kind of what that means. And the only time that that's really relevant is when we put in an options order. So I'm going to walk through that now. But before we do that, I want to talk about buying the stock. Typically, when I buy a stock, I'm only looking at big stock. Google, MicroStrategy, I don't know, Tesla, Coinbase, whatever. I'm just going to use Google because it's a big company as an example. It's only a couple cent difference. Like, look at the bid is 212.48, the ask is 212. Well, it flips all the time, 47.49. Typically, there's going to be, like, let's say 2 cents difference. What does that mean? 2 cents difference. It's $2 for every 100 shares. So it's not that much. When I put trades in, I try to be efficient. I don't look at necessarily like, what's the commission on something? We didn't talk at all about commission, but basically when you put a trade in, you're going to pay a commission or a ticket charge, a transaction charge, it might be called. And it's pretty cheap. It's like 50 cents, 50 cents, 51 cents, 60 cents. If you want to be technical about it, it's made up of a fee that the brokerage company charges, and then like the exchange fee is on top of that, like the New York Stock Exchange fee. They kind of have their hand in your pocket a little bit as well, but it's very negligible, right? 50 cents, 60 cents. Somebody had mentioned earlier, I don't know if it was somebody in this group or somebody else, they were talking about like interest rates, I think, interest rates on margin, using margin and paying interest, getting paid interest on the cash you hold in your account. That's also quite negligible. Margin interest can be a little bit more, but I look at things that like affect me, right? Like I look at, I try not to get bogged down in the details. Listen, guys, this can be as easy as you make it or as hard as you make it. Like if you want to like understand all the nitty gritty and nooks and crannies of it, it might take a long time. And is it even that important? You might make, let's say, 100% instead of 99.5% or whatever. Me personally, I don't really fuss about the nitty gritty. That said, when I buy or sell a stock, if I buy 100 shares of stock, like for example, let's say I want to buy some Google now and I want to sell a covered call against it, I'm just going to buy it at the market and I'm going to get filled at the lower number. So I'm prepared to do that. I'm not like going to put in a limit order, which I'll talk about in a moment, and maybe get like 1 penny better on the price. I don't really care about a penny here and a penny there. Like I just don't care about that. Because it just would make my job too difficult, and I don't want to do that. So when I buy stock or when I sell stock, me personally, I buy or sell it at the market. It's whatever the market's trading at. If I put an order in to buy 100 at the market, it's going to fill right around here, maybe within a couple cents or something. Now, if I trade an option, I typically will put in a limit order. And here's what the difference is. A limit just specifies like the worst price that you want to get on the trade, right? So let's go through an example. Let's just stick with Google for now, and let's stick with September 5th. That's the one that we're looking at, right? Google right now is 212.61 per share, right? And let's say we want to sell a put, and let's say we're looking at selling a $205 put, right? That expires next Friday, right? Here's the premium, 158. That's the last price it traded. But there's also going to be a bid and an ask. If I put an order in, if I click on the bid, that's the lower number. You don't have to remember bid versus ask. If I click on the lower number, it's automatically going to fill with an order entry that I'm selling one contract, right? I'm selling one Google September 5th. $205 is the strike price. It's a put, and then it gives me my limit price. if I put an order, and this price is changing with the market because it's live data. If I sell it at the lower price, if I just leave it here and then hit confirm and send, the green button to send my order and get filled, and filled means like executed, right? It's going to automatically fill. And the reason why is because there are already people standing in line to buy at this price. So if I sell it at the lower price, at the bid price, it will get filled right away. Sometimes people will kind of like go in the middle. Okay, the bid is the 155 and the ask right now is 158. Let me try to get an extra dollar, 156, right? Really 155 to 156, it's only $1, literally $1. The challenge with that is it might not fill right away because the market's changing all the time. People are buying, people are selling, these numbers are flipping around. But if you want to make sure that you get into the trade, you would enter the trade at the lower number when you're selling the option, right? Now Google, because it's such a big company, it has a very tight, what we say, tight spread. So the bid and the ask are very close. It's only 2 cents away, 155, 157, right? You see, 155, 157. Maybe we'll wait a few more moments and see if it flips. And it's kind of, it doesn't matter. Who cares about $1? So if you want to enter the trade, put an order in to sell it at 155 and you'll execute right away. If we look at something else, let's say MicroStrategy. MicroStrategy is probably not traded as much as Google. Let's see, and I'm just guessing. I could be totally wrong on that, but I think Google trades probably a little bit more. Let's see, if MicroStrategy right now is 339 and change. If I look at a let's say a 330 put, see how the bid and the ask are a little bit wider, right? 635 and 660, right? So let's say if I wanted to sell a contract, if I put it, if I put the order in at that lower price, it will automatically be filled. Now, best practice when you're selling an option, this might be a little too advanced. So if you don't understand this, it doesn't matter, this part of the presentation that I'm going to say. Some people will pick the mid price and go a little bit lower than the mid price. There's a little bit of math to that though. So to do that, like, it's just more work, right? So 335 to, 635 to 660, what's the mid price? I don't even know, 647, whatever. If I put in a price a little bit lower, I could probably get filled. And what's the end result? The end result is I might end up making like $5 more, $3 more, $10 more, something like that. So that's what I mean. Like if that mid doesn't make a lot of sense, it doesn't much matter. $5, $10. I don't want to say who cares about $5, but yeah, who cares about $5? Kind of like it's a lot of work to calculate that, but it's something that you might want to be aware of. Also, I can and we kind of walked through this already, where the bid and the ask is located on the screen. I can also put in a stop order. We're not going to talk a lot about stop orders because I don't really use them that much. I think it's one of those things. I have used them in the past, and honestly, I shouldn't have probably. I prefer to just buy more and average my price down. A stop order is okay, like let's go back to Google. I buy 100 shares of Google at $212.80. And I think ahead of time, okay, well, I don't want to risk all my money in Google. What if Google goes bankrupt? I don't want to ride it all the way down. I just don't want to do that. So I'm going to put a stop in, let's say at, I don't know, $180. And let's calculate that out. Because some of these basic calculations you're going to want to get the hang of. Let's say I pay $312 or $212 per share, and I only want to risk, I don't know, $3,000 or something. $3,000 would be $30 if the price had to go down $30. So $212.75 minus $30. Maybe I want to put a stop in at $182.75, right? The way I would do that is I would just put an order in, right? So we already have our order entry selling 100 Google. And instead of a limit, I'm going to put a stop order in. right? That means that, once it hits 212.70 or whatever that, I'm sorry, not 212.70, we were using what number? 182.75. I would specify the 180, whoops, 182.75. I would specify the price. I would put it in as a stop order. Now you see market here. The reason for that, and I don't want to get too detailed because this stuff is really not that relevant. Probably won't even be using it, but just to give you an idea of how that would work. If the price goes down to 182.70, then it becomes a market order, and then you'll sell your shares. Now the problem with market order, like stop orders rather, here's what happens. Stocks go like this, right? But they always go kind of like this over time. So do I want to get stopped out, recognize, take a realized loss on that position? Probably not. Me, I don't like taking realized losses, so I don't use stop orders. Yeah, this slide was just, if you don't have stock and you're selling a covered call, you buy the stock, then you sell the call right away. You don't wait a long time. We're going to just kind of skip through that. That's not all that relevant. You definitely want to check your fill after. So you want to get in the habit of looking at your brokerage transactions. Like this was a trade I did yesterday. I was short a MicroStrategy call. It was a covered call, and I bought it back. And the reason that I bought it back is I often, you don't have to. Remember, when you have a trade, you can do one of two things. You can wait until it expires, and then it will expire more or less than your strike price, right? Or you can liquidate your trade. And when you liquidate your trade, you're buying it back. The reason why you're buying it back is because I'm short a put, I sell a put. That means I have -1 as a quantity. I'm short a put, then I buy it back to close my position, right? I bought it back for $6 because MicroStrategy, I think yesterday was down. Where's MicroStrategy today? It's still down a tiny bit. I look at it like I never really care about $5, $6, $10, $20. Because sometimes what happens is I can buy it back, and then tomorrow, if there's like a big up day, let's say MicroStrategy is up 5%, 10%, I could sell another one for next week or something and make more money. So that's a little bit more advanced. It's a little more actively trading. But that's why I personally will buy and sell stuff a little bit more frequently, but you don't have to. We kind of talked about some of this stuff. Let's talk about closing your positions early and reading your positions. This, I think you guys can see this, right? I'm gonna make this a little bit bigger for me. This is just a couple examples that I wanted to go through that I kind of screenshotted from my account that I wanted to just walk through and make sure you guys understand what you're looking at, right? Now, this is with Schwab, but if you trade with somebody different, it's going to look a little bit different. And also you can customize oftentimes these columns. You can put more info in, you could take info out, you can like move columns around, but I like to see it like this. What's the symbol? What's the stock that I'm talking about? What's the quantity, right? So remember, when we're long shares, it won't have a plus, but it will assume a plus. And when you're short a call or a put for that matter, it will say minus, -1, -2, however many contracts you might have. Your cost basis, cost per share, that's how much you paid for your stuff, right? Your stock, or how much you also received in premium. So let me go through some of this and kind of explain to you what this means. BMNR, that's the Bitmine that we looked at the other day. Let's just look at this for now. Coin I was going to talk about afterwards, so we'll talk about that if there's time. But Bitmine, for example, I have 100 shares of Bitmine. What's my cost basis? How much do I own the stocks for? We talked about this the other day. A little less than $57, right? How much is the price now? It came down a lot, right? $46. I keep track of like day change, percent, day change, dollar. Again, you can customize these columns. How much am I losing right now? Like, what am I down right now on this position? Yesterday it was down like $900. Today's down $1,000. Why? Because it's come down more. Am I freaking out over this? No, I'm not. And also, If I look at the call, for example, I have an 829, that's tomorrow, a $59 call, right? When might I liquidate my position and put a different position on? I can buy this back right now at $5. Let's walk through this. So I am short a $59 call, right? I sold a $59 call. I got paid $159 for that contract. Now that money I keep no matter what happens. The price, this is the market price right here, this column. So that's the price at which I can buy this contract back, and I would have to pay that. Well, I might want to do that because right now I'm 95% realized of my trade, of the income. So in other words, I originally sold the contract and I got paid $159. I might want to buy it back for $5. Where's Bitmine today? Well, it's kind of flat. It's like down 0.3%. If I wanted to, let's say Will was talking about Monday being a holiday. So let's say if I wanted to, I can buy this back for $5 and I can sell another one for next Friday. Because as time goes on, it's going to minimize. Will was talking about the time value being eroded, right? That was a good point. As time goes on, it reduces the values. And today's Thursday. Maybe I want to do that. I don't know. Let's see how much money it would be, right? So $59 call for September 5th. That's going for not much. 25 bid, 40 ask, $30 last trade. It's not that much money, so I wouldn't do it. I don't really care about 20 bucks, 30 bucks. I'd rather not be short a call, and maybe tomorrow the price pops up a lot, and then this might be, $100 or something like that. But looking at what you have and looking at sort of opportunities that you might want to do just helps you understand, okay, well, I could do that if I wanted to, right? So that's why I put that on this screen. Before today ends, I want to go over something that I haven't gone over before. And I have this on the screen, Coinbase. So right now, this is a screenshot from my account. I have 400 shares of Coinbase, right? So 400 shares, when I look at this will show me my average cost per share. But the truth is, I bought 100 at one price, 100 at a different price, 100 at a different price. But this shows me my average, right? We talked about averaging down our shares. And then the price is currently where it is. So I'm down a lot, actually, almost $25,000 in Coinbase. Am I freaking out? No, I'm not freaking out because I recognize things go like this. Listen, if you put money in and you're expecting your account to just like always like show positive, like from a paper side, or you expect success 100% of the time, it's just not realistic. Like I said, you can make a lot of mistakes and you can be down money for temporary times, especially if it's paper loss. It doesn't really matter. The only time that this would matter, honestly, is if I needed to access some of this money. Then if I don't have a lot of cash in my account, I need to access some money, then okay. It's not great having a paper loss, right? But if you don't have to access the money and you're not taking on too much leverage, you don't have too much margin, it's not a big deal. Now I want to clarify a couple things. I want to go through a couple things that I haven't talked about. So because I have 400 shares, right? 400 shares, you want to look at your lot details. And what that means is this. I bought 100 shares at 323. Then I bought 100 shares at 330. Then I bought 100 shares at 405. So you see that's kind of, if you added all these up and then divide by 4, that's how you get that price, that average price of 374.11. I won't take the time to do it now to illustrate it, but that's how you derive that number. Very similar to what we talked about yesterday when you're averaging down your price. I buy 100 shares at $100. I buy 100 shares at 90. Now I have 200 shares at 95, right? So there's a mathematical calculation for that, and that we went through yesterday. So, but let's go back to the important piece that I didn't talk about yet in this presentation. Now I can do one of a couple things. I can sell four covered calls at, let's say, 375, right? Because I own 400 shares at $374 and change. Or I can sell one call. See how I'm short one call, a 325 call? The reason I'm short a 325 call is because I have 100 shares that I bought at 323, right? The reason I'm short one call with a strike price of 332.50 is because I have 100 shares that I bought at 330.01, right? You guys see how that makes sense? Now, if and when Coinbase right now is trading a bit lower, right? But 311 and change. But let's say Coinbase trades or closes at 325. What's going to happen? I'm going to have 100 shares go, and I'm going to call my broker and say, hey, those 100 shares that got assigned from that $325 call, I want to tag those to the shares that I bought on August 1 that I paid $323.81 for. You follow me? And the reason why you need to understand this is because of this. We're not going to talk a lot about this on this session, but if I sell something, let's say I get these shares assigned 325, right? And instead of using this lot of shares that I bought, this 323 basis lot, I use this one, right? Two things is going to happen. Number one, I'm going to create myself a realized loss. Number one, that means I bought the shares for 330 and then I'm going to sell them for 325. First of all, right off the bat, what have I been talking about all week? I don't want to do that. I don't want to ever create myself a realized loss, number one. Number two, it becomes a very messy accounting problem when you sell something for a loss and then you rebuy something. That's called a wash sale. Anybody in the class here know what a wash sale is, or ever heard of a wash sale before? Just give me like a thumbs up if you've ever heard of a wash sale. Maybe nobody. And that's totally okay. I'm going to talk about it briefly, and then I'm going to tell you why you don't ever want that to happen. A wash sale is when you have a stock or whatever, could be an options contract as well, but it's typically a stock. It's when you have a stock, you sell it and take a realized loss, and then you rebuy it again within 30 days. And it's basically an accounting measure that the IRS says you can't take a tax loss for that. Like we're not going to count that. We're not going to include it. We're going to like treat it a little bit differently. And the reason behind that, the reasoning kind of makes sense. So the reason is like the IRS doesn't want people trading stuff and like doing it in such an accounting way where they get to, minimize their taxes. So that's kind of like the short answer. The additional context to a wash sale and the reason why you don't want that to happen is because you see how I have right now 400 shares and I have 100 shares at 323 and 100 shares at 330 and 100 at 405 and 100 at 437. If I was to sell 100 shares at a loss, these numbers are going to change. The broker dealer is automatically going to adjust my cost basis. And honestly, it gets super messy and it gets confusing. And it gets like very hard to track. And I don't want to do stuff that's a pain in the ass to do. I want to do, listen, guys, and I know I said this before, but I'm going to say it again. I want to do stuff that's easy. I don't want to spend all day looking at my computer screen, calculating shit on a calculator, figuring stuff out. You know what I want to do? I want to do stuff that's important to me, right? I want to go to the gym. I want to work on my programming stuff. Lately, I've been doing tons of YouTube videos, and that takes a little bit of time, like creating thumbnails and whatever, putting that online. Next week, I'm going to fly to LA, and I'm going to go hang out with my kids for a few weeks. And we're probably going to go to Six Flags, go to the beach, hang out by the pool. Like the reason I trade options for two reasons, not just one. I trade options because I need money to live, right? Don't we all need cash to live? Like pay for our financial obligations. But secondarily, and probably equally as important, is I trade options because I want to have the lifestyle I want to have. I don't want to be tied to my computer. So I don't want to have difficult things that hurts my head that I can't keep track of. Because, the fact is, I mean, I consider myself smart, but the fact is I'm not some savant. I'm not some like PhD math whiz or something like that. And I'm telling you that for a couple of reasons. Number one, I'm telling you that because I want to encourage you to know that if I could do it, you could do it. Number one. And number two, I'm just sharing with you how I do it. Like I don't want to make things too complicated. So here's how I do it, right? I do it. This is like a best practice, I think. I have 400 shares of coin. I bought them at a variety of different prices. The lot that I paid 323, I'm gonna sell a 325 call. Why? Because I don't really care about the share appreciation. I just want to make income, right? The one that I have now, I sold for 400 bucks. The 332.50, I sold that for 300. I might, depending on coin, where's coin today? Is it down or up? Coin is up slightly. I might buy these back. So for example, this particular contract, the 332.50, this was, I think, yesterday I put this slide in. I could buy it back for $24. Let's see what it is now. It's on August 29th. 332.50. See how I have like these red things over here? That means I already have a position there. So 332.50, I could buy this back for like, 18 bucks or something like that. And then I could, if I wanted to, sell one for next week. Let's see what the price is trading for. A 332.50, right? 332.50. Not that much. I mean, a couple $100. Last trade at $224, right? I might do that. I'm gonna see how the end of the day kind of shakes out. Sometimes I do that, sometimes I don't. I try to get on Coinbase, it's better to get like $300-400 in premium, $500 maybe. But $200 is not shabby either. And the reason why the premium is lower is because the price has come down. Like let's look at a Coinbase chart, right? So I bought some Coinbase up here when it was high, and then it kind of dipped down, right? But I'm not freaking out over it. It's totally fine. I recognize that over the past couple weeks, I haven't made that much money in Coinbase, but I still made money and I did not take a loss. And that's like the name of the game. And that's what makes my life, my lifestyle sustainable. Don't take a realized loss, take an income from week to week. And yeah, there's a few ways that I can manage this position actually. So right now I have 400 shares, like I said, with an average price of 374, and I'm tagging, I'm selling one contract for this lot, one contract for this lot. Let's say as time goes on, depending on if I really want to get out of Coinbase, I recognize that, it's too much risk for my portfolio. I could just sell 4 375 calls, because my average price is 374, or I could also sell 4, I don't know, 370 calls and take a little bit of a loss. There's a lot of flexibility, and a lot of that stuff is kind of beyond the scope of this class because it's more like, gray and dancing and not those black and white fundamentals. But I could do that. In fact, let's see what a 375 call is going for. 375 call. It's not going for much money. Like, I'm not going to put a trade in for $20. I'm just not going to do that. Because it's not enough money. If this stock pops, like last week, it went up. I don't know. There was a day last week that all crypto was up like 10%, I think. I think it was here, this day right here. So it doesn't, take much for crypto to pop. So, hey guys, Michelle here. I'm just gonna pause the video for a quick moment and remind you to subscribe to my channel if you haven't already done that. This channel is all about options trading, helping people just like you, selling puts, selling covered calls, walking through different tickers. The link is below. Thanks again. Let's jump right back in. Oh, welcome back to day 5. Thank you for the love. I am so excited excuse me, to wrap up our session today. We had four, what I believe to be amazing days talking about options, right? Selling puts, selling calls, and being able to empower yourself with this knowledge in order to change your life. So today, day 5, what we're going to do is we're going to put it all together. We're going to fit all the puzzle pieces together. We're going to review what we've learned so far. What are puts? What are calls? How do they work? How do we wrap all of that together? We're also going to talk about a couple new things today to wrap up our session. We're going to go over margin, right? Some of you might be using margin, others might not be using margin, and that's totally okay. We're going to talk exactly how that works, some pitfalls that you want to be aware of if you do use margin, because that's really the way that most traders lose money, is not understanding margin. So I want to make sure to illustrate kind of how that works so you guys can make smarter choices and be prepared moving forward as you guys enter trades. We're also going to talk about how to open an account, right? Because I want you guys to be able to have the specific knowledge to be able to, if you wanted to, Monday morning or over the weekend, go ahead and open an account with a brokerage firm, put a trade in if you believe that you're ready. Keep in mind, you can also paper trade. So that's really important. We talked about paper trading a little bit throughout the session. And basically what that is it's kind of like practice. It's like practice money that we get to use before we use our real money. And the advantage of that is because maybe you want to get your feet wet with how to sell a put, how to sell a call, how to buy stock, how do you actually enter the trade. We're going to go over more of that today. We did do that, some of that yesterday, but we're going to go over more of that today so you guys are become more familiar with that. I want to talk a little bit about margin, and then also where to go, right? We can come back to this. We're going to wrap up that after. Margin is kind of like borrowing money from the bank, right? So if I buy a house and it's 500 grand, I don't have 500K to buy the house for. I put down a deposit, let's say 100K, the bank floats me the rest, right? So that's kind of how margin works. It depends on who you're trading with, right? And it also depends on what stocks they are. And also margin can change and does change. Like maybe margin starts off at, let's say you need 30% to put up, but something happens in the stock market and that stock gets super swingy, super volatile. And now instead of 30%, it's 40%, right? So that's something to keep in mind. There's a couple different kinds of margin when we talk about margin. And I'll give you the preview to margin is this. Margin is really hard to understand. It really is. And it's hard to understand for me. And I've been doing this for like 30 years. It's very like mathematical, right? It's not like, I pulled up my calculator and I was calculating rates of return and it's super easy. Margin is more involved. But to give you some basics behind margin, there's two different kinds of margin that you can have. You can have like what's called regulation T, Reg T margin, and that's kind of similar from one broker to another. That just means like, if I buy 100 shares of Apple stock, I have to put up 30%, on average, that kind of thing. Also, some broker dealers, not all of them, but lots of them offer what's called portfolio margin. So that will give you more juice, more leverage, right? Typically, portfolio margin is only for bigger accounts. Let's say, I don't know, 150K, 250K, or something like that. And it's like this black box calculation. So it's kind of like, how do you calculate that? Oh, I don't know. We can't tell you our secret. That's kind of like what the brokerages tell you. So typically, I have in the past used portfolio margin, and I don't like it because it's confusing and it's hard to track. So I like stuff that's trackable, like Reg T margin, and I can calculate, okay, if I buy this stock, I'm going to put up 30%. If I sell this put, I have to put up about 25% of what I would need if I had to buy the stock, right? There are no, I think I have this in, well, I want to hold that thought for a moment. the easiest way to check how much margin you need before you place a trade is if you just check the margin, right? So like we did this before, but we're going to do it again. Let's say Mara as an example. Mara is 16 bucks a share, right? Let's look at a $15 put for next week, right? So Mara, how do we find the strike? We go down the middle, right? And then we go over here. So let's say I wanted to sell a $15 put. The price right now is $16. I'm just going to fill up this window. So this window says I'm selling one Mara $15 put. The price right now is 16 bucks. And I'm going to right click and I'm going to click Analyze Trade. So this is the way Schwab does it. Think or Swim. Interactive Brokerage is going to do it slightly different. Here, this is going to tell you what your margin is. So the margin requirement on Mara, if I had to buy all the shares, right, and I didn't use margin, how much would I need if I was selling a $15 put? Well, you'd need $1,500, right? Because each contract is 100 shares. So, but if I want to use margin, Schwab is telling me I can get about half. So I have to put up $729, right? So let's calculate this premium since we got it open. What was I making? I think it was like 16 bucks, right? Yeah, 16 bucks. So Mara is $16 per share. If I sell a $15 put that expires next week, September 5, I'm gonna make 16 bucks, right? How much am I gonna put up in margin? I'm gonna put up 730 bucks. I'm gonna do the income I make, $16 divided by 730. I'm just rounding it off, okay? 2%. Huh, that's pretty good, right? 2%, but it's only for a week, right? Today's Friday. This is for next Friday, so it's 1 week. So I'm going to do what? Multiply by 52. This gives us our annualized return, 113%. Well, not too shabby. You see how you can make 100% pretty easily? This isn't rocket science. Like options trading is not rocket science. The people that talk about options is risky, blah, blah, blah. I don't know. Maybe they bought a bunch of options. And of course that was risky and that's a sucker gamble, right? Or maybe you sold some naked calls and that's super aggressive. I mean, it depends on how you're doing it, right? Let's say if I have to put up all the money and I don't want to use margin, I'm making 16 bucks. I'm putting up 1,500 because I'm selling a $15 put. I'm making a little more than 1%. But again, that's for 1 week. So I'm going to multiply by 52. So worst case scenario, guys, worst case scenario, I'm making 55% of my money. So like, you know, when Wall Street tells you, you know, to be happy with your 12% and kiss your broker's feet, no, there's a better way. Yeah. Briefly on what you look at when you're using margin. So different brokers will call it something different, but in Schwab, as an example, it's going to be called available funds for trading. So available funds for trading or option buying power. It's kind of the same with Schwab, or similar rather. And that's kind of like the cushion that you have, because here's the thing. Like, let's say if I have a $10,000 account and I sell a put on Tesla, the margin on Tesla might be like $9,000. So I might have enough money to make that trade, but as the price, or if the price comes down, it could make my account undercapitalized, which means that's long story short, it's like where a margin call comes from. Margin call means like you don't have enough money to sustain your position. So that's kind of like the one thing that you want to look at relative to when you're trading margin, right? Now, think of it like this. This is like a kind of a good slide because margin is kind of confusing, or can be confusing, and there's a lot of different pieces, and it's not like a simple 1 + 1 = 2 calculation. It's very involved. Because as the price comes down, your overall account value comes down, but the margin requirement comes down, but not as fast. So I know that sounds super confusing. That's what I'm talking about. It's not this easy static formula, but if you think of it as space left in a glass, right? So here's my glass of water, right? So it's about halfway full, right? If your glass is all the way empty, that means you have lots of cushion. You're not using margin, right? If your glass is halfway full, you have like half cushion. As your stocks come down, or if they start to come down in price, your think of it like this: your account will go from halfway full to like 3/4 of the way full, because your cushion is shrinking, right? And then what happens if you don't have enough money in your account and you're taking on too many positions? If your account starts to like overflow, think of a glass overflowing with water, it means you don't have any cushion left. That's what creates a margin call. Now, what is a margin call? I mean, probably some of you heard of a margin call, right? But basically, that's just that just means that you don't have enough money in your account to support the positions that you have. And you have one of two options in the case of a margin call. You either have to put more money in, or you have to liquidate something, and typically if your stocks are coming down, that means if you liquidate something, you're probably going to take a loss on that. And if you do that, it becomes a realized loss. Now, remember, realized losses like actually hit your pocket, right? So we want to try to avoid taking realized losses as much as possible. Now, sometimes people will ask, well, how does that work if I want to put more money in? Do I have to have money right away? Does the broker like ring me up and tell me? Do they give me a certain period of time? I mean, there's no real exact figure. I mean, typically, like the rule of thumb, like Schwab, I think typically gives you 2 days. However, there's always a caveat. They have the permission ability to just liquidate your trade as soon as you become you enter a margin call territory, right? So they say that they call you and you have 2 days, but that's not necessarily correct. It depends on, if the margin's going down. Here's the thing. A brokerage firm never wants to be in a position where you have to owe them money, right? They don't want to have to collect on customers. So they want to make sure you have enough money in your account. So they will typically be able to break your trade right then, free up your cash. That way it avoids you getting more in the hole, right? If that sounds like it makes sense. Now, like I said, an empty glass, if you're not using margin, that means you have 100% cushion. You will never be forced to liquidate a trade. Here's what I mean by that. Let's go back to MicroStrategy as an example. Let's say you sell a $300 put in MicroStrategy, right? A $300 put means that you, if you don't use margin, that means you have to have $30,000 in your account, right? That just means if you're not using margin, if you have an account that's $30,000 and you sell a put, a $300 put on MicroStrategy, no matter where that stock goes, you will never encounter a margin call because you already have the money up, right? So that's what that means. So that's why, there's definitely lower risk when you're not using margin, because then you're never going to be forced to have to liquidate a trade. And that's the only time that you lose money, is if you have to buy something back or sell shares and make less than what you got for it, or take in less than what you paid for something. That's the only time that you lock in a loss. I want to talk about a couple things. Here's a good slide, right? So it's important to have some sort of an idea if you're using margin. Now, listen, I have to be honest with you guys. I've been trading a really long time and I have made shit tons of money, and a few times I have lost shit tons of money. And I will tell you that the only time that I lost significant amounts of money were the times that I was over leveraged. I was taking too much. My account size wasn't big enough for the positions that I had, right? And stuff comes down, or maybe it comes down super quick and you didn't anticipate it. Now you have to liquidate things, and it creates a realized loss. I cannot stress that enough. Learn from my mistakes, right? That's why I tell my kids, please learn from my mistakes. That is probably the biggest and maybe the only mistake, like the only big one for sure, that I've made trading. Sometimes I lose a couple dollars here and there. It's like inconsequential, insignificant, but big drops. You want to simulate stock price drops. And what that means is this. You want to understand where a margin call would be triggered. Now, if you have a whole bunch of money somewhere else, it's not as important, right? So like, if you have stuff here, stuff here, stuff here, maybe it's not that as important. But if you're using margin and you don't have this chunk of money somewhere else to infuse into your account, if you need to, then you want to understand, okay, if I have Tesla and MicroStrategy and Coinbase, and those three stocks go down 10% this week, will that create a margin call? Because if it does, that means I'm going to have to liquidate something and I'm going to have to lose money. Now, I can tell you, this is interesting. I have been trading years and I've worked with lots of different broker dealers. I have never encountered a broker dealer that gives you that information. It's crazy to me, right? So like the past couple of years, I've mentioned this before. I don't know if it was on this call, maybe other videos. I used to pay these programmers. Maybe I started, I think, like 5 years ago. Hey, I want to create some mathematics because a lot of this stuff is mathematics, right? Listen, the world is mathematics. Let's look at like car insurance. Okay, what does the car insurance company do? They calculate their premium based on the likelihood that you're going to have an accident. And they use like, how old are you? What's your driving record? Where do you live? What kind of car do you drive? Life insurance. How old are you? Do you have a bunch of medical problems? What's the family history that you have? And their intention is they want to take in a little bit more money than what they pay out, right? That's what insurance companies do. I want to do the same thing. I want to take in pieces of money and then I only want to pay out a little bit. So if I'm selling puts, I don't want to buy the stock often. All things being equal, I'd rather not buy the stock because I'd rather keep my money in cash and generate income for myself, right? So what I'm saying is the world is mathematical, right? And for some reason I've never seen a broker dealer offer that. Well, why not? Like that's so important. Why don't they offer that? They don't offer that because the game is rigged. Anyway, like 5 years ago, I started like paying these programmers. Okay, I want to create this program, the spreadsheet to automatically calculate. Here's my positions as an example. If my stuff goes down X%, I want it to be flexible. I want to input some simulations. If Tesla goes down 5% and a MicroStrategy goes down 10%, what does that do to my account? Does that produce a margin call? For some reason, I spent a lot of money over the past few years, and I never was able to create this thing that I wanted to create. So I would say like maybe a handful of months ago, 3 months ago, I was like, you know what? If I want something and I can't find it, and I'm having trouble paying somebody else to create it for me, guess what? I'm gonna do that shit myself. And so now I'm spending like all my time. This week I was putting together the content for this program. But aside from that, and now after today, after this program is done, I'm going to be spending like all my time finishing that and rolling that out. Because I think that is so important. That's like the only time I've ever lost money. It's like, it's so important. So, I mean, I have spreadsheets that I use, but they're kind of like manual. Like I have to put this in or I have to put that in. So I'm creating these programs to automatically do that for you, which is kind of cool. But I do want to talk about next steps because I want you guys to have actionable things in order to open an account on Monday if you wanted to, right? So let's talk briefly about brokerage firms, right? So I kind of mentioned some of these before. There's lots of different broker dealers out there, right? This is just a list of a handful of them. There's certain things that you want to look for when you look at who do you want to work with. Customer service for me is typically number one. I want to, if I call them at 7 p.m., are they going to pick up? Are they going to be rude to me like interactive brokers? How are they going to talk to me? Do I have to wait on hold for a really long time? That kind of thing. So that's something that you want to consider when figuring out who you want to trade through. You want to look at fees, but also honestly, like a lot of these companies have similar fees. Like when I sell a put, I think my transaction charge is like 51 cents or something like that. It's negligible. So I don't fuss over the, dollar here, dollar there, but maybe that's something that's important to you. Maybe you want to look at their platform. Thinkorswim is kind of easy to use. Interactive Brokers is kind of easy to use. Tasty is kind of easy to use. I was using Tradier for a while, and then I realized that they don't actually show you ahead of time what the margin is before you put a trade in. And I thought I was missing something at first, and I called them up. And I was like, what am I missing? I can't see like what's the margin required. And they're like, we don't put that on there. And I'm like, why wouldn't you put that on there? Doesn't everybody want to see what the margin is before you put a trade in? If you're using margin. So you want to kind of like get a sense of how the platform works. Is it important for you to trade, on your phone? Me, I don't trade on my phone. But maybe that's important to you. Performance reports. I forget what it was. I think it's Tasty. I was with Tasty for a while, and they're pretty easy, right? Super easy to put a trade in, very user friendly, like beginner friendly, but they don't offer any performance reports at all. All right. So you have to kind of, I don't know if that's the same now, but I know a few years ago that's how it was. So you got to keep track of a lot more stuff yourself. So that maybe that's something that you want to evaluate. Margin rates, if you're using margin, how much are you paying for that? I think my margin rate, I don't really pay attention to that. 12%, I think, which sounds high. But if I'm making 100% per year, I'm okay with that. You know what I mean? It's like Michael Saylor, right? Everybody says don't borrow money and then trade with it. Michael Saylor showed all those guys, right? Like, what does he do? He borrows oodles of money and buys Bitcoin with it because he knows long term Bitcoin goes up. And now he's a billionaire. So, yeah. It's an online process typically. So, really, you're online, you're going to put your info in, your name, your date of birth, blah, blah, blah. They are going to ask you your annual income. Sometimes options might be only available, like you might have, and I would encourage you to check this, as you're opening an account or something, or before you open an account. Is there a required minimum annual income or minimum net worth in order to trade options? There could be. Like it could be, you have to make, I don't know, 25,000, 50,000 a year or something like that. Usually you'll see that kind of information on their website, or you can call them and ask them. Experience level is similar. So like oftentimes, and that's like the one thing that kind of trips people up when they open an account is everybody asks you like, how much experience do you have trading stocks? It's one of the questions when you open an account. 0 to 5 years, 5 to 10 years, that kind of thing. How much experience do you have trading options? So I think typically if you put 0, you might not be able to have margin, or maybe you can't sell a put even. Maybe you have, or maybe you can only sell a cash secured put or covered call or something like that. Or if you have 0 experience, they might have some like little class that you take online to increase that level. So that's something that you want to be aware of, and that's going to be different from one broker to another, right? You want to make sure what the minimum requirements are. Like maybe you have to have, $10,000 in your account to use margin, or 5,000 or whatever. So again, it depends from broker to broker. You want to have live data. So don't oh man, a while ago I was teaching somebody. I don't teach anybody one-on-one anymore because it just takes way too much time. But I had done that. Mostly it was for friends of mine though, really. And she was doing all this trading and she didn't have any live data. I'm like, why? You're crazy. Like yeah, it's free anyway. So why wouldn't you have live data? It's goofy, but make sure you have it. Always check your transactions on a regular basis. And I'm going to tell you why, right? And I know I got some questions. I'm going to go through the questions as well, but I'm going to tell you that brokerages make mistakes. And I could say from time to time, but I would actually say they make more mistakes than you think they might make mistakes. It's kind of like, why do you want to balance your checkbook? Because sometimes the bank makes a mistake. You think that they don't, but they actually do. And I put this stuff together. I did this actually right before this class because I was like, oh, I want to give some like juicy stuff to people. I'm always like kind of picking on Wall Street. Listen, I don't want to say I worked on Wall Street, but I worked for broker dealers before. I was an investment advisor. I had my own brokerage firm, financial firm. I had my own hedge funds that I was running. So I know what the industry and how the industry behaves. And a lot of this stuff people just don't know, because you know why? Wall Street doesn't want to tell you. I mean, just go to brokercheck.finra.com and like as an example, Schwab, I just put the big ones here. Schwab, Interactive Brokers, E-Trade, right? How many disclosures do they have, right? What is a disclosure? Disclosures is like they got slapped on the wrist. The SEC said, you know what, you're doing something wrong. You got to stop doing that and here, pony up a fine. Or they got sued by somebody or something like that. What I'm saying is they make way more mistakes than you think they make, number one. And number two, I encourage you, I don't want anybody to spend a whole week of your time and I give you all this amazing stuff. And then, like, let's say next week you're talking to your neighbor, and then your neighbor's like, oh my gosh, options are so risky. I heard on CNN, blah, 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 blah. Wall Street wants you to be dependent on them. I guarantee you. We went through a couple days ago, what's the assets under management for SPY? How big are these mutual fund companies? They are trillions of dollars. And that means that they are making billions of dollars per year. Do you think they want all these people trading on their own? No, because if too many people start doing that, they're going to start to be affected, right? And they're going to like shrink their pocketbook a little bit. So they are incentivized to mislead you. They are. And they're caught doing so, and they're also caught like, just making mistakes. And I get like people do make mistakes sometimes, but this is just to say, okay, Schwab has 310 disclosures on their record. That's nothing to sneeze at. Lots of it's arbitration, somebody brought a suit against them and then it got arbitrated, or regulatory event. The SEC said, you know what, you're doing this and you shouldn't be, and you need to stop now. And I just kind of put some $10 million. This was in January for Schwab. They had a $10 million fine. $135 million fine. Listen, if they're being fined $10 million, $135 million, do they have your best interest at heart? Maybe sometimes they do. I don't want to pick on them that much. But what I'm saying is, watch them and check your statements and check your transactions. Lots of times I found with Schwab as an example, my cost basis is incorrect. Like it didn't get adjusted, that kind of thing. You want to keep a spreadsheet. You want to keep track of your realized gains on an ongoing basis as well, right? It's not about performance. It's not about pulling up a report and with the broker dealer and what was my rate of return last year. I don't care what my rate of return was last year, because that includes like paper gains, paper losses. I don't care about that stuff. How much money did I put in my pocket that I was able to spend? That's what I care about. So keep track of that. Some of the stuff that I'm building, it takes a long time because like I'm not a programmer, but I'm learning programming now. But I want to create like all these like amazing tools for people to use. So stay tuned. So make sure you're part of this like inner circle thing. That's what I'm going to use to like just send people emails. Hey, I got this going. If you're interested, great. If not, that's okay too. But in the meantime, keep a log of your own stuff. Keep notes on your trades, right? Like, okay, whoever said I'm going to buy some BMNR today and I'm going to sell a call against it. What were you thinking? Why did you put the trade in? What was the delta? How much money did you make? What happens after Friday and when the market closes? Like, keep track of that stuff, because especially when you're learning, that's going to be very advantageous to yourself, right? Let's recap a bit, right? So we talked all week, two things only: selling a put, selling a covered call. They're different, yeah? I'm selling a put and I'm committing to buy a stock, but only if it goes lower than the strike price. And it has to do that before the expiration date, right? I'm paid a premium. I keep that no matter what happens. If and when, let's say I sell a put, if and when I get assigned and I have to buy those shares, I could sell a covered call after, though. You have to wait until the shares show up in your account. You sell a covered call against that. You only want to use a strike price that's higher than what you paid for your shares. Why? Because we never want to lose money, guys. We don't want to take realized losses, or we want to minimize that as much as possible, right? Selling a covered call, we're committing to sell our shares if it goes higher than the strike price before the expiration date. If it doesn't go higher, we keep our shares. We keep the premium too, and then we sell another call next week. It's like we keep doing it over and over again. A couple of days ago, we had that scenario. I showed you my screenshot from my trading platform, BMNR. I just kept selling calls against it. It's like hitting the baseball bat, right? I just want to keep hitting singles, singles, singles. So think of that. You just want easy, repeatable scenarios, and you just want to keep hitting singles and make income. You choose three things. The stock, the strike price, the expiration date. That's it. Easy peasy, guys. This is, I know it's hard when it's new, but once it clicks, it will click. Two things that after you put the trade in, you either wait until it expires or you close it early. If you close it early, it might be more or less than what you originally got paid, right? If it expires, it either expires worthless or you get assigned. If you're selling a put and the price goes down and it goes underneath your strike price, that means you get assigned and you have to buy those shares, right? If you sell a call and it expires and the price is higher, it ends up higher than your strike price, you're going to sell your shares at that price, right? At the strike price. So that's kind of what we talked about. You can do this. So I believe in each and every one of you. Listen, there's not one person ever that I taught how to do this that was not successful unless they quit, right? If you quit, then that's on you. But the only reason why you're going to fail is really if you don't have any money to start, because you need a little bit of money, $2,000, $5,000, something like that to put in an account. But paper trade first. That way you don't get hurt. But if you have some money and you pay attention and you understand, get your feet wet. You can do this. It's not that hard, man. It's two things: selling a put, selling covered call. It's not rocket science at all. And I believe in you. Join the community. That's the inner circle, right? So that's just like a email list. I haven't really sent any of those, but that's like if I do another event, maybe you might be interested. If I, release a technology tool that I'm making, maybe you might be interested, and it's good to join. And I want to thank everybody for their attention, and for the great feedback. Always positive vibes for sure. And yeah, and hit me up with any questions. And this was day 5, wrapping it up. Cheers. Hey guys, Michelle here. Oh my gosh, was that a rock star session or what? First of all, you should be so proud of yourself for watching the whole thing. I hope you learned tons of information all about how to sell a put and how to sell a covered call so you can be just like me and create yourself income on a weekly basis. It can literally be life-changing. Be sure to like the video, send it to a friend, put a comment here, subscribe to my channel. I'm putting up a video each and every day for 1,000 days. If you want more support, make sure that you're in my free inner circle. The link is in the comment section below. If you want more support, I have a one-on-one platform that might be a good fit for you. Just send me an email and I'll be happy to give you the details. Cheers for now and happy trading.